Hello everyone. Can you guys please confirm if the audio and video is clear? Quickly confirm if the audio and video is clear. Hello everyone. Can you guys please confirm if the audio and video is clear? Okay. Quickly confirm if the audio and video is clear. चलो क्या बात है. So very warm welcome to all of you and welcome to this marathon session where we are going to quickly discuss all the IND ASs along with important questions, where we discuss the important questions and all the major topics as well. So the idea over here is today we would in one half try to cover all the IND ASs, and in the other half we'll then stop for a break maybe after 3.5 hours, and then on the other half we will try to cover the major topics: business combination, consolidation, financial instrument, share based payment, leases as well as revenue. So I have shared we are definitely not going to kind of do a page turn where one by one we are going to read the charts. No. So the idea over here is I'll quickly run you through the concepts, not going into the detailing on each of them, just to brush up, because obviously you have a week, and by the way, next week at this time you would be in the middle of the exam. Hopefully this session really helps you a week later. So we will discuss the concept quickly and then move on to the questions. Again, I'm not going to sit and read the entire question because these are questions which are there in our material, also there in the institute material. If you have kind of gone through the institute material, and we'll discuss the important adjustments rather than going and investing time at this stage into the calculations. So are we on board? Yes. Is there an echo? Yeah, just a second. I'll just try to cover that. And read the entire question because just a second, please. In our material, also there in the institute material, and we'll discuss the important adjustments rather than and investing time at this stage into the calculations. So, are we on board? Yes. Just a second. Is there an echo? Yeah, just a second. I'll just try to cover that. Just a second, please. Hello. Is it better now? Is it better now, or is it still echoing? Let me just check. Okay, so chalo, hit the like button and let us get started with this all important marathon session. Okay, so I'll just also share a number on the chat itself in case there is some technical problem and I am on the session. You can just call over there 79772 99310. I'll just put this on the chat, so just in case there is some issue, you can kind of connect over there. Okay. Yes, this will be available. This will be available on YouTube as well. So I mean I always keep whatever if is a content, whenever I do a live stream, it will always be there on YouTube. So I mean it's an implied thing. I'll not kind of take this later. Okay. The concept notes. Yes, this will very well be available on YouTube. Okay. So concept notes, I'm not going to go through the notes. This is exactly the same as that of the shield. I'm not honestly going to go through the notes one by one. I'm kind of going to discuss the concept and going to go into the question fairly quickly. Okay. The idea over here is to finish this in around 6 to 7 effective hours. So maybe 3.5 hours approximately for the topics, 3.5 hours for all other IND ASs. So you can guess that in the next 6 to 7 hours, a lot of your content should get done. Okay, perfect. Okay, chalo. So we will first start with we will first go in the order of logical sequence. You might have to go a little back and forth. We'll first start with IND AS 16. We'll first finish the asset link standards. So we'll finish IND AS 16, 38 and 40 at one go, and then we will cover the important questions on these three. Then we'll do impairment and non-current assets held for sale, important questions for these. So I will take you in batches. Okay, so over here, if you go to IND AS 16, which is on property, plant and equipment, this is in important tier 1 category standard. The items over here that we remember is what is a PP. PP refers to items which are tangible, which is held for the purpose of use in the ordinary course of business and has a life of more than 12 months. All tangible assets covering this criteria will be covered except for IND AS 105, non-current assets held for sale, except for biological assets which are held for agricultural use, except for bearer plants which are getting covered under this standard. So how do you recognize the asset initially? You will recognize the asset initially at cost, which includes the purchase price, non-refundable, non-creditable taxes, directly attributable expenses, and if it's a qualifying asset, you will also include the borrowing cost and a present value of provision for site restoration. While we are taking the directly attributable expenses, standard specifically excludes 4 items. First, relocation and retraining expenses. Second, inauguration expenses. Third, expenses which are incurred after the asset is ready for use. And fourth, if there are expenses which are incurred for the purpose of staff training. These are the 4 items which are excluded. In case there are incomes which are earned after the asset is or during the period of construction, this income is to be subtracted from the cost of the asset after if the asset is ready for use, and after that any income is generated, that goes to the P&L. But before that, if any income is directly attributable to the cost of construction, we usually reduce it from the cost of the asset. If it is not directly attributable, we take it to the profit and loss. A very important discussion over here includes provision for site restoration, where you will create a provision at the present value of the site restoration obligation, and in each year you will try to unwind this. So your opening provision plus whatever is the discount factor, you will unwind this, and that will be taken to the profit and loss. In certain circumstances, there may be a change in the estimate of the site restoration obligation. If the entity is following the cost model, the change will go against the cost of the asset. If the entity is following the revaluation model, this change will be going into the revaluation surplus. A quick summary. There are 2 special cases over here. First is if there's a deferred payment. So if you are making a payment at or beyond 12 months, then the standard says you will record it at the cash price equivalent or present value as the case may be. If the payment is within 12 months and there is no explicit loan or interest mentioned, then you will consider this to be a regular credit purchase of the asset. In case of barter, barter is recognized at fair value, and this is fair value of the asset given up as a first preference. If not available, fair value of the asset received. If not, then the WDV of assets. This is provided the barter has commercial substance. If the barter lacks commercial substance, in which case you will recognize the transaction at WDV. Lacking commercial substance, usually if nothing is given, we will always assume the barter has substance if it is an exchange of different assets. However, if it is an exchange of similar assets, or if the question specifically tells you, you will assume that the barter lacks substance. Then you have subsequent expenditure. Usually, if the expenditure increases the life or efficiency, you will capitalize. In other cases, you will take it to the P&L. However, if there's a major inspection, major overhaul, or major replacement, then you will add the cost of the new part and then subtract the WDV of the old part in order to find the revised WDV of the asset. In case the WDV of the old part is not available, you will look at the supplier's invoice. If that is not available, then the fair value of the asset, and if that is also not available, then the price of the new part adjusted for time and then subsequently depreciated will be taken as a base for the purpose of finding the WDV of the old part, as the case may be. Then a very important discussion includes the measurement of the asset subsequently, which is cost model, revaluation model. In cost model, you will take the initial cost, subtract the accumulated depreciation and impairment if any. Under the revaluation model, you will take the fair value. This fair value is determined at sufficient intervals. Sufficient intervals for assets having stable values are annual intervals. Are assets having volatile values are annual intervals. And if the asset has a stable value, it is between 3 to 5 years. The revaluation model, if selected, has to be selected for a class of PP, and a class of PP refers to assets having a similar nature and a similar end use. In case assets having a different class, you can follow a different valuation model as well. If there's an upward revaluation, that revaluation will go into revaluation surplus, which is a part of non-reclassifiable OCI. If it's an initial downward revaluation, it will go to the profit and loss account. Non-reclassifiable OCI means on happening of certain events, like for example sale of an asset, you will take the balance in the revaluation directly to the retained earnings. You will not route it through the statement of the profit and loss account. Last part of this standard involves depreciation. Depreciation over here, there can be a change in the useful life estimate, a change in the salvage value estimate, or even in a change in the method of depreciation. All of these are treated as changes in accounting estimates and have to be prospectively applied. However, in case there is a component, if there is a major component which has a useful life which is different as compared to the useful life of the overall asset, you will follow the component method of depreciation, in which case you will depreciate the part as per the useful life of the part or the useful life of the asset, whichever is shorter. In case of other parts of the asset, you will depreciate it over the overall useful life of the asset. Component method is to be done if there are major parts which have a life which is different. Parts can be physical parts, they can also include major inspection or major overhaul. This broadly takes care of the broad theory. In case of site restoration obligation, there are two ways in which a change in the estimate of site restoration is adjusted. If you are following the cost model, then if there is a change in the provision for site restoration, that change has to be adjusted against the cost of the asset. If you are following the revaluation model, then since the asset is to be shown at fair value, not at cost, any change in the value of the asset will be adjusted against the revaluation surplus, and hence as per appendix to IND AS 16, you will adjust this balance against the revaluation surplus. So this kind of takes care of the concept base of IND AS 16. We'll do a very quick discussion of IND AS 38 and 40 and then go to the questions on this. So when we look at IND AS 38, this is on intangible assets. So when we look at intangible assets, when will a particular asset be classified as intangible? There are three criteria. First, it has to be identifiable. Identifiability means it has to be either separable or it has to be having a separate license or a contract. Separability means you are capable of selling it separately, or if this item is a separate license or a separate right or a contract. Are we clear with this? So this is what you mean by separability. Secondly, it has to be non-monetary. Third, it has to lack physical substance. That is when it is intangible. For something to be shown as intangible in the balance sheet, it has to meet the basic features of an asset being intangible, and the cost has to be measurable. And as a result, a lot of self-generated assets do not make it up to the balance sheet because their cost is not reliably determinable. We need to remember that certain deferred revenue expenses, if there are deferred revenue expenses like preliminary expenses not written off or advertisement expenses, major training expenses, they will go to the profit and loss account irrespective of the fact that the question tells you that the entity expects to generate greater benefits. That's fine. You recognize expenses as and when they are incurred, not defer it unless a standard allows you. Special cases over here involve research and development cost, where expenses incurred during the research phase are taken to the P&L. Expenditures incurred during the development phase are capitalized subjected to certain conditions. That is, it should be technically viable, legally feasible, cost has to be measurable, financially feasible. That is when you capitalize. Otherwise, you take it to the P&L even if it is a development phase. If nothing is available between research and development, we will assume in the exam that it is expenditure during the research phase. In case you are taking over a business in which case there is certain in-process R&D, then in-process R&D will be taken over as per IND AS 103 at its respective fair value. Till the time an intangible is under development, you will compare the carrying value with the recoverable value annually. You don't wait for the indicators. You will compare the carrying value with the recoverable value till the time the asset is under development, because you do not amortize assets which are under development. The next part includes amortization principles. So when we are looking at amortization principles having assets having a finite life will be amortized over the finite life, or in case no details of finite life are given, then if there is an indefinite life, then there will be no amortization. However, you will test the asset annually for impairment in case the assets have an indefinite life. You can follow any method for amortization in case there is a finite life. However, a revenue-based amortization is not permitted unless a revenue-based amortization will necessarily reflect the nature of the transaction. In all other cases, a revenue-based amortization is not permitted. Are we clear with this? Okay. Next, the other accounting principles like initial recognition, subsequent measurement, everything remains the same. Just remember that in case of an intangible asset, you can follow revaluation model if and only if the fair value is available from an active market. In all other cases, revaluation model is not permitted under IND AS 38. You have to follow the cost model. So that takes care briefly about IND AS 38. Last among these three topics, which are sister concerns, is IND AS 40 on investment property. There are 4 things in investment property that we have to see. It has to be land or building or both, which is primarily held for the, which is owned by the entity or held as a right of use asset, and which is primarily held for the purpose of earning rental income or capital appreciation or both, and not held for the purpose of your own use or for the purpose of sale in the ordinary course of business. That is what you call as an investment property. Now, there are certain guidances which the standard gives you, like in case of assets which are either under construction or assets which are currently vacant. At the time of initial recognition, the standard says you look at the intention. If the intention at initial recognition is to use this asset for your own use, you can show it as PP. If it is for the purpose of renting out, you can show it as investment property under development or otherwise as a case may be. However, once the asset gets classified as a PP or investment property, a reclassification can be done only if there is a change in actual usage. If there is no change in actual usage, you will not do any reclassification. However, sir, if you are undetermined, if you are not sure whether the asset is to be held for own use or for renting out, then the standard gives you guidance. If it is undetermined use, you will show it as investment property. What if the assets are held for dual use, like it's a 5-floor building out of which 2 floors are held for own use, 3 floors are given on rent to the others, in which case if these properties, that is 2 and 3 floors, are separately saleable, you will recognize them proportionately as PP for 2 floors and proportionately as investment property for the remaining 3 floors. However, if it's a 5-room flat, it's a single flat, and out of which 2 rooms are held for own use, the remaining 3 rooms are rented out. Because you cannot sell the 2 rooms separately from the 3 rooms, the entire property will be shown as a PP unless the own use component is insignificant. Unless given otherwise, we will never assume that the own use component is insignificant, and hence it will be treated as PP entirely. What are the differences if something gets classified as investment property? If something actually gets classified, let us say, as investment property, your initial recognition, subsequent measurement, everything remains the same as that of PP, just that at the time of subsequent recognition, you do not have the revaluation model option. You have to recognize investment properties using the cost model only. Can I depreciate these investment properties? Yes, the building component can be depreciated. The land component, like PP, will not be depreciated. Fair value over here has to be separately disclosed along with the notes, where you have to mention the details of the valuer, the valuation method used, assumptions used, etc. in the notes in case of investment property. A few special cases that you can look at in case of investment property involve reclassification. That is, reclassification from or to investment property can happen at the carrying value at the date of reclassification, and this happens if there is an actual change in use and not just a mere intention of change in use. In case holding company gives on rent property to its subsidiary company or vice versa, you have to look at evaluation in SFS and CFS separately. In SFS, if you have given it on rent to subsidiary, still you have given it on rent, so it is an investment property. In CFS, it depends on the ultimate use. So if the parent gives it on rent to the subsidiary and subsidiary uses it for its own head office, then for the group it is held for its own use, and hence it is to be taken as PP. Are we clear with this? Yes? Okay. Yes, you can depreciate leasehold land as well in case it is for a specific period, in case it is renewable as per IND AS 116. If it is an indefinite life, there will be no need for an amortization. Okay, so we'll quickly go through the questions. I have shared the PDF of these questions on the Telegram channel, so you can refer this. IND AS 16 is on page number 14. So we will quickly refer this question on page number 14. This question is a multiple time exam question. I would definitely rate this as important. I hope you would have gone through this question earlier as well in the course of your revision. I'm not going to kind of glance through the entire question. So over here, what is happening is, on 1st April, the company is purchasing some land. The cost of the land is included into the cost of the asset, including the legal expenses. So on 1st April, Sun purchased some land in order to construct a factory. The construction work commenced on 1st May. You have purchased the land on 1st April, construction work commences on 1st May, and hence, if building is a qualifying asset, capitalization of borrowing costs can start from 1st May only, because expenditure incurred is happening from 1st May for the building part. Sun incurred the following costs in relation to the contract: leveling of land, directly attributable and hence added; purchasing of materials, again directly attributable and hence added; employment costs for construction workers, again if this is directly attributable you should add, but this is per month, so you will have to find the number of months for which the construction is done; overhead cost incurred directly on construction of the factory, so 1 lakh rupees per month, so these overhead costs are directly attributable to the construction of the factory, they should be added; ongoing overhead cost allocated. Remember, cost which is merely absorbed or allocated is not going to be taken into the overall cost, it will be taken to the P&L directly because it is not directly attributable. So this will not be capitalized. Income received during temporary use of the factory as a car park. So if you are generating income as a car parking, this is not directly attributable to construction and hence it will be taken to the P&L, it will not be subtracted. Cost of relocating the employees. We have said that relocation expenses will be taken to the P&L directly and hence they will not be added. And cost of opening ceremony or inauguration ceremony, again this has to be taken to the P&L. This is not directly attributable. Acha, the factory was completed on 30th November 11. So it started on 1st May, got completed on 30th November and hence it took 7 months. So over here, employee cost as well as overhead cost, which was given on a per month basis, you will multiply this by the number of months, that is 7 months, in order to find the total cost, which is considered as a substantial period of time. Now this is where a lot of students have a question that can we consider this to be a qualifying asset? Well, in case the question specifically instructs you that 7 months is a substantial period of time, you can very well take this as a qualifying asset. If the question remained silent, it is open on you to assume. So if you assume that 7 months is not a substantial period, then there is no need to capitalize borrowing cost. If you assume that 7 months is a substantial period, then you can capitalize the borrowing cost. If nothing is given, we will assume 12 months to be the threshold unless otherwise given. And production began on 1st February 12. Let the production begin on 1st February 12. Remember, depreciation starts the moment the asset is ready for use. The moment it is ready for use on 30th November, irrespective of when the factory actually starts production, you will start your depreciation. The overall useful life of the factory building is 40 years from the date of completion. However, it is estimated that the roof will need to be replaced 20 years from the date of completion, and the cost of replacing the roof would be 30% of the total cost of the building. So when we are looking at this expenditure, we will say that our total expense, if you see the solution, you have a total of all of these expenses. Now, a part of these expenses is attributable to building, a part of it is attributable to land. Now, whatever is attributable to building, the materials, employees, overheads, everything has gone into the construction of the building, including the roof. So I don't need to capitalize the cost of the roof separately. However, this roof has a life of 20 years, whereas the overall building has a life of 40 years. And hence this shows the application of a component method of accounting. So under the component method of accounting, you will segregate the asset into major components. The components over here can be land, which has an indefinite life and hence no depreciation. Building within which there is a roof which has a life of 20 years and other parts of building which has a life of 40 years. So these other parts will be depreciated over a 40-year time frame and the roof will be depreciated over a 20-year time frame. While you are depreciating the roof, you will take 30% of the overall cost of the building. Okay. Again, depreciation will be for 4 months. Because the asset is ready on 30th of November, from that December, January, February, March, 4 months there will be depreciation. At the end of the 40-year period, Sun has a legally enforceable obligation to demolish the factory and restore the site to its original condition. So there is a legal obligation to restore. So at present value, you will record it as a part of the cost of the asset. The directors estimate that the cost of demolition in 40 years time will be 20 billion, but this is cost after 40 years and hence you will have to record it at present value. An annual risk adjusted discount rate appropriate to the project is 8% and the present value is 0.046, and as a result we will record at present value. So this is 20 into 0.046. I think 9,20,000 is the value that you will get, which is added to the cost. The construction of the factory was partly financed by a loan of 17.5 million taken out on 1st of April 2011. Now, in this question, even in the institute material, they have not been very categoric, very discrete. So over here, if this loan is given for the construction of the factory, this is attributable to the building element and hence whatever is the borrowing cost from the commencement date is the date of loan, or so date of loan is 1st April, or the date of expenditures incurred. or activities commenced, whichever is later. So expenditure incurred, activity commences from 1st May, and hence the capitalization of borrowing cost starts from 1st May and continues up to 30th of November, and hence there will be a 6-month borrowing cost capitalization. In the first month, even if the borrowing cost is incurred, that is in the month of April, it will go to the profit and loss. The loan was at an annual interest rate of 6%, and Sun received investment income of 1 lakh on the temporary investment of the proceeds. Ideally, they should clearly tell you that this temporary investment is for what period. If nothing is given, Institute has implicitly assumed that this is temporary investment during the period 1st of May to 30th of November, and hence they have subtracted the entire 1 lakh, because Ind AS 23 says that if the borrowing cost is capitalized, then the income which is generated on temporary investment of surplus funds should be subtracted from that corresponding borrowing cost, and hence whatever is the borrowing cost to be capitalized, that is 17.5 million into 8% into 6% into 6 by 12, that will be capitalized minus income on temporary investment of 1 lakh, and that net borrowing cost will be capitalized. So over here you will take the total borrowing cost, from this subtract income on temporary investment, and the net cost of the factory will be taken. Now out of this cost of the factory, we can say 1 crore is attributable to land, and hence the remaining 99,12,500 is attributable to building. Now out of this 1 crore which is attributable to land, there will be nil depreciation. However, to the building, we said roof 30% is attributable, and hence the depreciation will be based on that. For other parts of the building, 70% is attributable, and hence the depreciation will be calculated based on that. I am not going to do the numerical calculations at this stage. We are just doing a principle and a concept based discussion of important adjustments for the important questions. Are we clear with this? Yes? Okay. So this takes care of the question of Ind AS Ind AS 16. It's kind of a master question covering quite a lot of adjustments. Next you go to Ind AS 38, where we take one of the exam questions which had come in the January 21 paper. It had a few interesting adjustments. Question over here is from the January 21 paper. It is there in question 14 of our books. So Super Sound says the following transactions. So this is on page number 55. You can just focus on the screen as well. You don't really need to go and mark every question into your notes. You can just listen to the key adjustments and discussions, and that will kind of be sufficient. Super Sounds has the following transactions during the year 1920. On 1st April, Super Sound purchased net assets of Music Limited, a separate company, for 13,20,000. So this is PC. The fair value of Music's identifiable assets was 10 lakhs, which means 3,20,000 remaining is goodwill. Super Sounds is of the view that due to popularity of Music's products, the life of goodwill is 10 years. Remember, under Ind AS 103, goodwill is having an indefinite life. It has to be tested for impairment annually. It cannot be amortized, and hence whatever is given in the question, we will not be able to amortize the goodwill over 10 years. In fact, we will test it for impairment annually. So over here there will be an intangible to the extent of 3,20,000, that is goodwill, which will continue to appear. Second, on 4th of May 19, Super Sounds purchased a franchise to organize musical shows from Arman TV for 80 lakhs. Let's say this is 80 lakhs, and an annual fee of 2% of the musical show's revenues. So I'm paying 80 lakhs to acquire a franchise. A franchise right is a contractual right, and it is like a license, and hence it is an intangible asset. It is separately identifiable, should be recorded at the initial cost. Initial cost is the price that you pay to acquire the license, which is 80 lakhs. So 80 lakhs should be a part of the cost of the license, plus an annual fee of 2% of the musical show's revenues. Now that 2% cost is not directly attributable to acquisition. It is linked to operation, which means if you operate and generate a revenue, 2% of that is to be paid. If you don't operate, do not generate revenue, then nothing of that 2% is to be paid, and hence the 2% will be a revenue expense to be taken to the P&L, will not be added to the cost of the franchise license. The franchise expires after 5 years. Musical show revenues were rupees 10 lakhs for the year 1920. Projected revenues for the year 2021 are 25 lakhs and 30 lakhs per annum for the remaining 3 years thereafter. Okay, so you are acquiring a franchisee license at 80 lakhs. Your initial recognition will be at 80 lakhs and you will amortize it. Now the life of this license is 5 years and you have been given various revenues. Remember, a revenue based amortization is not appropriate, and amortization, if nothing else is available, will be based on a straight line basis. So over 5 years you will amortize. Now ideally you are purchasing on 4th of May, and hence there are approximately 11 months, and hence amortization ideally should be for 11 months. However, if you just bypass adjustment 3, if you read at the end, it is given a full amortization is to be done in the year of acquisition, because this question is giving you that specific instruction to do a full year amortization in the year of acquisition. We are amortizing it over the entire 12 months. However, ideally it should have been done for 11 months only. So this will be 16 lakhs amortization 1 by 5, 80 lakhs divided by 1 by 5, and hence 64 lakhs will be appearing in the balance sheet on account of this license. On 4th of July, Super Sounds was granted a copyright that had been applied for by music during the year 1920. Super Sounds incurred 2,50,000 on a legal cost to register the patent or copyright. So this is directly attributable, and hence the 2,50,000 should be capitalized. However, it further says, and a further 7 lakhs additional cost to successfully prosecute a copyright infringement suit against a competitor. Now this 7 lakhs can be taken to the P&L, considering it is not directly linked to acquisition. It is linked to protection of your license, not directly linked to acquisition. However, if in a special case you tend to assume, or it is given, that this 7 lakhs had to be incurred, infringement suit had to be quashed before you were given this license, then it can be directly attributable, and in such cases it can be capitalized. Institute has taken it to P&L. I would also prefer if you take it to the P&L on the assumption that this is a cost to protect your copyright and not necessarily a cost to acquire your copyright. The life of the copyright is 10 years. Can the copyright be amortized? Well, yes. 2,50,000, which is a copyright, will be amortized over a period of 10 years, that is 25,000, and hence 2,25,000 will be shown as an intangible asset. So PP will appear, there is no PP. Intangibles, you will have separately a line item for goodwill, which is 3,20,000, no amortization. Then other intangibles will comprise of 64 lakhs as well as 2,25,000 in your balance sheet. In your profit and loss account, there will be revenues from the sale of that music show. A 2% of that revenue will be taken as cost, and 7 lakh as the legal expenses for that copyright claim will be taken. You are required to show a schedule showing intangible section in the Super Sound balance sheet. So we have discussed that you will have goodwill, you will have franchisee rights, and you will have these copyrights or patents, and a schedule showing related expenses that would appear in the statement of the profit and loss. So when you look at the statement of profit and loss, the related expenses will include 2% of the musical show revenue in the first year, 7 lakh as legal expenses, and the amortization cost of 16 lakhs on the franchisee right and 25,000 on the copyright. Okay, so that kind of takes care of this intangible question. Next, you go to investment property. So over here, when we are looking at investment property, there is this fairly big question of Shaurya Limited, where Shaurya Limited had 2 buildings, property A and property B. Both of these buildings were held for the purpose of capital appreciation, and you had given it out on rent. In which case, how will you recognize these assets? Well, you will recognize these assets at their initial cost less depreciation, because there is building, so there will be depreciation. So you will recognize it at their initial cost less depreciation, and during the year, if there is any income earned and if there are any other expenses, this income as well as other expenses will go to the profit and loss account separately. So it's fairly detailed question. I guess you would have some sense on this. So if we look at the relevant information for building A for 31st March 12, building A was purchased 6 years ago at a cost of 10 crores and its life is estimated to be 20 years. So it was purchased 6 years ago. From 6 years ago, let us say from 31st March 2012, and its life is 20 years. So over here, if your initial cost is 10 crores, then up to the start of the year, the accumulated depreciation, up to the start of the year, 5 years would have gone by plus 1 year, the current year, and hence 6 years till date. So over here, 10 divided by 20 into 5. So whatever that comes to, I guess this is 10 divided by 20, that is 0.5 into 5, that's 2.5 of accumulated depreciation. And in the current year, a further 0.5 of depreciation will be recorded. So at what value? So 2.5 is your accumulated depreciation plus 0.5 in the current year, and hence 3 is the accumulated depreciation. Your closing net block will be 7 from building A. During the year, company has invested in another building B for capital appreciation. This is purchased on 1st April at a cost of 2 crores and expected life is 40 years. Company follows SLM. So 2 crores divided by 40 will be 0.05 depreciation of the current year for building B. So in case of investment property, you will recognize everything using the cost model only, and hence you will recognize it at the WDV. There is a group of income and expenses given which will be taken to the profit and loss account. Now separately, there is this entire paragraph which was given where discussion about fair value is done. Like you had appointed an independent valuer who used discounted cash flow techniques, took various assumptions and came to a fair value, let us say, of 10.5 crores. What do you do with fair value of 10.5 crores? Do you guys remember? What do you do with the sum on 10.5 crores? So on 10.5 crores, you will just give a disclosure in the notes to accounts. You will not be recording it in the books of accounts. You will just merely give a disclosure in the notes, and you will also kind of disclose the method used, assumptions taken, all of this. You will give disclosure in the notes to accounts. Are we clear with this? Yes. Okay. So this kind of takes care of IND AS 40. So see, I mean, I can't discuss each and every question over here. I hope you understand. You have a limited time. I mean, if we discuss, this can go on for around 15 hours. I mean, it will defy the entire purpose. The idea over here is to kind of give you a quick gist so that you can proceed and not discuss each and every question. There are a group of questions, but if we keep on solving all of them, well, it will take a fairly long period of time. Okay. So what do you, I mean, so we'll go to the next bunch of, so you'll go to IND AS 36. How, I mean, just tell me whether I'm going very fast, very slow, you need me to cut down something, it is going proper. Just tell me in the comments so that I can kind of improvise that from IND AS 36. Yes, this video will very well be there on YouTube. Do you want me to increase the speed, reduce the speed, manageable? What do you guys think? चलो ठीक है. Okay. ठीक है चलो. So I think most of you feel it is manageable. Some of you say fast when I say when. Okay. चलो ठीक है. We'll go to impairment now. Then we look at impairment under IND AS 36. ठीक है. Okay, Nisarg, point taken. Yes, acha. So when you look at, we have a limited amount of time over here. If you want a much more slower speed, I would suggest you actually look at the full revision videos, I mean, which are there on YouTube, because if we go even slower, we'll even cross midnight, right? So we'll focus on that. Chalo. We'll go to IND AS 36. We'll quickly discuss the important parameters on IND AS 36. On IND AS 36, we will have two types of impairment. First, it is a single asset impairment, and then impairment under a cash generating unit. Cash generating unit part is more important from an exam standpoint. When you look at an individual asset, you compare the carrying value with the recoverable value. Recoverable value is the higher of the fair value less cost to sell, or the value in use. Fair value in use is calculated as a present value of future cash flows. While you are calculating value in use, remember the value in use is calculated before deducting interest, before deducting tax, and hence the discount rate that you take will be the pre-tax WACC, and you will not take the cost of equity. Second, if there are any restructurings or any new technologies, you will consider the expense only if the entity is committed to the restructuring or incorporating the new technology. Otherwise, you will not take it. If the foreign currency, if there are foreign currency cash flows, you will convert, you will discount the foreign currency cash flows at the foreign currency discount rate to find the value in use in the foreign currency, which you will convert at the spot rate to find the value in use in the Indian rupees. If there is a site restoration obligation attached to your asset, you will compare the net carrying value, that is the carrying value of the asset minus the provision for site restoration, with the value in use or net selling price also after deducting the commitment for site restoration. So these are the crucial elements for the purpose of single asset impairment. In case there is an impairment, you will first reduce the impairment from the balance available in the revaluation. If there is no balance in the revaluation, then it will be adjusted against the profit and loss account. Can there be a reversal of impairment? Reversal is permitted for all assets except for goodwill. Again, reversal can be done only if there is an improvement in service potential. In other cases, you cannot be doing a reversal of impairment. While you are doing reversal, a few steps have to be remembered. First, you try to calculate the carrying value had there been no impairment. Second, you look at the recoverable value and find out the maximum ledger balance that can be shown after the reversal. Compare it with the actual ledger balance, and the difference between the two will be shown as a reversal of impairment to the extent possible. So this is about single asset impairment. Impairment can be done only if there are indicators which are existing, except for a few assets like goodwill, intangibles with an indefinite life, or intangibles under development, where annual impairment testing needs to be done. Next, you look at cash generating unit, which is a more important part. Within cash generating unit, the impairment under a cash generating unit is very important. So when you look at a cash generating unit, this is the smallest group of identifiable assets which is capable of generating a largely independent cash flow. In case there is an indicator of impairment on an asset which is not capable of generating a largely independent cash flow, that is when you go to the cash generating unit. In case of a cash generating unit, you will have a group of assets. So how do you do the impairment? In step 1, you calculate the carrying value of the cash generating unit. The carrying value will include the carrying value of identifiable assets plus the carrying value of allocable corporate assets plus the carrying value of allocable goodwill, if it is possible to be allocated. Compare this with the recoverable value of the entire CGU. The difference between the two is treated as impairment. Impairment will first be written off against goodwill and excess, if any, against other eligible assets. Other eligible assets can include PP, intangibles, investment property, etc. in the ratio of their carrying value. While you are reducing the impairment, you have to be careful that you cannot take the value of the asset below the individual recoverable value if data is available. Now, there are a few interesting questions that have come in the past regarding this concept, so you should focus on that. Secondly, what if there are unallocable corporate assets or unallocable goodwill? Sir, first of all, if there are allocable corporate assets, in which ratio can we allocate? In case the useful life is given, then you will multiply the carrying value with the useful life. Whatever is the total product, the weights will be considering carrying value into the useful life. If useful life data is not given, then you will allocate the corporate asset in the ratio of carrying value if it is allocable. However, if the question specifically instructs you that the corporate asset is unallocable, in which case you will do a two-tier impairment testing, where you will first try to do impairment for the smaller cash generating units. If impairment of smaller cash generating units is done after considering allocable corporate asset, then you go to the larger cash generating unit, which includes even the unallocable asset, which is usually the company as a whole. And then you again do impairment testing for the larger unit, that is the cash generating unit, for all the CGUs including the unallocable assets. Two-tier impairment testing whenever there is unallocable corporate assets or unallocable goodwill, as the case may be. And the last part of the standard involves impairment loss in case of a subsidiary. So in case there is a subsidiary and subsidiary has various cash generating units, then you will have to do impairment testing at the group level for impairment loss in the subsidiaries books. In case the subsidiary is following full goodwill method, that is NCI is recorded using the fair value, in which case you will calculate the goodwill, allocate the goodwill to the various cash generating units of the subsidiary, and then do the impairment testing. If there is an impairment loss, that impairment loss will first be allocated to goodwill, then to other assets. Each of these losses will be borne by parent and NCI both, because subsidiaries assets belong to parent and NCI both. If it is full goodwill, there is a part of goodwill which is attributable to NCI as well, hence there is no separate adjustment needed. The problem arises in case of partial goodwill, because in case of partial goodwill, you take over 100% of the subsidiaries assets and liabilities. However, goodwill is recorded only partially. To compare it with the recoverable value, which is for the entire business of the subsidiary, we need to gross up the goodwill to include the unrecognized goodwill attributable to NCI as well. So your total carrying value, including the gross full goodwill, will be compared with the recoverable value, and an impairment loss is determined. That impairment loss is first allocated to goodwill, and then allocated to other assets. Within goodwill, a part of the loss is attributable to the parent, a part of it is attributable to NCI. In the P&L, you only record the loss attributable to parent because NCI's share is not even recorded in the books. You cannot impair a non-existent asset. For the other assets, you will allocate the impairment loss to the parent and NCI both, because in the books you have recorded the full assets. We will do sums on this to get a better understanding. So this is about impairment. A allied standard to this would be IND AS 105. This is non-current assets and discontinued operations. So when we are looking at non-current assets held for sale, what do you mean by a non-current asset? Well, everything which is other than a current asset is treated as a non-current asset. Disposal group is a group of assets and liabilities which an entity intends to sell, and discontinued operation would be a component, a division, a part of the entity which has either been disposed of or it is discontinued, that is abandoned. So this is a past event, or it is held for sale. So how is a disposal group and a discontinued operation different? Well, in certain cases, a disposal group can also be a discontinued operation and vice versa. However, if there's a group of assets, like I have 10 classrooms out of which I'm deciding to dispose just one of them, there is a disposal group. If it's a disposal group, I will follow the regular principles of IND AS 105, but I don't need to disclose the profit or loss of that disposal group separately on the face of the income statement. However, if I have 3 divisions, the coaching division, the fast food division, and let us say a CA practice, I decide to discontinue the fast food division, in which case, apart from comparing the carrying value and the fair value less cost to sell of these assets, if they are held for sale, I will also have to disclose the profit that is earned separately on the face of the income statement as profit or loss arising from discontinued operations. So this is the significance of showing something as a discontinued operation. Now, when a particular asset is classified as held for sale, what is the criteria to be seen? There are 2 important criteria for classification. First, it has to be available for immediate sale in the present condition. Immediate sale meaning there should be no backlog. The asset should not be critical to the entity's ongoing operations. If there is a delay in selling because of a customary or legal factor, then such a delay can be ignored. Secondly, it should be available in the present condition. That is, if there is any renovation, etc. pending, the asset is not available for sale in the present condition. Secondly, the sale has to be highly probable. There are 5 conditions for sale to be highly probable. Appropriate level of management should be committed to the sale plan. Second, active process should be started or buyer should be identified. Third, the price should be reasonable. Fourth, the sale process should be completed within 12 months and there should be no change likely in the sale plan. If an asset is classified as held for sale, then you will show it at the lower of the carrying value or the fair value less cost to sell. If the fair value less cost to sell is lower, then there will be a write-off to be written under the P&L, which you can call as impairment. Once an asset is classified as held for sale, you will stop depreciating the asset and you will show this asset as per its a separate disclosure as non-current asset or disposal group held for sale. In case there is a change in the plan to sell, in such cases you will calculate the carrying value had there been no held for sale classification, compare it with the recoverable value and take the asset to that value. The difference will be shown as gain or loss on classification. The accounting for disposal group held for sale is exactly similar to a cash generating unit held for sale. Impairment loss, if any, will be allocated first to goodwill and then to other eligible assets. Okay, so this broadly gives a bird's eye view over IND AS 105. We will go to the questions on IND AS 36. There are I think 3 or 4 questions that we have taken. These are fairly detailed questions. So over here, if you go to the questions for IND AS 36 and 105, first is an IND AS 36 question which had come in a very recent exam question. This is a very detailed question which covers all your accounting for a cash generating unit. So this one question and all your accounting for cash generating unit will be kind of covered. So if we refer this, question number 1, LDR is a manufacturing company which deals in cold drinks and it is having various plants across India. There is a machinery A in the Baroda plant which is used for bottling. There is one more machinery, there is machinery B which is clubbed with machinery A. Okay. A can individually have an output and can be sold independently. Machinery B cannot be sold in isolation without clubbing with machinery A. So it is like a filter, for example, that you are using along with machinery A. Company considers this group of assets as a CGU and an inventory amounting to 2 lakhs and goodwill amounting to, this is 1.5 lakhs actually, 1.5 lakhs is included in such a CGU. So remember, the identification of CGU is management's responsibility, not your responsibility. If the management says machinery A, B, inventory and goodwill are a part of CGU, well, all 4 of these are a part of CGU. Machinery A was purchased on 1st April 13. Today we are sitting, let us say, on 31st March 18. It is given somewhere at the end, but let us say we know that today we are sitting on 31st March 18. So if machinery A was purchased on 1st April 13, 5 years have gone by for 10 lakhs and residual value of rupees 50,000 was there. Machinery B was purchased on 1st April 15 for 5 lakhs with no residual value. So basically 3 years have gone by for machinery B. It has a 10-year life. The useful life of both machines is 10 years. So for machinery A, out of 10 years, 5 years have gone by. For machinery B, out of 10 years, 3 years have gone by. 7 years are remaining. The company expects the following cash flows in the next 5 years pertaining to machinery A. Remember, this is only for machinery A, not for the CGU. The incremental borrowing rate is 10%. So you have been given all of these cash flows, which is excluding the residual value. Remember, the salvage value should also be taken into the calculations. On 31st March 18, the professional valuers have estimated the current market value of the machinery is 7 lakhs. This has been already estimated. The valuation fee was 1 lakh. Now this is interesting. Will valuation fee be an incremental cost to sell? The answer is no, because the valuation fee is linked to valuation. It is not linked to sell. The cost to sell is considered to be expenses which will be incurred if you sell, which will be avoided if you don't sell. Valuation fee is linked to valuation, and since the valuation has already been done, that is at 7 lakhs, either this fee has already been paid or it has to be paid. It cannot be said to be incrementally linked to the sale, and hence this 1 lakh you do not subtract. There is a need to dismantle the machinery before delivering it to buyer. Dismantling cost is 1.5 lakhs, which is incremental. Specialized packing cost would be 25,000 and legal fees would be 75,000. Each of these are incremental in nature, and hence if I want to find a fair value less cost to sell, it is 7 lakhs or 700,000 minus dismantling cost of 1,50,000. So this is less 150, less packing cost of 25,000, less legal cost of 75,000, and 4,50,000 is going to be the net amount. The inventory has been valued in accordance with IND AS 2, so it is already written off if required. The recoverable amount of CGU is 10 lakhs as on 31st March 18. In the next year, the company has done the assessment of recoverability of CGU and found that the value of CGU is 11 lakhs. So maybe there is an additional impairment or there is a reversal of impairment in the next year. The recoverable amount is 4,50,000 for machinery A and combined A and B is 7,60,000. So we are required first to compute the impairment and the carrying values on 31st March 18. So first you will look at machinery A, machinery B, inventory as well as goodwill. As per management, all of these are a part of your CGU. And hence you will try to find a value for machinery A. Machinery A was purchased at 10 lakhs, 5 years have gone by, 5 years are remaining. So if you calculate your regular depreciation after considering the salvage value, I guess this comes to 5.25 lakhs. Similarly, you do the working for machinery B, where out of 5 lakhs, which is to be spread over 10 years, 3 years have gone by. So 50,000 per annum depreciation, and hence 3.5 would be the value. So considering all of this, 5.25, 3.5, 2 and 1.5, this is 12.25 the carrying value. Compare that with the recoverable value of the entire CGU, which is given to you as 10 lakhs, and hence the impairment under IND AS 36 will be 2.25 lakhs. Out of this impairment of 2.25 lakhs, first attribution will go towards goodwill. So out of 2.25, 1.5 will be attributable towards goodwill, and hence the remaining 0.75 will ideally be attributable to other assets, that is A and B, in the ratio of their carrying values. Now if you blindly allocate it in the ratio of their carrying values only, in such a case what would happen is, it is possible that A's value can be taken below its individual recoverable value, and hence it is important that you find what is the recoverable value of A. The recoverable value of machinery A is its fair value less cost to sell or its value in use. So for its value in use, you will take the future cash flows including the 50,000 salvage value, discounted at the only rate available, which is 10%, and this if you calculate will come to around 4,89,000 and something. I don't remember the number exactly. It is 4,89,705. So this is just a mathematical calculation. 4,89,705. So the recoverable value of A is 4,89,705. So if we were to amortize, for example, the 2,25,000 impairment loss, we will say out of 2,25,000, 1,50,000 is attributable to goodwill, and to the other eligible assets there is 75,000. Out of the 75,000, if you allocate to machinery A and machinery B in the ratio of their carrying value, this is 5.25 upon, let us say, 8.75, and 75,000 into 3.5 upon 8.75. If you attribute, this comes to approximately 45,000, this comes to approximately 30,000. If I allocate this, then machinery A will become 5,25,000 minus 45, which comes to 4,80,000. Now, one of the principles mentioned that the individual value cannot fall below the individual recoverable value, and hence machinery A will not bear 45,000. It will bear a loss maximum in such a way that its final balance comes to 4,89,705, and hence 5,25,000 minus 4,89,705, and you will get 35,295 as the impairment that will be borne by machinery A, which means the remaining will be attributable to machinery B. So over here, out of this 39,705 will go to machinery B, and hence your carrying value of the CGU will be, nothing will go to inventory because it is not covered under this standard. It is 5,25,000 minus 35,295, which comes to 4,89,705. For machinery B, it is 3,50,000 minus 39,705. 3,50,000 minus 39,705 comes to around 3,10,295. Inventory continues to remain at 2 lakhs, goodwill is fully written off, and hence if you total up, this will come to 10 lakhs. So this is the most complex part of this question. The second part of the question merely requires you to find the depreciation for the next year. Remember, this is a cash generating unit where impairment under IND AS 36 is done, and hence depreciation can continue in the next year. If this was IND AS 105 question, there cannot be any further depreciation, but in case of IND AS 36, there can be depreciation. So over here, you will continue with further depreciation. You will record whatever is the depreciation based on the remaining useful life. So remaining 5 years, remaining for the first case, 7 years, remaining for machinery B. You will find the carrying value. Once you find the carrying value, you will take the total. So this is something, if you just refer the solution over here, this is your revised carrying values, carrying value of the CGU after considering the depreciation on 31st March 19. You compare it with the recoverable value, which is 11 lakhs, and hence there appears to be a reversal of impairment, assuming there is an improvement in service potential. If you assume there is an improvement in service potential, you have to do reversal of impairment. You have to tell the examiner that reversal of impairment on goodwill is not permitted. So on other assets A and B, can you reverse? Well, yes, you will have to find the carrying value of A and B had there been no impairment. Had there been no impairment, carrying value of A would have been 5,25,000 minus depreciation of 95,000. Had there been no impairment, for B would have been 3,50,000 minus 50,000 had there been no impairment. So you will try to find the carrying value ignoring impairment, which will be 4,30,000, which will be 3 lakhs. You will compare that with the recoverable value, which is 4,50,000 and 3,10,000, and you will say you can reverse up to whichever is lower, which is 4,30,000 and 3 lakhs. In your actual ledger, as you can see, we have 4,01,000 and 2,65,000. So we can find the amount to be reversed. So this is something that you should revise. I've just discussed the important principles. Are we clear with this? Yes? Okay. So this is about the really long question which had come in the recent exams as well. So, I mean, some students would predict that this will not come again, but remember, you don't do this trend analysis at this stage. Whatever comes in your way, read, understand, proceed. Read, understand, proceed. Don't do any trend analysis, does not help. It in financial instruments in I think June or July and January of 21, it had happened that the same question had come back-to-back attempts. So do not do that trend analysis, please. Achha, next you have question number 2. This is on the unallocable corporate assets part. So there are 3 cash generating units A, B and C, where you have the details as follows. So there are cash generating units A, B and C. It has two corporate assets, X which is allocable, Y which cannot be allocated. So Y is non-allocable, X is allocable. The recoverable value of the CGUs A, B and C are given and you are required to calculate impairment loss. Whenever there is an unallocable corporate asset, you will do a two-tier impairment testing. So you will first try to do impairment testing for the smaller CGUs, that is A, B and C, which includes the carrying value of the individual assets plus the allocable corporate asset. Now allocable corporate asset is 600. You will allocate it in what ratio? Since the useful life is available, you will take the product of the carrying value into the useful life. So this is 5,000, this is I think 15,000, this is I think 22,000. So this will be in the ratio of 5:15:22. Based on this, you will allocate 600 in the ratio of 5:15:22 and you will try to find the carrying value of these individual cash generating units. So over here you calculate the carrying value 571, 964 and 1415. This carrying value you will compare with the individual recoverable values which are given of 600, 900 and 1400. Once you do that, you will record impairment in CGU B and CGU C because A is not impaired. The carrying value of A is less than the recoverable value, no impairment. For B and C there is an impairment, you recognize it, allocate the impairment to the corporate asset X and the individual assets of B and individual assets of C and find the answer. Once that is done, we have still not tested corporate asset B for impairment, and hence what you will do is you will do impairment testing at a larger CGU where you will take the carrying value of the individual assets and also include corporate asset Y. Compare the total carrying value with the recoverable value. In this case, there is no impairment. However, if there was an impairment, the impairment will directly be adjusted against corporate asset Y only because the other assets are already at the lower of their carrying values or recoverable values. Acha. Next, we have question number 3, which is a recent RTP question, an important question which includes unallocable goodwill. So over here and partial goodwill as well. On 31st March, Vision acquired 80% of equity shares of Mission for 190 million. So this is PC of 190. The fair values of net assets that were included in the CFS of Vision on 31st March are 200 million. It is the group's policy to value NCI at its proportionate share of the fair value of the subsidiary's net assets. So if you want to calculate, this is PC, which is for 80% stake 190, NCI proportionate net assets over here are 200. So 200 into 20% will come to 40 and as a result 30 will be goodwill. This 30 will be partial goodwill to the extent of 80% share. On 31st March 2014, so this is 3 years later. On 31st March 2014, Vision carried out its annual review of goodwill and found evidence of impairment. No impairment was evident when the reviews were carried out on 31st March 12 and 13. So the goodwill will remain the same. There will be no change. The review involved allocating assets of Mission to the 3 CGUs and computing value in use. The carrying values before impairment are given below. So these are carrying values before impairment. So you have the total carrying values and to that you have value in use. You don't have the net selling price, in which case if I want to find the impairment, there will be no impairment in unit A. In unit B, 90 minus 66, I guess that comes to 24 of impairment, and in this case again no impairment. For the smaller CGU, so this 24 will first be allocated to goodwill. There is no goodwill because it is unallocable. You will read it ahead, and then it will be allocated to other assets, that is intangibles and PP. It was not possible to meaningfully allocate goodwill on consolidation to the individual units, but other assets are allocated as in the table. So goodwill is unallocable, as you must have read earlier as well. The intangible assets have no ascertainable market value, but all current assets have a market value at least equal to the carrying value, so they will not be impaired further. They are not even eligible. The value use of Mission Limited as a single CGU is 350 million. This is for the company as a whole. Discuss and compute the accounting treatment of impairment of goodwill as per IND AS 36. So what you will do is you will first have to do the smaller asset impairment testing, where unit A there will be no impairment, it will continue at 170. Unit B, there will be an impairment of 24, which will be allocated to intangibles and PP in the ratio of their carrying values, after which the total carrying value of the unit will be 66, and for unit C this is 100. So after doing all of this, you will find that the total carrying values will in the total carrying values over here will include just a second, क्या हो गया ये? I think there is some issue in my iPad. Just a second. That I'll just discuss this. Nevertheless, the total carrying values will include or for A and C, the total carrying values, if I'm not wrong, is 170, and for C it is 100. For B it is 66. So, अरे यार एक second रुक जाओ. So when we look at the total on your calculators, 170 plus 66 plus, let us say, 100, this comes to, let us say, 336. Apart from that, there is goodwill. Goodwill was at 30 rupees. Now this goodwill is, just a second, okay, so we'll just be back in a minute. So यहाँ पे you will take the individual carrying values, but what about goodwill? Goodwill of 30 rupees is partial goodwill. In order to show the goodwill, you will have to show the full goodwill, because the recoverable value of 350 which is given in the question is for the entire business, and hence we will do a cross multiplication. We will say that if your goodwill, which is to the extent of 80%, if 80% is equal to 30, then 100 is how much? So 30 is equivalent to 80%, and 100 is how much? It comes to 37.5, and hence 7.5 is the value of the unrecognized goodwill which is attributable to NCI. So you will take 37.5. So if you take the total carrying value, I hope you have the notes in front of you. Just give me a minute. My iPad will restart. We'll just resume from there. So this is 66 rupees for B, plus 170 for A, plus 100, that is 336, plus 37.5 for goodwill, and hence this comes to 373.5. So 373.5 compared with 350, and hence the difference between the two, that is 23.5. The 23.5 difference, finally we are here. So finally you will have, yes, 373.5 the carrying value, including the goodwill grossed up. Compare that with the recoverable value, which is 350, and hence the difference between the two, which is 23.5. The difference between the two, which is 23.5, will be taken as impairment. This impairment will first be attributable to goodwill. Out of this goodwill, of 37.5, 23.5 में से parent को you will attribute 80%, and to the NCI you will attribute 20%. So 23.5 into 80% comes to 18.8 will be recognized in the parent, whereas the remaining will be 4.7 which will be attributable to NCI. Now NCI share of goodwill to the extent of 7.5 was not recorded in the books, and hence its corresponding impairment will also not appear in the books. Parent share of goodwill, that was 30 rupees, was recorded, and out of this 18.8 will be subtracted. So when we recognize the impairment loss, your impairment loss will be to the extent of 18.8 which is recorded. 4.7 pertains to unrecognized goodwill, and hence it will not be recorded. Are we clear with this? Yes? Acha. After this we will go to IND AS 105. Under IND AS 105, Yes, you have this question where there is a company which is putting up a disposal group up for sale. On 1st June, the entity plans to sell a group of assets. Merely because it plans, the sale is not highly probable. On 31st July, the board of directors approves and becomes committed to a plan to sell. So this is where appropriate level of management is committed by entering into a firm purchase commitment with entity Y. So when I look at a firm purchase commitment, there is an identified buyer. However, since a manufacturing unit is regulated, approval from the regulator is needed for the sale. The approval from the regulator is customary and is highly probable. So because of this, you will say that this can be ignored. The delay due to regulatory approval can be ignored. This approval is received by 30th November and the sale is expected to be completed by 31st of March, which is within 12 months, and as a result, we don't have to postpone the recognition of asset as held for sale. We can recognize the disposal group as held for sale from 31st of July. Entity follows December year end and the assets and liabilities attributable are, so from 31st of July, it is classified as held for sale. The carrying value on 31st July is 2,600 and the fair value as on 31st December is 2,000, it is not relevant, and on 31st July is 1850, cost to sell is 100. So the fair value less cost to sell comes to, let us say, the difference between these two, it comes to 1850 minus 100, which comes to 1750, and hence the difference between the two, that is 850 will be the write-off. Out of this write-off, first you will allocate 500 against goodwill, and then the remaining 350 will be attributable between the eligible asset, that is plant and machinery and building, in their corresponding carrying values in the ratio of 900 is to 1850. The fair values on 31st December are lower than the carrying value of the disposal group. So if the fair values are actually lower, then there will be a further impairment which will be written off against plant and building only. There will be no further depreciation because these assets are classified as held for sale. Okay, another question over here involves a fairly detailed calculation which is on similar lines. So over here, following is the extract of the CFS of A Limited as on 31st March. It's an important question. यहाँ पे ये पूरा एक्सपेक्ट दिया हुआ है on 31st March. On 15 September, entity A decided to sell the business. It is noted that the business meets the condition of disposal group held for sale in accordance with IND AS 105. However, it does not meet the conditions to be classified as a discontinued operation. So it is a disposal group from 15 September but not a discontinued operation. The disposal group is stated at the following amounts immediately prior to the reclassification. So it is shown at total 2160. The proposed sale of the disposal group is at 19 lakhs and it is estimated that the cost to sell will be 70,000, which means 18 lakh 30,000 or 1830 in thousands will be the fair value less cost to sell. The cost consists of professional fee to be paid to external lawyers and accountants. So which means the difference between these two, that is 2160 minus 1830, that is equal to 330, will be taken as the impairment. Now this impairment will first be written off against goodwill, so this 200 will be fully written off, and hence the remaining 130 will be attributable between intangible assets and between property, plant and equipment in the ratio of their carrying value. So basically you will take the remaining 130 of impairment loss and allocate it in the ratio of 930 is to 1020, whatever those numbers come. As on 31st March 12, there has been no change in the plan to sell and the entity still expects to sell it within 1 year. Mr. X, an accountant, remeasure the following assets in accordance with the respective standards. So you have been given only the remaining assets. You have not been given goodwill over here, you have not been given PP over here, you have not been given intangibles. Are they still a part of your disposal group? Yes. However, the institute expects you to find those values. So you will calculate the values as on 15 September. Once you find that values, there will be no further depreciation and hence you can find the revised carrying values over here. The disposal group has not been trading well and the fair value less cost to sell has fallen to 16 lakh 50. What will be the value of the assets on 15 September and 31st March? 15 September we have found, these are the values. Goodwill, as you can see, becomes nil, intangible assets minus 62 and you have PP 952. Going forward on 31st March 12, goodwill still continues to be nil, Intangible assets still continue to be 868 and PP still continues to be 952. Considering that, we find 1710, compare it with 1650, find a loss of 60, and this 60 will be allocated between intangibles and PP in the ratio of their corresponding carrying values. Are we clear with this? Yes? Okay, so this kind of takes care of IND AS 105 as well. Next, we will finish the other asset linked standards so that we kind of wrap this up except for leases, that is IND AS 23, IND AS 41 as well as your IND AS 2. Quickly discussing this, when you look at IND AS 23, this is the standard on borrowing cost. Borrowing cost is standard is attributable to a qualifying asset. So if there is a qualifying asset which is an asset which necessarily or normally takes a substantial period of time to be ready for its intended use, the borrowing cost will be capitalized. What are borrowing costs? Interest using effective interest method, finance cost in case of a lease liability, as well as exchange differences in case of foreign currency borrowings to the extent they are considered as adjustment to the borrowing cost. In case you have taken a foreign currency loan, in such case, if you want to find the part of the exchange loss which is attributable to borrowing cost, there are 4 or 5 steps that you need to follow. First, you will calculate the actual interest to be paid in the foreign currency. So, the loan into the US dollar rate of interest into the rate on the date when the loan is paid. Compare that with the notional interest if the loan was taken in India. The difference between point 1 and point 2 is the interest saving, also called as interest adjustment. Compare the interest adjustment with the foreign exchange loss. Select whichever is lower, that is the adjustment to borrowing cost. Excess, if any, is positive, which will be taken as foreign exchange loss. Okay, next we are going into commencement date. So the relevant dates over here will include commencement date, that is the later of the date when the loan is taken, date when expenditure is incurred, or the date when activities are undertaken. Later of this is the commencement date. Cessation date is a date when all the activities necessary to get the asset in the ready to use condition are completed. And suspension, when will you suspend the capitalization? Suspension of capitalization happens if active development is interrupted due to factors which are abnormal, that is beyond the entity's control, and for an extended period of time. Then the last parts of the standard or the major parts of the standard include capitalization of borrowing costs in case of specific borrowings, where you take the actual borrowing cost from the commencement date minus income on temporary investment of surplus funds. And in case of general borrowings, you calculate the weighted average borrowing rate of the general borrowings, apply the weighted average borrowing rate to expenditure incurred out of the general borrowings for the period for which it is outstanding, compare it with the actual borrowing cost and select whichever is lower. Expenditure incurred on qualifying asset can be calculated as the cash spent or assets transferred plus interest already capitalized minus progress payments or government grants which have been received. In case of a specific asset, where there is borrowing cost capitalization using specific as well as general borrowing, you will first finish off specific borrowings, and then for the remaining expenditure you will apply using the weighted average borrowing rate. Achha. Next, so this is the broad principles. Next you have biological assets, IND AS 41 on agriculture. So when you look at IND AS 41 on biological assets, under IND AS 41 what all gets covered? Just a second. So under IND AS 41 what all gets covered? Under the scope of IND AS 41, this is a very quick discussion. You will include biological assets other than bearer plants if they are used for agricultural activities. Second, you will have agriculture produce only at the point of harvest, and third, you will have government grants which are linked to biological assets. What is agricultural activity? Agricultural activity would refer to activity which involves biological assets which are held for sale or for the purpose of additional biological assets, that is breeding, or biological assets which are held for converting into agricultural produce. If you are managing biological transformation for these assets as well as managing harvest, that is when you will be covered under IND AS 41. If you are merely doing harvest, you will directly be under IND AS 2, maybe inventory, you will not be covered under IND AS 41. The accounting for biological assets will be initial as well as subsequent recognition happens at fair value less cost to sell. So if initially your there's an asset reproduced and you have not paid anything, then there will be a gain or loss on initial recognition. At every subsequent balance sheet date, if the fair value changes, in which case the difference will be taken to the profit and loss account, the biological asset is not depreciated. In case fair value is not determinable, then in such rare cases, you will depreciate the asset and show that at cost. In the P&L or in the notes, you will have to show a bifurcation between price and the changes due to age, changes due to price. In case of agricultural produce, you will recognize the agricultural produce at the point of harvest at the fair value less cost to sell. Once it is harvested, it becomes inventory. This is the deemed initial cost for inventory, and at every subsequent recognition in the balance sheet date, you will compare the cost with the fair value less cost to sell for the purpose of this standard. In case there are government grants for biological assets, IND AS 20 will not apply. In fact, under this standard, you will see if there are unconditional grants, in which case you will take the grant directly to the profit and loss account. If it is conditional, you will record it as and when conditions are fulfilled. For grants for other items, IND AS 20 will apply. So this is about IND AS 41, a quick discussion, and then there is IND AS 2, which is on inventory. Inventory, nothing much over here. You include inventory. Inventories will include raw materials, finished goods, stock in trade, work in progress, etc. Initial recognition of inventory happens at cost. While calculating cost, you have to be careful that you do not include storage costs unless it is necessary to get the asset in the ready to use condition or ready to sell condition. You do not include abnormal loss. You do not include administrative or selling expenses. If there is a normal loss, the cost per unit is calculated as the total cost divided by normal units. In case there is an abnormal loss has to go to the P&L. However, in rare cases when there is an abnormal gain, you will calculate the cost per unit as the total cost divided by the normal units or actual units, whichever is greater. An important discussion over here includes absorption rate. In case you have to find the cost per unit for the purpose of absorption, you will take the total fixed overheads, production overheads divided by the normal units or actual units, whichever is higher, in order to determine the absorption rate. In case of joint products and byproducts, you will calculate the net joint cost after subtracting the NRV of the byproducts and allocate the net joint cost in the ratio of the sales value at split off point. This allocated joint cost will be used for the purpose of inventory calculation. In case of cost flow assumptions, we will remember that you can generally follow FIFO or weighted average. LIFO is not permitted. In certain special cases, standard cost as well as retail sales price method is also permitted. Inventory valuation happens for finished goods and work in progress at cost or NRV, whichever is lower. NRV is calculated as the estimated selling price minus estimated selling expenses minus estimated cost to complete. In case of raw materials, you usually calculate the value of the inventory at cost only for raw materials because you don't hold them for sale. However, in case the finished goods in which the raw materials are going to be used are expected to sell below cost, in such cases only you will compare the cost of the raw material with the replacement cost, select whichever is lower and then do the workings. In case of NRV, if there is a subsequent reassessment of NRV, you will have to compare the cost and the NRV, not the carrying value. So if it is 100 and the NRV is 80, you record a loss of 20. Subsequently, if the NRV goes up to 95, you will compare the cost with the NRV, that is 95, and measure the inventory at 95. So there will be a reversal of write-off to the extent of 15 rupees. Okay, so this covers these three standards. So let us go to these topics. So let's first go to IND AS 41. It is end of the closest from here. So we'll do IND AS 41. A very important question over here on IND AS 41. This has come again multiple times. So this is important. So this is a case where you are doing the accounting for biological assets. Moon prepares financial statements on 31st March. On 1st April, the company has the following. It has land of 50 lakhs. Land is covered under IND AS 16. And IND AS 16, if nothing is given, you will record using the cost model. So land continues at 50 lakhs, no depreciation, no revaluation. Purchase 200 dairy cows. Average age on 1st April of 2 years for 10 lakhs, which means 10 lakhs divided by 200 cows, that is approximately 500 per cow or 5,000, let us say, per cow. Received a grant of 1 million towards acquisition of cows. This is a grant for acquisition of cows. This grant is non-refundable. So if it is a grant for cows, IND AS 41 will apply, and as a result, if it is an unconditional grant, it will be taken directly to the P&L account. For the year ending 31st March 12, company has incurred the following costs. 6 lakhs to maintain goes to P&L. 4 lakhs for breeding will also go to the P&L. On 1st October, 100 calves were born. There are no other changes in the number of animals. So when the calves are born, your entry will be calves account debit to gain on initial recognition. This is on 1st October when the value was 1200 rupees. So 1,20,000 will be recorded as initial recognition for the calves and 1,20,000 will go to the P&L. As on 31st March 12, Moon had 3000 liters of unsold milk in inventory. The milk was sold shortly after at year-end prices, and hence this milk will be recorded as closing stock and the corresponding effect will also be given in the P&L. So milk will be a part of the current assets, 3000 at 24. So 3000 into 24, 72,000 will be the value at which milk will be recorded as current assets inventory with the corresponding credit in the P&L. Achha, there are a lot of other items which are there in the balance sheet. So for the 2-year cows on 1st April 11, they will now be 3-year-old cows, and hence they will appear at 5,500. 5,500 into 200 will come to, I guess, 11 lakhs. 5,500 into 1100 comes to 11 lakhs, and this, just a second, 5,500 into, let us say, 200 comes to 11 lakhs, and this 11 lakhs will appear in the balance sheet. Along with that, you will try to show the difference due to age and difference due to price separately. So the difference between 5,000 and 5,200 is due to price, whereas the difference between 5,200 and 5,500, that is 300, is due to age. Similarly, for newborn calves, you had recorded the newborn calves as 1,200, but at the end of the year, they will come at, sorry, it is not 1,200, it was 1,100. This is newborn calves. This will be shown as 1,100, 1,10,000. By the end of the year, this will become 1,300, and hence there will be a change due to price. There will also be a change due to age. You will have to show these bifurcations separately. Based on this, you will prepare the extract where you will show the government grant income of 10 lakhs, fair value gain on the calves, fair value gain on the cows, and milk. This will be shown as income. Within expenses, breeding fee as well as maintenance expenses will be shown on the balance sheet. PP land will be shown, assuming it is following cost model, at 50 lakhs. Then biological assets other than bearer plants, you will show dairy cows and you will show calves, and within current assets, within the inventory section, you will show milk. So this is how you will recognize the entire data set that is available. Achha. Next is this question number 2, where it's a slightly contentious question. We'll quickly discuss this. X purchase 100 beef cattle. Beef cattle is cattle which you are purchasing with the intention of, let us say, slaughtering or for the purpose of selling, and hence this cattle is held for the purpose of sale. So when this cattle is sold actually or slaughtered, you can recognize sales and a corresponding COGS. At an auction for 1 lakh on 30th September, subsequent transportation costs are 1,000. That is similar to the cost that would have been incurred to sell the cattle at the auction. So 1,000 is a cost to purchase. 1,000 will also have to be incurred at the time of selling. Additionally, there would be a 2% selling fee on the market price of the cattle to be incurred by the seller. Initial recognition happens at fair value less cost to sell. So that is 1 lakh rupees minus 1,000 incurred at the time of selling minus 2% of 1 lakh, that is 2,000 auctioneer's fee, and hence 97,000 will be recorded. So your entry will be cattle account debit 97,000 to bank 1 lakh plus 1,000 cost to transport the cattle to the warehouse, 1 lakh 1,000, and hence 4,000 balancing figure will be the loss on initial recognition. Second, on 31st March, the market value of the cattle in the most relevant market increases to 1,10,000. The transportation cost of 1,000 would have to be incurred by the seller to get the cattle to the relevant market. An auctioneer's fee of 2% of the market price of the cattle will be payable by the seller. Again, you will do the working as 1,10,000 minus 1,000, fair value less cost to sell, minus 2,200, and hence 1,06,800 will be the fair value less cost to sell for this cattle. On 1st of June, X sold 18 cattle for 20,000. Because this cattle is held for sale, even though it is a biological asset, ideally we will show this as sales. So 20,000 will be shown as sales. Incurred transportation charges of 150. So this 150 will be shown separately as an expense in the P&L account. And in addition, there was a 2% auctioneer's fee on the market price of the cattle paid by the seller. So that is 2% of 20,000, that is 400 rupees, will be shown separately in the P&L. So over here, if I were to prepare the corresponding profit and loss impact, so over here there will be sales which will be coming as 20,000. When inventory is sold, you will recognize the sales separately and the cost separately. When fixed assets are sold, you can directly recognize the gain on sale. So for inventory, the transportation cost is 150, auctioneer fee is 400, and apart from that there will be COGS. So there is certain cattle, this is 1,06,800, which was the cost for 100 cattle, out of which 18 cattle is sold. So this is 1068 into 18 comes to 19,224. Another way to do this would be to remeasure 19,224 to the fair value and then recognize the corresponding gain as well. So here if you go to see, there is a net gain on this transaction of 20,000 minus 150 minus 400 minus 19,224, which comes to 226. This 226 can also be separately recognized as gain on remeasurement or a direct gain, though Institute has shown this as sales separately and the cost to be shown separately, considering this is beef cattle or goat as the case may be. On 15 September, the fair value of the remaining cattle was 82,820. It does not matter because you are remeasuring every half yearly as given in the question at the end. 42 cattle were slaughtered on that date and the total slaughter cost was 4,200. This is cost which is already incurred. It is not a cost which is yet to be incurred. So it is not treated as a cost to sell. This is a cost which has already been incurred. The total market price of the carcasses, that is the dead bodies, on that date was 48,300 and the expected transportation cost to sell the carcasses is 420. No other costs are expected. Okay, sorry. No other costs are expected. So over here, this is to be again shown as a sale. There is no sale, sorry, there is a slaughter, so you will have to create an inventory. The inventory will be created as fair value less cost to sell at the point of harvest. So the fair value of the inventory, that is a produce, that is carcass, is 48,300 and the cost to sell further is 420, and hence 48,300 minus 420 comes to 47,880 will be the inventory. Correspondingly, the biological asset, that is a cattle, 42 cattle. So over here you can show inventory. You can bring in inventory in your books, that is a carcass. You will remove the biological asset. The biological asset will be 1068 per cattle into 42 cattle. 1,06,800 divided by 100, so that is 1068 into 42 cattle comes to 44,856. Along with that, to make the inventory, I had to incur a slaughter cost of 4,200, and hence whatever is a balancing figure over here will be shown as a gain or loss as the case may be on initial recognition. Since we have been not given any further information about this inventory, we assume this is unsold and it will appear on 30th September at 47,880. On 30th September, the market price of the remaining 40 cattle was 44,800. So you will have to remeasure, and the expected transportation cost is 400, and there will be a 2% auctioneer fee on the price of the cattle. So that is 44,800 minus 400 minus 2% of 44,800 comes to, let us say, 896. Whatever this value is, you will compare it with the existing ledger balance and the gain or loss will be recorded. Past journal entries so as to provide initial and subsequent measurement of all the above transactions. Interim periods are 30th September and 31st March, and company fair values on these dates. Because the question tells you that the company fair values on these dates only, you have not done remeasurement on 1st June or on 15th of September. So this takes care of question number or questions on IND AS 41. Next you go to questions on IND AS 23. So this is on borrowing cost. There are two questions over here. One is on this foreign currency angle and second is on general borrowings. We'll quickly discuss that. ABC has taken a loan of $20,000. We are on page number 31. Acha, you can focus on the screen. ABC has taken a loan of $20,000 on 1st April for the construction of a plant at an interest rate of 5% per annum on an annual basis. On 1st April, the exchange rate between the currencies is 45 per dollar and the exchange rate at the end is 48 per dollar. So these are the different rates. The corresponding amount could have been borrowed by ABC from SBI at the rate of 11%. Compute the borrowing cost to be capitalized for ABC. So the first step is to calculate interest. Interest will be $20,000 of loan into 5%, which is the rate of interest. So this is $1,000 into rupees 45 per dollar, and as a result this will be, I think, this is at the rate 48. because at the end of the year interest is paid. So this is 48,000. Now if this loan was taken in India, this would have been $20,000. When this loan was taken, the rate was 45, and hence this would be a 9 lakh rupee loan into 11% rate, and hence this would have been 99,000. And hence the interest adjustment over here is a difference between these two, which is I guess 51,000. This is your interest adjustment. Compare this with the foreign currency loss. Your foreign currency loss is $20,000 into rupees 3 per dollar, that is a difference of 48 and 45, and hence this comes to 60,000. So foreign exchange loss, to the extent it is considered as an adjustment to interest cost, so the lower of the two. So if I want to figure out the borrowing cost, it will be 60,000, that is a foreign exchange loss, or the interest adjustment, that is 51,000, whichever is lower, and hence this is 51,000. And hence if I want to find the additional foreign exchange loss out of 60,000, we can say 51,000 is borrowing cost, and hence 9,000 is forex loss. So the question asks you to calculate the borrowing cost to be capitalized. We will say 48,000 of actual interest paid plus 51,000, and hence 99,000 is the borrowing cost that we will need to capitalize in this particular case. Okay. Next you will have question number 2, which is on the general and specific borrowings. Here there is an entity A who has contracted for construction of building for 22 lakhs. In thousands, that is 2,200 in thousands. The building was completed at the end of March, and during this period payments were made to the contractor as follows. So there are various payments over here which comes to 2,200. A's borrowings at the end on 31st March were as follows: a 10% borrowing with simple interest which relates specifically to the project. So this is like a specific borrowing. Debt outstanding on 31st March amounted to 7 lakhs. Interest on 65,000 was incurred on these borrowings, and interest income of 20,000 was earned. Remember, if it is specific borrowings, actual borrowing cost will be capitalized, which is 65,000 minus income on temporary investment of surplus funds, which is 20,000, and hence 45,000 net borrowing cost will be capitalized. Next, there is 12.5% 10-year note with simple interest. Debt outstanding amounted to 10 lakhs, which remains unchanged. 10% with simple interest. Debt outstanding on 1st April amounting to 15 lakhs, which remains unchanged. So for specific borrowings, we will capitalize 45,000. For the general borrowings, we will have to calculate the weighted average borrowing rate. The WABR, or weighted average borrowing rate, will be calculated as, for example, the interest, that is 12.5% of 10 lakhs, that comes to I guess 1,25,000, plus 10% of 15 lakhs, which comes to 1,50,000 upon a 10 lakh borrowing plus 15 lakh borrowing, and as a result we will have 2,75,000 divided by 25 lakhs, and hence this comes to what we say is, I think, 11%. So this is your average borrowing, 275 upon 25, this is 11%, and hence you will apply this 11% to expenditures incurred out of general borrowings. So the first remember your specific borrowings is 7 lakhs. So we will assume that the first expenditure of 200 is out of the specific borrowing only, and as a result nothing is coming out of general borrowing. The second expenditure of 600, well, out of the 700 borrowing, 200 has already been utilized, and hence the remaining 500 will be utilized on 30th June. So out of the second borrowing, 11%, but this is utilized only for 9 months into 9 by 12. Subsequently, everything is coming out of general borrowing only because specific borrowing has been fully utilized. So if expenditure is incurred on 31st December, it is outstanding for 3 months. If it is incurred on the very last day, outstanding for 0 months, and hence you will have 100 into 11% into 9 by 12 comes to 8.25. This is 1200 into 11% into 3 by 12 comes to, I guess, 33, 0 over here, and hence 41.25. 41.25 will be taken as the borrowing cost to be capitalized out of general borrowings. So this takes care of question 2 for general borrowings, borrowing cost. Next you have IND AS 2. We have taken a question on IND AS 2 which covers the impact of calculation of cost of inventory, absorption costing, also raw material cost, everything covered over here. So we go to question number 1 on page number 3 for inventory. Okay, so over here, if you look at inventory, you have opening inventory of finished goods of 1000, raw material is 1100, 25,000 rupees for finished goods, 11,000 for raw material. That comes to cost per unit. If I want to find the cost per unit of raw material, that comes to 10 per unit for raw materials. Then purchases. For a manufacturer, the purchases will be raw materials, 10,000 units purchased at the rate 1 lakh, and hence the cost per unit of materials purchased is also 10. Labor, overheads. Overheads are fixed. This is 75,000 of fixed overheads. Okay. Sales, and then there is closing inventory, raw materials and finished goods. Acha, the expected production for the year was 15,000 kgs. This was the expected production. Acha, but what was the actual production? Well, we don't know. The sales are 10,000 units. The opening finished goods were 1,000 units and the closing finished goods are 1,200 units. So, if I want to find the units produced during the year, you can say COGS or cost or units sold, basically, like the COGS formula. Units sold, which is 10,000, will equal to the units purchased, the units at the start, that is 1,000 finished goods, plus the finished goods produced during the year, minus the closing finished goods, which is 1,200. So, if I do this working, we will get that the finished goods produced during the year is 10,200. Similarly, if I want, so this is FG, finished goods produced. Similarly, if I want to find the raw materials consumed, this is opening raw materials plus the raw materials purchased minus the closing raw materials. So, I know that the opening raw materials is 1100. If I highlight this in blue, is 1100, purchases are 10,000 and closing is 900, which means we are getting raw materials consumed as 1100 plus 10,000 materials purchased minus 900, and as a result this comes to, again, if we go to see, this will come to 10,200. So basically raw materials consumed during the year are also 10,200, finished goods produced during the year are also 10,200. This is one thing which students kind of miss over here. Due to fall in the market demand, the sales price of the finished goods was 20 per kg and the replacement cost of the raw material was 9.5 per kg. You are required to calculate the closing inventory as on that date. So, if you had to calculate the closing stock of finished goods as well as raw materials, you will have to find the cost per unit and compare it with NRV. So, when you calculate the raw material cost within finished goods on a per unit basis and then on a total basis, on a per unit basis, cost per unit is 10. We saw that opening material is also 10. Material purchased during the year, that is also 10. Total, when we say, these are 10,200 units. For every unit, 10 rupee was spent and hence 1,02,000, which is your raw material cost. Add to that labor. Labor over here was 76,500. 76,500. Labor is variable. So, if I want to calculate per unit 76,500 divided by 10,200, this will come to 76,500 divided by 10,200 comes to 7.5. Now, problem comes in fixed overheads. Now, fixed overheads as such are 75,000. However, we have to take the absorption rate, and absorption rate is based on the normal units or actual units, whichever is higher. Normal unit is 15,000 and hence your absorption rate is based on the normal, that is 5. Your actual units are 10,200 and hence 10,200 into 5 and hence only 51,000 is absorbed. The remaining 24,000 will be unabsorbed and will be taken to the profit and loss. So, if I find the total cost, this will probably be 22.5 per unit, and if I total up 1,02,76,500 and 51, this will be 2,29,500. This is the total cost for finished goods. I will compare for the finished goods. I will compare the cost with the NRV. Cost is per unit 22.5. NRV, if we see, is 20 per kg, and cost or NRV, whichever is lower, that is NRV, and hence the finished goods will be valued at 20 into कितने units है finished goods के अंदर closing में? This is 1,200 units. So, this is 1,200 into 20 and hence 24,000. will be the closing stock of finished goods. Acha, for raw material, typically you measure it at cost only. Cost is 10 per unit. However, in case the cost of the finished goods is greater than the NRV of the finished goods, then raw material is measured at cost or replacement cost, whichever is lower. And hence, for raw material, you will look at the cost, which is 10, compared with the replacement cost, which is 9.5. हम ये usually compare नहीं करते थे. We are comparing it here because the cost of the finished goods is greater than the NRV, and hence you will compare the two, select whichever is lower, that is 9.5. So raw material will also be measured at 9.5. So over here, this is 900 into 9.5. 900 into 9.5 will come to 8550. So the question asks you that what will be appearing as a closing inventory. Well, the total bit of these two, 24,000 and 8550, this will be 32,550. 32,550 will be appearing as a part of your closing inventory. Acha, IND AS 23 RTP question, I've uploaded an RTP video for May 2023. Within that, you can just refer the RTP question for IND AS 23 that is discussed at a lot of length for you to get a clear understanding. Okay. Okay. So that is about IND AS 2, and this kind of takes care of the asset link standards. All of the asset link standards, keeping aside leases, all of them get done. Achha, after that we go to the standards which are linked to liabilities. So we will finish off provisions and contingencies, we will do income taxes, and we will do employee benefits. These are standards which are linked to liabilities. So first we will go to IND AS 37. This is the general standard when it comes to liabilities. IND AS 37. Provisions and contingencies. As per IND AS 37, standard says you will have to create a provision for both legal as well as constructive obligations. Legal obligations arise out of law or a contract. Constructive obligations arise out of past practices or published policies where there is an expectation in the minds of the affected parties, like a Diwali bonus, for example. Achha, how do you account for contingencies? If there is a contingent liability which you think it is probable, you will create a provision. If it is uncertain, you will give a disclosure. If it is remote, you will ignore. If it is a contingent asset, you take a step back, and if it is probable, you will merely give a disclosure. If it is uncertain, you will ignore. So when will you recognize a contingent asset? Only when it is virtually certain. Virtual certainty, remember, arises out of facts and not out of expectations, and hence virtual certainty is only when there is factual confirmation that the asset will be realized, in which case you will recognize. These cases are interesting when there is, let us say, an event which happens during the post balance sheet period, like settlement of a lawsuit in the post balance sheet period, gives you additional information of a provision to be created in case of a contingent liability, or a disclosure to be given in case of a contingent asset. Remember, you will recognize a receivable only once there is virtual certainty, which is in the next year. In case of reimbursement, you will recognize the reimbursement right, that is a receivable, if there is virtual certainty that the reimbursement will be done. Acha. Next, when we look at measurement of provision, the measurement of provision is to be done on a best estimate basis and on a present value basis. So if the effect of time is material, then you will do the measurement using the present value basis, and effect of time is material if the time gap is more than 12 months. Usually you will always measure the provision unless it is the data for measurement is not available, in which case you will give a disclosure. Two special cases which are there in this standard. One involves onerous contract or burdensome contract, where the unavoidable cost of fulfilling or cancelling the contract is greater than the benefits arising out of this contract, in which case you will create a provision for losses on the onerous contract immediately. While creating the provision for these losses, you will look at the net cost of fulfilling the contract or the penalty on exiting the contract, select whichever is lower, and create a provision. You have to distinguish the losses on onerous contract from something like future operating losses. The future operating losses which are arising on other than onerous contract, you need to kind of ignore them. You will record those future operating losses as and when they happen. When we look at provision for restructuring, restructuring refers to closure in general. If there is a provision for restructuring, standard gives you guidance on timing, that is when should you restructure. If there is a legal obligation, when the obligation to restructure arises. If there is a constructive obligation, when there is a detailed formal plan in place and that formal plan starts to be implemented or the plan is communicated. That is when you will create a provision for restructuring. While creating a provision, you will include the direct expenses like legal cost, bankers fees, etc., termination expenses. You will not include relocation expenses because they are linked to continuance and not linked to closure, future operating losses, or expenses incurred to set up new systems at another location. This will not be included. Next, you go to IND AS 19, which is employee benefits. Now, this is again a slightly complex standard. Employee benefits cover all benefits except for share-based payment, which are actually covered under IND AS 102. Every other benefit is covered under employee benefits. We are classifying employee benefits into 4 categories. First, short-term benefits, which are benefits which are within 12 months to be recorded on an undiscounted basis. Second is post-employment benefits, which are sub-segregated into defined contribution and defined benefit plans. Post-employment benefits are benefits like gratuity or pension, which are payable at or after retirement. Then there are termination benefits like VRS or retrenchment, which are payable at the time of voluntary or a forced termination, and everything else is other long-term benefits. In case of short-term benefits, salaries, bonus, etc. should be recorded as and when the obligation arises, whereas in case of short-term compensated absences like paid leaves, in case they are they can be accumulated, that is carried forward, then you can record it. You can record a provision to the extent of leaves that you are expecting to be utilized. However, if these are vested benefits, that is, you can encash them, then you can create a provision for the entire amount and not just to the extent of leaves that can be which are expected to be utilized. In case of post-employment plans, there is defined contribution plan where the risk of investment or liability changes is on the employee, not with the employer. The measurement of such plan is very easy. You will record the expenses to the extent of contribution. Beyond that, nothing is to be recorded as an expense. Whereas when you look at the defined benefit plan, the risk remains with the employer, in which case you use the projected unit credit method to measure the liability. The accounting for this is complex and actuarial valuation is recommended. A few key terms for defined liability measurement include: you have current service cost. What do you mean by current service cost? Current service cost refers to the increase in liability due to current period service. Then you have interest cost. Interest cost is opening liability coming one more year closer. Past service cost is due to services in the past which are now eligible to higher benefits due to plan amendment. Let's say earlier you were agreeing to pay 1% of the last drawn salary, now you are paying 2% of the last drawn salary. That is past service cost. Actuarial gains or losses. If an actuary changes his assumptions, that is actuarial gains or losses. And you have curtailment, which is reduction in employee benefits which have been agreed. So over here there is a detailed example which you can see. There are plan assets as well. We will look at the ultimate disclosure. Okay, so this table over here that is there is a fairly important table. As a chartered accountant, your job is less of a liability measurement, more of a presentation. So why should the liability change? If there's an opening liability which is determined by the actuary will increase due to current service cost, will increase due to interest cost. Where will the second effect of current service cost and interest cost go? Well, your opening liability will increase due to current service cost as well as interest cost. The second effect of this will both go to the profit and loss. So when I'm calculating profit and loss, current service cost as well as interest cost on the liability will be taken to the P&L. Apart from that, why should the liability change? Well, liability can change if there is a plan amendment and due to that amendment you have to pay more. So there will be past service cost due to which there can be a potential increase. There can be a reduction in liability if you have decided to curtail or reduce the benefits. So if there's a curtailment, you have decided to reduce the benefits. So a curtailment will reduce the liability. Second effect again goes into the P&L. Now, if benefits are actually paid, that will also reduce the liability, and after all of this, you will get your closing liability as per an actuarial valuation. Now, sometimes this closing number does not tally. If it does not tally, it is because actuary has used different assumptions in the opening and closing, and hence this balancing figure is called as changes in actuarial assumptions, which is actually taken into the other comprehensive income, called as a remeasurement reserve, taken as a part of other comprehensive income. So you will calculate actuarial gains or losses as a balancing figure in your in your liability. Now, what are plan assets? Plan assets are actually earmarked investments or insurance policies which are used for the purpose of meeting these liabilities. So over here, why should these plan assets, how do you record them? Well, you show them at fair value. Why should these plan assets increase? Well, due to return. So they will increase due to expected return, and you need to remember that the discount rate for liability is the same as the expected return on the plan assets. So plus interest. The second effect of this interest will be shown as a reduction from the expenses. It will not be shown as an income, it will be shown as a reduction from expenses, so that you can show the net interest. It is because in the balance sheet you show the plan liabilities minus plan assets net. In a similar way, in your income statement you will show the income on the plan assets as a reduction from expenses. Apart from that, plan assets will increase if the company contributes. It will reduce if certain benefits are paid, and hence plan assets had to be sold. Now, even after all of this, the closing fair value might not necessarily tally, and here the difference is attributable to changes in return on the plan assets which go into the other comprehensive income. This is the second item which goes into the other comprehensive income. The difference between the actual return on the plan assets and expected return is called as the changes in return on plan assets, which goes into the other comprehensive income. Now, after all of this is taken care of, in the balance sheet you will present the net amount, net deficit or surplus. So you will take the plan liabilities at the end of the year minus plan assets at the end of the year. If liabilities are greater, let's say 1000 is the liability, 800 is the asset, the difference of 200 is the deficit, and that will be the amount appearing in the balance sheet. However, if the plan liabilities are less, let's say plan liabilities are 600 and the plan assets are 800, in which case 200 is the surplus, and that surplus ideally will appear in the balance sheet unless there is an asset ceiling. Asset ceiling is a restriction on withdrawal by the company. Let's say if the asset ceiling is 50 rupees and the net surplus is 200, then you will restrict the net amount to be shown in the balance sheet to 50, and 150 will be shown as the changes in the plan assets due to the effect of asset ceiling. So the changes due to the effects of asset ceiling will appear over here. This will happen only and only if there is a surplus and there is an asset ceiling which is defined in the employee agreement, otherwise ye nahi aata. Now, this presentation in my opinion is very important in this standard. Apart from that, there is certain discussion on attribution of current service cost. So current service cost attribution starts from the point a year of service contributes to an additional unit of benefit and continues till the time a year of service keeps on contributing to generating an additional benefit. If different years give different benefits, then if a materially higher level of benefit is attributed to the later years, then you use straight line, otherwise you will use pro rata workings. For other long-term benefits as well as termination benefits, other long-term benefits working is exactly the same as the post-employment benefits, except that there is no other comprehensive income, even if there is actual gains or losses, even if there is changes in return or asset ceiling, everything will go in the profit and loss account. In case of termination benefits, you will try to find out the actual amount which is purely linked to termination, and you create a provision the moment the obligation to terminate arises. So this is regarding termination benefits. Okay, so that kind of broadly covers IND AS 19, and then going into the all important tier 1 category, IND AS 12. This is on income taxes. Now there are various ways in which you can address this. We will do it based on the method that we have tried to cover. So in income taxes, there is a current tax which refers to the tax which is payable as per the Income Tax Act. Then there is deferred tax which arises due to temporary differences. Differences can be temporary or other than temporary. Temporary differences are the differences between carrying value, which is a value as per IND AS of an asset or a liability, and the tax base, which is the value of the asset or liability as per income tax records. If there is a difference, ideally if the accounting is done in the same way as tax, there will be no difference. But if there is a difference, we will assume that the difference is temporary unless otherwise given. We will have to see that due to this difference, will we have to pay a higher tax in the future years? That is a taxable temporary difference which is creating deferred tax liability, or will we get a deduction in tax in the future years, in which case it is a deductible temporary difference which creates a deferred tax asset. If the difference is other than temporary, in which case no deferred tax is to be created, income tax expense is the total of current tax plus or minus deferred tax. So where will the current tax or deferred tax be recorded? If the underlying items on which current tax or deferred tax is calculated, like sales, purchase, etc., is going to the P&L, then the corresponding current as well as deferred tax will go to the P&L. On the other hand, if the underlying items like fair value reserve as a part of other comprehensive income is going in the OCI, then the current or deferred tax on these will also go into the OCI. If the underlying item like a dividend and the corresponding dividend distribution tax, if the underlying item is going directly into the reserves, then the tax amount will also be taken directly into the reserves. The identification of deferred tax liability or asset is one of the most tricky and the important parts of this standard. The steps that we typically follow in case of a standard deferred tax question is, you first figure out what is the underlying item, like PP, which is an underlying asset, or unamortized preliminary expenses, an underlying asset, or loan, a financial liability, an underlying liability. You figure out what is the underlying asset or underlying liability. Step number 1, apply all IND AS and find the carrying value. Step number 2, calculate the tax base. Tax base over here will be based on the tax laws. You don't have to remember the tax laws. Question will generally give you guidance, and based on that, try to find the amount of that particular item appearing as per the tax balance sheet. Take the difference in step 3 between the carrying value and tax base. Now, whether this is a deferred tax asset or liability, obviously you can apply the conceptual base and try to find. However, from a general rule perspective, how will you calculate? Well, if it is an underlying asset or an underlying liability, if the carrying value is greater than the tax base, the answer is always opposite. So, if your carrying value is greater than the tax base, whether it is an asset or a liability, the answer is opposite. So, an underlying asset like PP, if there is an asset and the carrying value of PP is greater than the tax base, this will create a deferred tax liability. If there is an underlying liability like interest payable, for example, and the carrying value is greater than tax base, the answer is opposite, it creates a deferred tax asset. However, if the carrying value is lower than the tax base, in which case the answer is in the same direction. So, an asset will create a deferred tax asset, a liability will create a deferred tax liability. So, over here, if there is a PP whose carrying value is lower than the tax base, then there will be a deferred tax asset. Or if there is a loan whose carrying value is lower than the tax base, it will create a deferred tax liability. If the carrying value is equal to the tax base, then there will be no deferred tax impact. At what rate should you create deferred tax? Well, current tax will be based on the prevailing tax rate, whereas deferred tax should be based on the rate which has been enacted or substantively enacted till the balance sheet date. If tax rates change, then you will remeasure the deferred tax asset or deferred tax liability based on the revised tax rates. Exception on creating deferred tax asset: usually you will create deferred tax asset unless you believe that the entity does not have sufficient benefits against which it can utilize a deferred tax asset. For example, over here, if the entity should have sufficient taxable temporary differences whose reversal pattern matches the reversal pattern of deductible temporary differences, or it should have sufficient profits against which it can utilize these, let's say, carry forward losses, or it should have some tax planning strategy which it can use in order to offset these deductions or carry forward losses. The maximum deferred tax asset that you can create is the total of these items. Beyond that, even if there are deductible temporary differences, you cannot create a deferred tax asset. For deferred tax liability, usually there are no such restrictions. These benefits have to be checked in case of deferred tax assets. A special case of deferred tax involves deferred taxes along with business combination, where the same principles apply. At the stage of business combination, you will compare the fair value of the net assets taken over, that is as per IND AS, with the tax base. In case no tax base is given, then the old carrying values will be taken as a base for the purpose of deferred tax. The difference between the two into the tax rate will give you the deferred tax asset or liability as a case. Maybe the tax rate to be used over here will be the tax rate which is applicable in the subsidiary's jurisdiction. You will calculate deferred tax on all items unless otherwise given that they are not tax deductible or they are not taxable. You will calculate deferred tax on all items except for goodwill, where an exception is given. You do not need to calculate any deferred tax liability on goodwill. At the stage of taking over a business, if there are carry forward losses, you will again try to reassess and see whether, if you believe that the acquirer will be able to utilize those losses. If yes, you create a deferred tax asset for those carry forward losses. If no, you will not create a deferred tax asset even for those losses. A couple of exceptions which are given to the DTL. In case the reversal of deferred tax is within the entity's control, Like for example, if there's a parent and there is a subsidiary, if it gives dividend, then parent will have to pay tax. However, the payment of dividend by the subsidiary is within the parent's control, and parent does not expect that the subsidiary will pay dividend in the foreseeable future. In such a case, the standard allows you to not create a deferred tax liability on a difference arising due to investment in subsidiaries in the parent's books. That is, if dividend payment is within parent's control and it is unlikely that the dividend will be paid in the foreseeable future. Such an exception is not available to investments made in associates or joint ventures because parent does not have unilateral control on the distribution of dividend. Next over here is one specific case on deferred tax on share-based payments. This is to be accounted based on the specific instructions given under IND AS 102 special guidance. 3 steps you have to remember. Step number 1, remember that the carrying value will be nil. Ideally, carrying value you would have taken as the balance of SBP reserve. However, SBP reserve is calculated based on fair value. IND AS calculates fair value. Income tax does not give you deduction based on fair value, and hence IND AS has said let the carrying value be nil. Second, tax base ideally should be based on intrinsic value. Intrinsic value is the difference between the actual market price and the exercise price, because that is what income tax will give a deduction for. However, we don't know what the intrinsic value will be at the time of exercise, so the question says you can take the intrinsic value as on each balance sheet date and you can prorate that. The difference between the two into the tax rate will always result into a deferred tax asset. You will not apply the rules here like in carry forward losses. There is always a deferred tax asset. In a similar case here also there will always be a deferred tax asset. Why? Because of these items the company will get a deduction in the year when the employee exercises, so that will result in a deferred tax asset. Step number 1, carrying value to be taken as nil. Step number 2, tax base is to be taken as intrinsic value prorated. Step number 3, the difference between 1 and 2 into the tax rate will give you a deferred tax asset. So these are the broad things that you kind of need to go through for IND AS 12. We'll quickly glance through the questions over here. We are at IND AS 2, so we'll first go to IND AS 12. So on IND AS 12, you have this question where there are 4 distinct subparts which are equivalent to 4 different questions. So over here, X Limited prepares consolidated financials up to 31st March. During the year ended 31st March 18, the following events affected the tax position of the group. So there are 4 different possibilities. First, Y is a wholly owned subsidiary of X, made losses adjusted for tax purposes of 30 lakhs. See, remember, if losses are made, that creates a deferred tax asset. However, for you to create a deferred tax asset, you should have sufficient benefits against which you will utilize those losses. Y is unable to utilize the losses against previous tax liabilities. Income tax does not allow Y to transfer the tax losses to other group companies. It allows Y to carry forward the losses and utilize it against the future taxable profits. The directors of X do not consider Y will make profits in the foreseeable future. So, should you create a deferred tax? No DTA. No sir, there is a carry forward loss. Yes, but you do not expect that it will be utilized, and hence you do not create a DTA. Acha, in this question, if you see at the end, the tax rate is 20%. So if deferred tax is to be calculated, we'll calculate it at 20%. Second, just before 31st March 18, X committed itself to closing a division after the year end, making a number of employees redundant. So this is an obligation to terminate. Therefore, X recognized a provision for closure cost for 20 lakhs in its statement of financial position as on 31st March 2018. This is as per IND AS 37. You would have created a provision for restructuring. Income tax allows tax reduction for closure cost only when the closure actually takes place, which has not yet happened, and hence income tax has not recorded this. In the year ended 31st March 19, X expects to make taxable profits which are well in excess of 20 lakhs, and X has taxable temporary differences from other sources which are greater than 20 lakhs. This is for X. So over here, if we look at this case, there is a provision for closure cost which is basically an underlying liability. What is the carrying value as per IND AS? The carrying value as per IND AS, I guess, is 20 lakhs. The carrying value as per IND AS is 20 lakhs. This is the amount as per IND AS balance sheet. Tax base as per income tax balance sheet. Question says income tax has not allowed recognition for this, and hence as per tax balance sheet, tax base is nil, nothing appears, and hence the difference over here is 20 lakhs. Acha, on this difference, you will calculate 20 lakhs into 20%, that is 4 lakhs. But the problem is 4 lakhs is what? Is it a deferred tax asset or a liability? Well, this is an underlying liability where the carrying value is greater than the tax base. If carrying value is greater than the tax base, the answer is always opposite, and hence this will create a deferred tax asset. Logically, it is a deferred tax asset because in income tax, you will get deduction in the future years for 20 lakhs and hence you will pay lesser tax in the future years. So, a deferred tax asset. Can you create a deferred tax asset for X? Yes, because there are sufficient future benefits against which you can utilize this benefit and hence 4 lakh DTA can be created. Third, during the year 31st March 17, 18 kar dega. X capitalized development cost which satisfied IND AS 38 criteria, the total amount capitalized was 16 lakhs. So, this is development asset, intangible under development. The development project began to generate economic benefits for X from 1st of January and the directors of X estimated that the project would generate economic benefits for 5 years from that date. Okay, so this is the period over which the benefits will be generated. Let us say this is 5 years. The development expenditure is fully deductible against taxable profits for the year ended 31st March 18. So, in this case, there is an intangible asset. This is at the end of the day an asset. Acha, what is the value as per books of account? 16 lakhs is capitalized, but that is on 1st January. That 16 lakhs will be amortized. So, out of 16 lakhs, you will have 16 lakhs divided by 5 years. So, that is amortization per annum, out of which 3 months have gone by. So, into 3 by 12. And hence, this is 16 lakhs minus. So, if you calculate, I think this comes to 15 lakh 20,000. 80,000 is the amortization. 16 divided by 5. Yes, 80,000. Tax base. Question says development expenditure is fully allowed to be taken as deduction, which means in the tax balance sheet nothing appears. This is 0 and hence difference is 15.2. Acha, how will you calculate whether it's a deferred tax asset or liability? Well, this is a case where the carrying value is again greater than the tax base. But this is for an asset. So, an asset will create an opposite effect, that is a deferred tax liability. So, this will be 15.2 into 20% comes to 3,04,000, a deferred tax liability. Why is it a liability? Because income tax has given you full deduction of 16 lakhs. Books may you have taken only 80,000 and hence the remaining 15 lakh 20 you will get deduction in the books, but you will get no corresponding deduction in income tax and hence you will have to pay more tax in the future years. Acha, last part. On 1st April 17, X borrowed 1 crore. The cost to X for arranging was 2 lakhs and hence initial recognition, it's a financial liability, will be 1 crore minus 2 lakhs as per IND AS, that is 98 lakhs as per IND AS 109. And this qualified for tax deduction on 1st April. So, income tax 2 lakhs will be directly taken in the PNL, so tax base will be 1 crore. The loan was for 3-year period, no interest was payable on the loan, but the amount repayable on 31st March was 1 crore 30 lakh 43,000. This equates to an EIR of 10% and as per income tax, a further tax reduction of 30 lakhs will be claimable when the loan is repaid. So, income tax does not give you reduction for interest in each year. In books, interest will be recorded as per effective interest method. Explain and show how these will be accounted for. So, in the last case, there is a loan. Loan over here is a liability. Acha, as per IND AS, at year 1, your opening balance in the loan would be 100 minus 2, which is 98. On which there will be an effective interest rate at the rate of 10%, which comes to, let us say, 9.8, and there will be coupon. So, there is no coupon over here. So, 98 plus 10% will come to closing balance of 107.8. So, your value as per income tax will be 107.8 on 31st March 18. You compare it with the tax base, which is 100, because under income tax 2 lakhs has been taken to PNL, so you must have passed the entry under income tax, bank account debit to loan 1 crore and then PNL account debit to bank 2 lakhs. So, your asset, so your liability, that is a loan, continues to be at 1 crore, 2 lakh goes to the PNL. Each year interest will be recorded. This interest will go to the PNL in tax after 3 years and hence there will be no effect for the same. So, over here the difference is 7.8. This is a difference where the carrying value is again greater than the tax base and hence for a liability the answer will be opposite, that is a deferred tax asset will get created. So, this is 7.8 into 20% comes to 1,56,000. Why is this an asset? Well, because in income tax you have got only 2 lakhs deduction. In books you got a 9,80,000 deduction. So, for the remaining 7,80,000 you will get a deduction under income tax in the 3rd year and hence it is deduction in future years. So, that is a deferred tax asset. So, over here this is, let us say, a deferred tax asset. This is question number 1. Acha, next you go to IND AS 19 on page number 17. This is a question which involves a detailed presentation of IND AS 19 items. Acha, so at the end what do you have to do? Examine and present how the events would be reported in the financial statements for 31st March 18 as per IND AS. Okay. So A prepares financial statements up to 31st March. It operates a defined benefit plan on behalf of current and former employees. A receives advice from actuaries regarding current and overall liabilities. On 1st April 17, actuaries advised that the present value of the defined benefit obligation was 6 crores. This is the opening amount. Well, will the opening amount go? If I look at the shield for a, shield maybe chhod deta. If you look at the presentation in terms of liabilities, this will be like the opening liability worth 6 crore. So if this is a liability, an opening liability worth 6 crore or 600 lakhs. On the same day, fair value of the assets, which is for a defined benefit plan, the fair value of the assets are 5 crore 20. So if there were assets, let us say assets again opening will be 5 crore 20 or 520. Achha, on 1st April 17, the annual market yield on government bonds was 5%. So this is the rate of return. During the year ended 31st March 18, A made contributions of 70 lakhs into the plan and paid out benefits of 42 lakhs to the retired members. Both of them were made at the end of the year. So contributions were received at the end, benefits were paid at the end, and hence that will not really impact the interest calculation. So over here, if I were to find the impact in the P&L as well as in the OCI, I would say, why should this liability go up? Well, it will go up because of interest at the rate of 5%. So 5% of this is 30, it will go to the P&L. This is interest on the liability to the extent of 30. Achha, whatever is the interest rate on the liability is also the expected return on the asset. So this is interest at the rate of 5%. This is approximately 26. 5% of 520. This will reduce my expense and hence my net interest comes to, let us say, 4. Achha, apart from that, you have been given that there are contributions. Now these contributions increase the plan assets. This is, I guess, 70 lakhs, and the second effect will be against bank, less benefits paid. Again, the benefits paid will reduce the liability as well as it will reduce your plan assets. It will not impact the P&L because you have already recorded the expense as and when the liability was getting built up. The actuaries advised that the current service cost for the year ended was 62 lakhs. And on 20th February, the rules of the plan were amended with retrospective effect. These amendments mean that the present value of defined benefit obligations was 15 lakhs. So this is current service cost, which increases the liability by 62 lakhs. Second effect goes in the P&L, current service cost 62 lakhs. And there is a past service cost which also increases the liability. Second effect for this goes to the P&L again of 15 lakhs. Past service cost is recorded in P&L, actual gains or losses goes to the OCI. During the year ended 31st March 18, A was in negotiation with employee representatives regarding planned redundancies. Redundancies means terminations, reductions, curtailments. The negotiations were completed shortly before the year end and redundancy packages were agreed. The impact of these redundancies was to reduce the present value of the defined benefit obligation by 80 lakhs. So, you are reducing this by 80 lakhs. Before 31st March 18, A made payments of 75 lakhs to the employees affected by the redundancies in compensation for curtailment. So, the liability reduces by 80, but you are paying 75 and hence liability debit 80. 2, you are paying by selling plan assets to plan assets 75. So, 5 will be gain on curtailment. For a liability of 80, you are paying 75. These payments were made out of assets of the retirement benefits plan. So, over here, you will have less curtailed benefits paid. You have paid 80. Discharged 80 worth of benefits by selling plan assets for curtailed benefits worth 75, and hence there is a gain on curtailment which will go to the P&L to the extent of 5 rupees. Your general entries liability account debit 80 to plan assets 75 to gain going to the P&L at 5. On 31st March 18, actuaries advised that the present value of liability was 6 crore 80 and the fair value of plan assets was 5 crore 60. So basically this is 6 crore 80, this is 5 crore 60, and as a result you will try to find if the totals tally. So over here this is 630, 62, 15 minus 42 minus 80 comes to around 585, and hence the difference between the two, I guess 95 rupees. You will have to increase the liability. This must be due to changes in actuarial assumptions. If changes in actuarial assumptions increase the liability, there will be a 95 rupees increase in the liability. So your entry is liability credit, then OCI is debited, so there will be a 95 debit. So this is actuarial assumptions on the liability. Then you look at plan assets, 520 plus 26 plus 70 minus 42 minus 75 comes to 499, but it's actually 560, which means there is a 61 increase. So this is changes in return on the plan assets, but this has to be debited to plan assets, so OCI will be credited. So 61 ke liye changes in return on plan assets, OCI will be credited. So this is a credit effect, and hence a net, I guess 34 net debit will go under the remeasurement reserve. In the profit and loss, 66 15 minus 5, a net 76 will go as a defined benefit expense, and in my balance sheet a net liability at the end of the year will appear at 680 minus plan assets. I have to show the net amount 560 and hence 120. This is a net deficit, so I don't need to even look at asset ceiling, and the net 120 will appear in my balance sheet. Okay, so this is a broad discussion about the presentation of these items, which is shown on the next page. Acha, next you go to IND AS 37. There is one interesting and an exhaustive question which is there in IND AS 37. So go to page number 52, IND AS 37. This covers onerous contract, provision for restructuring, disclosure, a lot of things. So over here there is a conglomerate. So I'll just kind of run you through the basic parts. There's a conglomerate where you had one entity or one division of management consultancy which you want to discontinue. This discontinuance is happening with effect from 15th of February. 31st January is the date when let us say the directors decide, but 15th of February is the date when a public announcement is made. That is when the obligation to restructure arises, and hence from 15th of February there is a need to create a provision for restructuring. So what all will go under the provision for restructuring, and the directors sign the accounts on 30th of April. So two dates you have to remember. The provision for restructuring is created on 15th of April, 15th of February, and the board of directors sign the accounts on 15th of May. Balance sheet date is 31st March. So considering all of this, we will start over here. On the date of public announcement, it is estimated that G Limited would have to pay 540 lakhs as termination payments to its employees, as the cost for relocation of employees who remain in the group would be 60 lakhs. So there will be a termination payment of 540 that is expected, and relocation cost of 60 lakhs. Remember, relocation cost is not a part of provision for restructuring, but termination cost is. If you are including termination cost, it should be at the best estimate. The actual termination payments totaling to 520 lakhs were made in full on 15th of May. Acha, this is the date when directors signed the account. So you can see realistically 520 was paid, and hence the provision on 31st March should be based on the most reliable basis. This is an adjusting event, and hence provision should be made based on 520. As per latest estimates on 15th May, relocation cost is 63 lakhs. In any case, you will not record relocation cost till the time it is incurred. It will not be a part of provision for restructuring. So over here, there will be a provision which will be created at 540 to start with, and then you will adjust it and create it at 520 as on 31st March. It is an adjusting event. Second, G had taken a property on short-term lease which was expiring in the future. The present value of the future lease payments using an appropriate discount rate is 430. So this lease was expiring, but you are closing the business, and hence this is an onerous contract. If you continue paying the lease rents, it will cost you 430. On 15th May, G made a payment to the lessor of 410. This is again on 15th May. So this gives you additional information of the penalty amount in return for early termination of the lease. So you have to create a provision in this case for an onerous contract, and this will be at the lower of 430 or 410, whichever is lower. So on onerous contract, you will create a provision of 410 lakhs. Acha, the loss after tax of G Limited for the year ended 31st March 18 was 400 lakhs. G made further operating losses totaling to 60 lakhs on 30th April 18. Remember, during the year 17-18, this is not a discontinued operation. Discontinued operation is an operation which is held for sale. This is not held for sale. or it has been disposed during the year. This is not disposed during the year, or it has been discontinued during the year. Remember, the discontinuance in this case happens in the next year, and hence during the year 17-18 for this 400 lakhs, a detailed line by line disclosure will have to be given. However, in the next year, when you are actually discontinuing a component of the entity, then for the 60 lakhs, you can show disclosure as a discontinued operation. How should you present the decision to discontinue the business in the CFS? What provisions are required to be made? So provisions of 520 plus 410, that is a total provision of 930 needs to be made. And in the P&L, you will give a line by line disclosure for 400 lakhs worth of losses in the next year. On the other hand, you will show the net 60 lakhs as a discontinued operation in the next year. Yes, okay. So this will take care of the standards involving, core standards involving liabilities. Now a few other standards which are also there in module number 3. So we are kind of done with all the asset link standards of your CA module 2, ICI module 2, except for leases. Next, in your module 3, we have finished off the standards pertaining to liability. Then there are 3 other standards which are pertaining to disclosure. One is EPS, one is related party, and one is segment report. So these are pure disclosure related standards. We'll quickly kind of cover that. So first we will go to IND AS 24. This is on related party transactions. So when we are looking at related party transactions, this is a pure disclosure standard. I would just a second. I would not have numerical calculations over here. So what is the significance? Related party report has to be disclosed in the notes to accounts. So in the notes to accounts, when you are disclosing the related party report, you have to give 2 disclosures. One is the name and nature of relationship between the related parties, and second is the transaction and outstanding balances with the related parties. So when you are disclosing the name and nature of relationship, you have to look at the relationship between individuals, that is individuals and the entity, either persons having control or joint control or significant influence, or their key managerial personnel in the reporting entity or in the parent entity. Key managerial personnel involve personnel who are responsible for planning, directing, controlling the affairs of the entity, and include function heads like CEO, CFO, Chief Marketing Officer, Chief Production Officer, Chief Operating Officer, etc. Directors, whether independent, executive, non-executive, it does not really matter. All of these directors will be treated as related parties. So the directors will be treated as related parties. So this is the individual relationship along with the close family members, which includes the spouse, domestic partner, parents, brothers, sisters, children, etc. Second is the corporate relationship. Between the corporate relationships, members of the same group, that is subsidiaries, sub-subsidiaries, fellow subsidiaries. Joint ventures or associates will be related parties. Apart from that, if there are 2 entities which have the same party having a joint control, they are like co-joint ventures, they are also related parties. Or if there's one entity which is a joint venture and another entity which is an associate of the same third party, they are also related parties. This is company to company relationships. Apart from that, so basically what is not a related party? If there are 2 entities which are merely co-associates, they are merely having significant influence, they are not treated as related parties. Co-associates, co-joint ventures or co-subsidiaries are treated as related parties. So if there's an individual relationship, if there's an individual who is having control or joint control at one place, and that same individual or their family member has a control, joint control or significant influence at the other place, then it is considered that there is a related party relationship. However, if there is an individual or his family member which has only significant influence or KMP in one entity, and that same person or his family member also has only significant influence or KMP relationship in the other party as well, then both of these are considered to be not related to each other. Apart from that, the entity and its employee welfare fund, entity and another company which is providing key managerial services will also be related parties. So what will not be related parties over here will be co-associates, will be co-venturers, will be entities who are providing major loans or major suppliers or major customers. They are not trade unions, they are not related parties. In the related party report, the name and nature of relationship has to be given for a related party if transactions have happened during the year. However, if the relationship is due to control, like a holding subsidiary relationship, then name and nature of relationship has to be given even if there is no control over here. In terms of transactions, you have to give details of the transactions and the outstanding balances, and you have to give a disclosure irrespective of whether you believe that the transactions are at fair price, that is arm's length, or irrespective of whether you believe that the transactions are very small in number. The fact that the transaction is happening with the related party, it is treated as material and will require a disclosure irrespective of the size or irrespective of the amount, irrespective of whether it is happening at fair price or not. Now, it is possible that during the entire year, related party relationship is there only for a part of the year, in which case you will give the disclosure in the related party report only for the period for the transactions that have happened during that period. In case of KMP, key managerial personnel, you will give the details breaking up between short-term, long-term, post-employment, other benefits and share-based payments as well. These will be separately disclosed. There is the only exception in this related party report is on government entities. So, if an entity is related to another entity merely because it is either controlled, jointly controlled or significantly influenced by the government, then these two entities, even if they are related parties, do not require to disclose that in the related party report. However, you have been given a choice that if you want to voluntarily disclose, you can disclose. However, you have been exempted. Remember, all you need to disclose is the name of the government. You don't need to kind of disclose the name and relationship with other similar government companies. Okay, so this is about related parties. Next, you have IND AS 33, which is on earnings per share. This is an important standard. I would treat this as more important, tier 1 category. There are two types of EPS. There is the basic EPS, then there is the diluted EPS. So, when we are looking at basic EPS, it is a profit available for equity, ordinary shareholders, divided by the weighted average number of equity shares. In the numerator, while calculating profit, you will subtract all expenses, including even payments which are to be made to other equity components. You will have to find a net profit only for equity shareholders, divided by the weighted average number of equity shares. While calculating WANES, you will take the time based weighted average. For the time, you will take the number of days or months for which the shares were outstanding. In special cases like partly paid shares, you will convert them into equivalent fully paid shares. In case of bonus shares or in case of share split, you will have to do a retrospective restatement. So the date of bonus share is irrelevant. You will assume that the bonus share was in existence from the start of the year or the date of issue of the original share, whichever is later. Bonus shares, you calculate what is called as a bonus adjustment factor and you retrospectively adjust. An important point over here, two important points in basic EPS in my understanding will be right shares and participating preference shares. So when you look at right shares, in case of right shares, there is a hidden bonus element. How do you find the hidden bonus element? First, you calculate the theoretical X rights price, which is a weighted average price. So in the numerator, you will take the number of shares into the pre-right price plus the right shares subscribed into the rights price divided by the total number of shares. That will give you the theoretical X rights price. Then you calculate the rights adjustment factor, which is the pre-rights price, fair value prior to rights, also called as a cum rights price, divided by the theoretical X rights price. That will give you the rights adjustment factor, and you multiply the rights adjustment factor to all the shares that you have taken prior to the date of rights. So this is an important working. I would want you to practice sums on this when you are revising as well. And second is participating preference shares within the basic EPS section. So when you look at the participating preference share, special guidance is given under the appendix for the participating preference shares. How do you do the working? There are 4 steps. Participating preference shares participate in the profits of the company, and hence if you want to find the EPS, you will first have to find the undistributed profit. Step number 1 is to find the undistributed profit, that is the total profit minus the fixed preference dividend minus the agreed dividend to be paid. That will give you the undistributed profit, which is to be distributed between both equity and preference share. Then you will formulate, you will take something as X, depending on the sharing ratio. You will take, let the equity dividend to be paid per share be X, and hence the preference dividend would be, let us say if 25% is to be paid, then 0.25X. Then you will formulate an equation that if this undistributed profit was distributed, how much will go to the equity, that is the number of equity shares, let us say 10,000 into X, and how much will go to the preference? Let's say the number of preference shares, that is 5,000 into, let us say 0.25X. So that in total will come to, let us say, the undistributed profit, and then you find X, and based on that you find the earning per share of equity share and participating preference share, which is the distributed amount per share plus your share in the undistributed profits as well. So this is something which I would also want you to practice separately, because basic EPS पे ये दोनों चीज के ऊपर ज्यादा आने का possibility रहता है. Then you have diluted EPS. What is diluted EPS? Remember, EPS, whether basic or diluted, has to be shown on the face of the income statement. So what is a diluted EPS? Diluted EPS over here refers to EPS considering potential equity shares. What do you mean by potential equity shares? These are shares which have the potential to become actual equity shares, like convertible debentures, like convertible bonds, convertible preference shares, warrants, etc. They have the potential to become equity shares, and if they become equity shares, then what will be the impact on the EPS? That is what you have to kind of study over here. If they actually become equity shares, then what will be the impact on the EPS? So over here we will first look at convertible preference shares or convertible debentures. From which date will you consider them? Well, from the date of their issue or the start of the year, whichever is later, because if they've been issued during the year, you can't take them as potential from the start of the year. Till which date will you take? Well, till the end of the year or the date of conversion. If they've been actually converted during the year, then they were potential only to the part before their conversion. So this is the time period. Now, what is the numerator and the denominator adjustment? In case of preference dividend, if the conversion happened at the start of the year, you will not have to pay preference dividend, and hence preference dividend will be added back. If the conversion happened at the start of the year, you will not have to pay interest, and hence interest will be added back. However, preference dividend as per income tax is not tax deductible. Interest is tax deductible, and hence if you don't pay interest, the tax savings on that will also have to be reversed, and hence you add back interest into 1 minus T. Apart from that, in the denominator, you will add back the number of shares on conversion. This is a general thing that you do if you don't have a market rate of interest given on similar instruments. If a market rate of interest on similar instruments is given, then the amount of interest that you add back in the numerator will not be the coupon interest, it will be the effective interest, because as per IND AS 109, your actual interest debited to the P&L will be the effective interest. That is the liability component as per IND AS 109 into the effective interest rate that must have gone to the P&L, and hence that is the only thing that you reverse. While doing this assessment, you don't have to see whether the conversion is likely or unlikely, whether the conversion will happen or not happen. ये सब कुछ भी आपको देखना नहीं. You will try to calculate the diluted EPS had there been no interest. Had the conversion happened at the start of the year, you will add back effective interest into 1 minus T. Sir, when will we know we should take coupon interest? When will you know we should take effective interest? If the question gives you the market rate of interest on similar instruments, you will add back effective interest by finding the liability component. If the question does not give you market rate of interest on similar instruments, you will have to take coupon interest, and based on that you will add back. Okay. Now it is possible that there are multiple conversion ratios. One instrument can get converted into, let's say, 135 shares or 125 shares or 110 shares. You will take the maximum conversion ratio, because that will result in the maximum possible dilution. You want to show the worst possible picture, and hence you will take the maximum ratio. This is in case there are debentures or preference shares. In case there are options or warrants, we will try to find the free element in the options or warrants, because in case of debentures or preference shares, no new money is going to flow in on their conversion. But in case of options, when the options are exercised, new money will flow in, and as a result, we will have to take only the amount in the diluted EPS calculation after considering that money. So over here, let us say the options, there are 1000 options, and exercise price is 50. However, the prevailing market price is 100. In which case, over here, if these 1000 options are exercised, we will get 1000 into 50, that is 50,000 into our bank account. Using that 50,000, what can we do? Well, we can go to the market and buy back our shares if you have no use. In which case, 50,000, if you go to the market to buy back, you'll have to buy back at 100 rupees, and hence out of the 1000 shares that are issued, I can buy back 500 shares, and hence the remaining 500 are treated as a free element which has to be taken in the diluted EPS calculation. Next, you have contingent shares. When you look at contingent shares for basic EPS, you will take contingent shares into the calculation only once the shares become issuable. However, in diluted EPS, you will take the contingent shares into the calculation if the shares are issuable considering the current period to be the end of the contingency. So if the contingency is profit linked, or let's say linked to the number of stores, in which case you will take the number of stores or the profit at the end of the year and say that if this was the end of the contingency period, will the shares become issuable? If yes, you will include that in the diluted EPS calculation. If no, you will not include that in the diluted EPS calculation. As we said, EPS, both basic and diluted, has to be presented on the face of the income statement, and in case there are discontinued operations as well, you will have to present EPS from continuing, discontinued as well as total operations. In such cases, there are multiple EPSs to determine whether a particular potential number of shares are dilutive or anti-dilutive. What will we do? We will try to calculate EPS for a control number. Control number over here will be EPS from continuing operations. So if inclusion of a particular potential shares dilutes the control number, we will take that into the diluted EPS calculation, otherwise no. So this kind of by and large takes care. There is an order of solving in case there are multiple potential equity shares. This had come, I think, in the November 2020 exam as well. If there are multiple potential shares like convertible debentures, convertible preference shares, warrants, etc., all of them in a single question, then first you will have to calculate incremental EPS, that is a cost saving in the numerator, divided by the number of shares or free element to be issued in the denominator. You will rank the securities in the ascending order of incremental EPS. So once you rank the securities, there are 3 securities, you rank them, you calculate the EPS on a cumulative 1 by 1 basis. You don't take all the 3 together. You first take, let us say, only options, find EPS. If it reduces, then you add, let us say, preference shares. If it reduces, then you further go and you add debentures. If it does not increase, then that means it is anti-dilutive. Remember, diluted EPS is the worst possible EPS. Inclusion of a particular stock, if it increases the EPS, you will ignore that in the diluted EPS calculation. So this is about IND AS 33. We'll kind of do quickly the questions pertaining to these 2 topics. Let us go to IND AS 24. We'll do these 2 topics and then stop for a small 5-minute breather. We'll take a slightly longer break once these standards are done and before we are going to go into the bigger topics. So over here we are almost done with our module 3 as well of the CA curriculum, which is there pertaining to other than topics. We are kind of almost done. So we have module 1 remaining, and then we have the major topics remaining, which we will do, let's say, after a slightly longer break. We'll take a small breather after these questions are getting discussed. So we are at IND AS 24. Okay, page number 35, IND AS 24. Now ABC is a long-standing customer of XYZ. So ABC is a customer of XYZ. Mrs. P, whose husband is a director in XYZ. So let's say her husband is Mr. P, who's a director, so it's a key managerial personnel in XYZ. Purchase a controlling stake in entity ABC. Okay. On 1st of June 17, sales of the products from XYZ to ABC for the 2-month period, that is 1st April to 31st May, totaled 8 lakhs. Now this is the period before the controlling stake was acquired. Following the share purchase by Mrs. P, XYZ began to supply the products at a discount of 20% to their normal selling price and allowed ABC 3 months credit. Previously, ABC was allowed only 1 month credit. XYZ's normal credit policy, sales of products from XYZ to ABC in the 10-month period was 60 lakhs. And on 31st March 18, the trade receivables of XYZ included 18 lakhs in respect of the amounts owed by ABC. Analyze and show how the above events would be reported. So over here, if I look at the diagram, there is a Mr. P who is a director, that is a KMP in XYZ, and has a spouse, that is family, who is Mrs. P, who acquires a controlling stake in ABC on 1st June 2017. So over here, are XYZ and ABC related? Yes, there is a related party relationship with effect from 1st of June 2017. How is there a related party relationship? There is one place where there is a significant influence type of a relationship, like a key managerial personnel relationship, and on the other place there is a control relationship. an entity where there is control at one place and that same family member or other family member has significant influence or KMP at the other place, both of them are related parties. If they are related parties, in the related party report of XYZ, I will show among other things ABC Limited and the transactions with ABC Limited when the related party relationship was in existence was 60 lakhs. So in the related party report, I will show 60 lakhs as sales from, let us say, June to March. That will be a part of related party report. The sales of the first 2 months, that is 8 lakhs, will not be a part of related party report, but in your PNL it will still be a part. So in your PNL your total sales will be 8 and 60, that is 68. However, in the related party report your sales with the related parties will be 6 lakhs. Then when you look at the outstanding balances, within the outstanding balances you will show the outstanding balances pertaining to these transactions separately, that is debtors of, for example, 18 lakhs will be shown separately as a part of outstanding balances. So here this involves identification of a related party and preparation and its impact in the related party report. The transactions are happening at favorable terms and hence these favorable terms, if required, will also be separately disclosed. Are we clear with this? Yes, we will cover these topics. IND AS 21 I think we will do along with along with financial instruments and business combination as well. There is quite a lot of impact, or we can discuss it now as well, that's not an issue. Achha, next is an important question which had even been recently asked, but it has a lot of angles to be covered: basic, diluted, potentially convertible shares, a lot of interesting things, so it will give you a good understanding. So CAB Limited is in the process of preparation of consolidated statements for the group for the year ended 31st March 13, and the extract for the same is as follows. So you have profit for the year, other comprehensive income, total comprehensive income. You have a lot of these details given. Remember, for the profit working, you don't take other comprehensive income. You only take the profit. So these numbers are irrelevant. Again, the profit that you take is the profit available to the parent. And as a result, NCI will not be taken. Sir, why? Because the number of shares held by NCI is not taken in the denominator. It is only the share, which is the share capital of the parent is there in the denominator of basic EPS calculation. So you will take 39,000. So a lot of extra data is given. We will filter down and say 39,000. That is profit before considering the share of OCI, and profit attributable to parent not considering NCI. That is the amount that you should take. Everything is in thousands. The long-term finance of the company comprises of the following. This is a big amount if I want to take in thousands. So this is, let's say, 2 lakh equity shares at the beginning of the year, and company issued another, let us say, what is this, 50,000 equity shares on 1st July at full market value. So this will help you in the weighted average number of shares calculation. There will be 80,000 irredeemable preference shares. Acha, irredeemable preference shares, these were in issue for the whole of the year on 31st March, and the dividend on these shares is discretionary. So these preference shares are classified as equity in nature. They are not financial liability in nature, they are equity in nature, but remember, they are not equity shares, they are equity in nature. So payment to them will be directly adjusted against retained earnings, but they are not equity shares at the end of the day. Now because they are not equity shares, we will not take them in the denominator. EPS is earning per equity share, not earning per any component of equity, and hence preference dividend paid even to these components of equity will be reduced. Net profit over here will be the profit available in the PNL. This will be before appropriations, and hence preference dividend paid would not have been subtracted from this 39,000. You will have to subtract it separately. Why? Because you want to find the profit available to purely equity shareholders. Acha. Then rupees 18 crores of 6% convertible debentures issued on 1st of April and repayable on 31st May at par. Okay. Interest is payable annually, and as an alternative to repayment at par, the holder on maturity can elect to exchange their convertible debentures for 10 crores ordinary shares in the company. Okay. So this is a choice. On 1st April 11, the prevailing market interest rate for a 4-year convertible debenture which has no right of conversion was 8%. So this data is given. Market rate of similar non-convertible instruments is given. So we can find the liability component using an annual discount rate of 8% and present value of 1 rupee is 0.74, and the cumulative amount is 3.31. Okay. So in the year ended 31st March 13, CAB declared an ordinary dividend of 0.10 paise and so 0.10 rupees 0.10, that is 10 paise, and a dividend of 0.05 rupees, that is 5 paise. On irredeemable preference shares, compute the following. We have to find the finance cost and the basic and diluted EPS. So a lot of data is given, and this is an interesting and important question, I would say. So if I were to look at the basic EPS calculation, for the purpose of basic EPS, I have to first filter out the profit available for equity shareholders. So this is 39,000, which is profit as per income statement, which is before appropriations. From this, you will have to subtract the amount that you are going to pay to irredeemable preference share owners. There are 80,000 in thousands irredeemable preference share owners. To each of them you are paying 0.05, and hence after this is paid, the profit that you get is a profit available for equity shareholders, and hence this is what, 80,000 into 0.05, I guess this comes to 4,000. So this is 4,000 divided by weighted average number of shares. So this is 2 lakh in thousands, which is outstanding for the entire 12 months, plus I think 50,000 in thousands, which is outstanding for 9 months. Now you do not add the irredeemable preference shares over here because they are not equity shares. They may be in the nature of other equity, but they are not equity shares, and hence this is what, 2,37,500. So this is 35,000 divided by 237,500, and hence this comes to I think 0.147. This is basic EPS. Remember, finance cost which is paid to the convertible debentures would have already been subtracted within 39,000, and hence we don't have to subtract it again because finance cost is in the nature of expense, goes to the P&L. Acha, when I want to calculate diluted EPS, there is only one potential equity share. Students believe there are two potential equity shares. One is irredeemable preference shares. Irredeemable preference shares is not potential equity share. It does not have the potential to become equity share. It is going to be irredeemable. It is going to be a preference share. It does not become and does not have a potential to become equity share. On the other hand, there is a convertible debenture worth 18 crores. 18 crores, अगर मेरे को thousands में करना है, divided by 1000, that comes to I think 1,80,000 in thousands. So over here you have convertible debentures worth 1,80,000. Acha, here IND AS 109 application happens. If the issue proceeds are 1,80,000, I need to first find the liability component and for academic completion equity component. आप equity component ना भी करो तो चल जाएगा. So what is the coupon rate on these instruments? The coupon rate on these instruments, for example, is 6%. 6% of 1,80,000 comes to 10,800. So this is 10,800 into the present value annuity factor at the rate of 8% for a period of 4 years. Is that number given? Yes, 3.31. This is an optionally convertible instrument. So over here plus, so you will have 3.31 plus 1,80,000 into 0.74. These factors have been given to you, and as a result 10,800 into 3.31 M plus 1,80,000 into 0.74 M plus MRC. So this is around 1,68,948, and the remaining is equity component just for academic completion. Now if I want to find the interest on the liability component, this will be year 1 and 2. Remember, this is issued in 1st April 11. You are currently in the year 12-13. So you want the interest of the second year. So your opening amount is 168,948, on which effective interest at the rate of 8% is going to be levied into 8%. This is I think 13,516. Coupon that is going to be paid is going to be 10,800, and hence this is plus 8% minus 10,800. Closing comes to around 171,663. In the second year 171,663 and uske upar into 8%. So this is 13,733 minus 10,800 जो भी number आता है, and this comes to I guess 1,74,596 or 7 as a guess maybe. So if I want to calculate diluted EPS, I need to remember that 13,733 must have gone into my profit and loss account of the second year. Coupon must be 10,800, but in case of convertible instruments, when 109 applies, what goes to the P&L is not the coupon, it goes what goes to the P&L is the effective interest, and hence if I want to find the diluted EPS, I start with where basic EPS ends. So that is 35,000 divided by 2,37,500. 35,000 divided by 237,500, to which you will add the interest. So the interest over here will be 13,733 into 1 minus T. If the tax rate is available, the tax rate I guess is 25% given at the end, minus 0.25 plus, acha, this has the potential to become how many shares? The question tells you that for 10 crore ordinary shares, 10 crore ordinary shares will be I guess 1 lakh shares. 1 lakh in thousands will be 10 crore into 12 by 12, and hence if I want to calculate the diluted EPS over here, the diluted EPS will be calculated as 35,000 plus 13,733 into 0.75 plus 35,000 comes to, let's say, 45,000 approximately 300 divided by 337,500. Divided by 337,500 comes to around 0.134. Now this is lower than 0.147, and hence this EPS is considered to be diluted. So a lot of interesting adjustments over here. So this is 0.147, 0.134. While you calculate 0.134, the interest that you add back is effective interest into 1 minus T. Irredeemable preference shares are not potential equity shares, and hence they are not considered in the diluted EPS calculation as well. Convertible preference shares are potential equity shares, and hence they are considered. Okay, so this kind of takes care. So it's of IND AS 33. We'll stop for a short, maybe kitna 5 to 10 minutes breather. We can stop for around 5 minutes at this stage, because I'll take another 1 hour at max to complete the other IND ASs, except for the 5 or 6 major topics, which we will keep on the other side of a slightly long break. So if you, I know it's a little daunting, but if we have to finish this in the shortest possible time, we can go on for around 8, 10 or 12 hours, but then it does not really do justice. So just take a short breather and be back in, I'll just message on the Telegram channel once we are starting. I think we will start in around 10 minutes. Okay, so be back in 10 minutes. It's 6 o'clock, so be back by around 6:10 latest. Okay. Yes, timestamp, I will try to give the timestamp, but obviously it will not be possible today. So in tomorrow you should be getting, by tomorrow you should be getting the timestamp. Hello, hello, hello. Can you please confirm the audio and video is clear? Hello, hello, hello. Can you please confirm the audio and video is clear? Okay. Chalo. Let's continue with our onslaught. We will go to the other two standards which are remaining under your module 2, that is IND AS 21 and 108. We finish that and then we go to the last of these other indices under IND AS, the module 1, which is the simplest of the lot. Can get done faster. So this is foreign exchange. It's an important standard going under the tier 1 category. So over here in foreign exchange, there are three types of currencies. You have the functional currency, which is a currency of the primary economic environment in which the entity operates. Foreign currency, every currency other than the functional currency is referred to as a foreign currency. And then there is a presentation currency, which is a currency in which financials are presented. While determining functional currency, the standard says you look at the primary factors that include the currency in which sales are denominated or which currency which influences the sales. Secondly, the currency where expenses are incurred. And third, the competitive environment in which the entity operates. If the primary factors are not conclusive, that is when you go to the additional factors, which involve looking at additional factors like sources of finance, where in which currency are they raised, retentions, where are they retained, etc. Now, what are the foreign currency transactions? What are the principles in which you convert the foreign currency transactions? So your accounts are to be prepared in the functional currency, and if there's a foreign currency transaction like an import transaction, export transaction, you have to convert them. Conversion happens at the exchange rate prevailing as on the date of the transaction. After the transaction has been recorded and once you reach the balance sheet date, assets and liabilities have to be remeasured. If there are monetary items, they will be remeasured at the closing rate. If there are non-monetary items, they will be remeasured at the historic rate. If the non-monetary items are at cost, if the non-monetary items are to be recorded at fair value, then you will remeasure them at the rate on the date when the fair value is determined. Where will the gain or loss go? For monetary items, the gain or loss will always go to the profit and loss account, whereas in case of non-monetary items, usually the gain or loss will go exactly where the fair value differences are going. Like for example, if the fair value differences are going into the revaluation reserve, that is at the part of OCI, then the foreign exchange element will also go to the revaluation reserve along with the OCI. Or if the fair value reserves are, or if the differences are going in the PNL, then the fair value gain or loss is going to the PNL, then the exchange differences will also go to the PNL. The only exception over here to this rule is for investment in equity shares, which are recorded at FVOCI, in which case a foreign exchange gain or loss will be recorded in the profit and loss account. Now, the standard over here gives you certain guidance on what is a monetary item. Monetary item refers to items where the amount is determinable in monetary value or money value terms. The amount is determinable in monetary value or money value terms. That is a monetary item. A non-monetary item, on the other hand, is where the amount is not determinable in a monetary value or a money value terms, fixed. So, in case of a debtor, I am going to receive exactly the money value, or loan, I have to pay exactly the money value which is fixed contractually. However, in case of intangible assets, tangible assets, inventories, etc., the money value is not fixed or determinable, and hence it is considered to be non-monetary. Now, the important aspects, there are two important aspects over here. How do you account for foreign exchange gain or loss in case of financial assets or liabilities which are recorded using amortized cost or using FVOCI? So, in case there are financial assets which are recorded using amortized cost principles, in which case you will convert each item. So you will first prepare the amortization table in dollars, opening in dollars plus effective interest rate in dollars less coupon payment in dollars, which will give you closing, and each item you will then convert into rupees. Like the opening will be converted at the opening rate, effective interest using the average rate throughout the year, coupon based on the rate on the date when coupon is paid, and closing at the closing rate. In which case, if there's a difference, which there will be because you have converted different items at different rates, some at opening, some at average, some at closing, the difference over here will be attributable to different exchange rates used, and hence the difference will be the foreign currency gain or foreign currency loss. The same working will also apply in FVOCI bonds. However, at the end, you will compare the closing balance with the fair value converted at the closing rate, and the difference will be the fair value gain which is to be recorded for these bonds in OCI. So there are two important questions which are there in your material. For this, you should try to refer this. This is important. Then there are foreign currency operations. When we look at foreign currency operations, under foreign currency operations, you look at the functional currency. If the functional currency is the same as the parent's currency, then for the operations, the accounts are to be prepared in the same currency. There is no question of translation. However, if the functional currency is different, like for Tata and JLR, Tata Motors functional currency is the rupee, JLR the functional currency may be pound, in which case you will have to translate the financials of JLR into Tata's currency in order to facilitate consolidation. Now, at what principles will you do that? Incomes and expenses will ideally be converted to the rate as on the date of transaction, but if that is not available, then at the average rate. Closing may, if there are monetary or non-monetary assets or liabilities. Remember, in this case, both monetary and non-monetary assets and liabilities will be converted at the closing rate. However, the equity share capital will be at the historic rate, that is at the rate as on the date of acquisition. Reserves, which are pre-acquisition, will be at the rate as on the date of acquisition, and post-acquisition reserves will be built up at the average rates over the post-acquisition period. If you do this working, your balance sheet or trial balance is not going to tally, because you have taken some of the amounts at average rate, some of the amounts at historic rate, some of the amounts or majority of the amounts at closing rate, and hence the difference in the balance sheet will be taken as a foreign currency translation reserve, also called as FCTR. This FCTR is a part of other comprehensive income, which is a part of reclassifiable other comprehensive income. That is, at the time of the sale of the foreign operation or losing control over the foreign operation, the balance in the FCTR will be transferred to the statement of the profit and loss account. So this is about FCTR. Okay, so over here, there's also a separate discussion on goodwill. Remember, goodwill on consolidation will be calculated in dollars. Like all assets and liabilities of the subsidiary will be converted at the closing rate. Goodwill is also an asset attributable to the subsidiary, and hence the goodwill will also be converted at the closing rate. So there will be some impact or changes in consolidation for the same as well. There is also a special case in case there are foreign if there are foreign currency assets or liabilities which are monetary items. If settlement is planned, if there are monetary items, then the gain or loss in the standalone as well as consolidated PNL will go to the PNL only. However, if settlement is not planned, so if you have given a loan to a subsidiary whose settlement I don't plan, in which case it is a part of the net investment of the foreign operation, in which case in SFS the gain or loss can still go to the PNL, but in CFS you will reclassify that to FCTR, a very special case, not very important from an exam perspective. In case of disposal of a foreign subsidiary, if you end up losing control, then the FCTR will be transferred to the statement of PNL account. However, if you don't end up losing control, then the balance in FCTR, if you earlier had an 80% stake and you are giving up 10%, then 10% of the FCTR will now be transferred to the NCI. Okay. So that kind of takes care broadly about the foreign exchange standard. There is also IND AS 108 on operating segments, which is kind of, I guess, the last standard when it comes to module 3 type of standard. So we'll quickly wrap up IND AS 108 as well. So IND AS 108 pertains to operating segments. Now operating segments is defined, just a second. Okay. Operating segments are defined based on what the chief operating decision maker or CODM defines as operating segments. So for the chief operating decision maker or the CODM, who is the person who is ultimately responsible for taking the operating decisions, like the CEO or the CEO or even a panel of operating experts, this is a CODM. So in case of operating segments, there are three things that you have to see. First, the segment should be capable of generating revenue. Second, this should be a segment that should be reviewed regularly by the CODM for performance evaluation and resource allocation. And third, discrete information should be available. If that is the case, then that segment should ideally be reported. However, CODM might be tracking multiple segments. So in order to ensure that only limited segments are shown, we apply aggregation criteria, where if there are multiple segments whose nature of products are similar, nature of customers are similar, the nature of manufacturing process is similar, distribution network is similar, regulatory environment is similar, in which case you are allowed to aggregate these these segments and then present. Till this stage, there's a lot of subjectivity, and hence institute does not really ask you a lot of questions on this. The next part of the standard is more important, which is reportable segments as well as preparation of segment report. Once you have identified the operating segments, aggregated them to the extent possible, after that you have to show only the material segments. How did you figure out material segments? You have quantitative thresholds. Quantitative thresholds refer to segments having greater than 10% contribution in the overall segment revenue, or having a greater than 10% contribution in the overall segment profit or loss, or having a greater than 10% of contribution in the overall segment assets. While you determine segment profit, assets or revenue, you have to take only the operating items. Non-operating items will not be taken. Again, these items will be measured on the basis that CODM uses for the purpose of this, for their measurement. Secondly, for segment revenue, even if there is some inter-segment or segment revenue, that inter-segment revenue will also be included in the segment revenue. Further, while you calculate segment profits or losses, you will take the total of all segment profits, compare it with the total of all segment losses, select whichever is higher, and accordingly, you will take 10% of the higher number, ignoring the sign. If a segment is reportable in any one of the criteria, it will make it to the final segment report. Now, there are a few additional criteria as well, like management discretion. If a segment does not make it in the reportable segment category, even then, the management can still show certain segments as reportable if they meet certain specified parameters in their mind. So, it is management discretion. An important hidden adjustment is the big picture test, where the segments that you ultimately select has to cover 75% of the overall enterprise revenue. So, if these selected segments do not cover 75% of the overall enterprise revenue, then you will have to keep on adding segments till the time 75% of the overall enterprise revenue actually gets covered. So, this is about reportable segments. Then you look at the preparation of segment report, which is to be shown in the notes to accounts. So, in the segment report, you will first show about segment revenue, between that external and inter-segment revenue, then segment profit. Once you show the segment profit, that is segment revenue minus segment expenses, you will have to show the reconciliation of that segment profit with the company's net profit. Reasons for differences can be unallocable expenses or incomes, non-operating expenses or incomes, income taxes, or different policies being followed. So, you will have to show the reconciliation. Till now, you have focused only on the profit and loss. Now, you have to focus also on the balance sheet. So, looking at the balance sheet, you will look at the segment assets and reconcile them with total assets of the company. Segment liabilities and equity, reconcile it with the total liabilities and equity. And last May, you will show additional information pertaining to capital expenditure, that is money spent behind fixed assets, as well as depreciation for each segment. Apart from that, if additional data is available for a secondary segment, like we have shown all of this for a business, if additional data is available for a secondary segment, then you will show data regarding revenue geography wise, for example, assets geography wise, and capital expenditure geography wise. You don't have to show this for profits. Again, reconciliation is not needed. Further, if data is available, you will also show data regarding major customers or percentage of sales which are made to major customers to the extent possible. So, that kind of takes care of a broad discussion of segment report. Next, we will go to the questions. We'll first kind of tackle the questions involving IND AS 21. So, there are around 2 or 3 interesting questions of IND AS 21. Let us go to page number 24, where we discuss IND AS 21. So, on 30th of January 2011, A Limited purchased a machine for $5,000 from USA on credit basis. So, this is entry will be machinery account debit to creditors for machinery. This is at $5,000, which means you will have to convert this into rupees. A's functional currency is a rupee. The exchange rate as on the date of transaction is 60, which means 5,000 into 60 comes to 3 lakhs. Your entry will be machinery account debit to creditors. Let us say 3 lakhs. Okay. The fair value of the machinery determined on 31st March 11, that is at the end of the year, is 5,500. So, there is a remeasurement. You have determined the fair value, which means it is reasonable to assume that you must be following the revaluation model. The exchange rate on 31st March is rupees 65 per dollar. The payment to overseas supplier is done on 31st March 2012, that is the next year, and the exchange rate on 31st March 12 is 67 per dollar. Okay. The fair value of the machinery remains unchanged for the year ended 31st March 12, which means the institute assumes that we actually got a fair value exercise done, and at the end of 31st March 12, by the way, the fair value still appears at $5,500. So, a fair valuation was done, which yields a result of $5,500. Prepare the journal entries for the year ended 31st March 11 and 12 according to IND AS 21. Tax rate is 30%. So the first journal entry over here will be machinery account debit to creditors at 5,000 into rupees 60 per dollar, that is 3 lakh rupees. Now by the end of the year, you will have to remeasure the creditors. Creditors are monetary items, you will have to remeasure. So creditors, you have to pay $5,000. The rate when you did the credit purchase, the rate was 60, now the rate becomes 65, and as a result, you will have to pay more. $5,000 into rupees 5 per dollar, that is 25,000. That is a foreign exchange loss on a monetary item will go to the P&L. Forex loss account debit to creditors for machinery. So this is 25,000. Next, machinery. Machinery is a non-monetary item. Ideally, non-monetary item, if it is at historic cost, you don't need to remeasure. However, if it is shown as fair value, then you will have to show at the rate on the date when the fair value is determined. Now, fair value is determined on 31st March, which is $5,500 when the rate is 65, and hence the machinery will appear at 5,500 into 65, that is 3,57,500. Currently, the machine is at 3 lakhs, and hence 57,500 will be debited to the machinery. 57,500. Now, within this 57,500, $500 is the appreciation in the machinery value. So had the exchange rate not changed, had the exchange rate remained at 60 only, still the machinery value appreciates by 500. So $500 into rupees 60, that is 30,000, which will go to the revaluation reserve as a part of OCI. Additionally, beyond this, if let us say the rate also changes, so at $5,500, let us say the machinery was at $5,500, there is also an increase in rate, which is 65 minus 60, and hence 27,500 will be also part of the foreign exchange gain, because the underlying gain is going to the OCI. This foreign exchange gain will also go to the OCI. Now, will there be a deferred tax? Well, potentially deferred tax can arise on creditors also and machinery also. Institute has taken only on machinery, probably assuming that for a monetary item like creditor, even income tax will recognize a foreign exchange loss. This is the institute's assumptions. For machinery, income tax will not recognize, in which case on 31st March 2012, for items like 31st March 2011, for an item like machinery, you will try to find the carrying value. As per IND AS, this is 3,57,500. As per income tax, the tax base continues to be, let us say, 3 lakhs, and hence there is a difference. The difference over here is 57,500, and because this is a difference where the carrying value is greater than the tax base, the answer is going to be opposite. So this will give rise to a deferred tax liability at 57,500 into, I think the tax rate is 30%, and hence this is 17,250. Your entry will be deferred tax account debit to deferred tax liability. This deferred tax will be adjusted against revaluation surplus as a part of OCI. So over here, against the revaluation surplus as a part of OCI, you will subtract 17,250 of deferred tax to deferred tax liability. Now on 31st March 12, the creditors are paid, and that is when the rate is 67. Your creditors in your books are 3,25,000, but when you paid, the rate is 67, so you will pay 5,000 into 67, that is 335,000. So creditors account will be debited by what is there in the ledger, that is 3,25,000. To bank is 3,35,000. On a monetary item, the loss will go to the profit and loss. Let me just check, just a second. Let me, I've just refreshed the settings one. If there is a lag again, please let me know. Okay, so over here, machinery will again be remeasured. So machinery is $5,500. So on $5,500 into rupees 67 per dollar, that comes to 5,500 into 67 comes to, is it still a problem? It comes to 368,500, and hence there is an increase of 11,000, which will go to the revaluation surplus, and again there will be a further tax angle. There will be a further tax angle. So this is on 31st March 2012. You will have 3,68,500 compared with 3 lakhs, which is there in income tax, and hence 68,500. 68,500 into 30% will come to 20,550. However, out of this 20,550, 17,250 is already there and hence the difference between the two, which is 3,300. This is what you call as a deferred tax liability, which will again be adjusted against other comprehensive income. So this is an interesting question. Generally creates a lot of hassles for students. Acha. Next is question 2, which involves the impact of foreign exchange and financial instruments, an important question. So on 1st April, Makers raised a long-term loan from foreign investors. Makers raised a loan. So Makers is a borrower. The investors subscribed for 6 million foreign currency loan notes at par. 6 million is 60 lakhs at par. It incurred incremental issue cost of 2 lakhs, which means your initial recognition will be at 58 lakhs. Interest of FCY 6 lakhs is payable annually on 31st March, starting from 31st March 12. So at the end of the year, 6 lakhs of interest is to be payable. The loan is repayable in FCY on 31st March 17 at a premium. Achha, we don't know how much premium, and hence we can't find the present value today. And the effective interest rate comes to 12%. A lot of students try to calculate the value today. You can't find it because the amount of premium is not available. So you'll assume that the transaction price minus the transaction cost will be the initial recognition value, that is 58 lakhs. The appropriate measurement basis for loan is amortized cost, and the relevant exchange rates are 2.5 and 2.7. Average rate is 2.42. The functional currency is the Indian rupee. What would be the accounting treatment for a foreign currency loan in the books of Makers for 11-12, and calculate the various amounts? So over here, you will first do this in dollars or FCY, whatever is a foreign currency. Your opening will be 58 lakhs. Your effective interest at the rate of 12% in their currency, 58 into 12% comes to 6.96, and the coupon over here would be 6 lakhs, and hence your closing will be 58.96. Now each of these numbers you will convert at the respective rate. So this is converted at the rate of 2.5, then this is converted at the average rate of 2.42, this is converted at the rate on the date of payment, which is at the end of the year, and this is at 2.7. So you will convert every number. 58 into 2.5 comes to 145, 6.96 into 2.42, the average rate comes to 16.84 approximately. 6 into 2.7 comes to 16.2, and last में 58.96 into 2.7 comes to 159.19. So ideally, if I total all of these, your answer should be equal to 159.89, but it will not. So 145. So this is in rupees. 145 plus 16.84 minus 16.2. If you do this, comes to approximately. Just let me verify this once. Okay. Perfect. So over here, if I were to find a balancing figure for this, minus 159.19, this comes to around 13.55. This is an increase in liability, and this is on a monetary item, and hence this will go to the PNL. So this will be forex loss, which will be taken to the PNL to, let us say, loan or whatever is a bond liability. This is 13.55 approximately. So what have we done? We have first prepared the amortization table in the foreign currency, converted each item at the respective rate, opening at the opening rate, interest, effective interest throughout the year at the average rate, coupon on the date when it is paid, that is 2.7, and the closing at the closing rate. The balancing figure is to be taken. Are we clear with this? Achha, any problems? Yes, okay. So this kind of takes care of question number 2. Then it's question number 3, which is a fairly detailed question where a lot of items are to be figured out, whether it is monetary, non-monetary, and then the relevant rates are to be taken. This is on calculation of foreign currency translation reserve, or FCTR. So you can kind of review this. It's a fairly big question. So a lot of these items, you just have to figure out whether it is monetary or non-monetary, and if it is foreign currency translation, remember the foreign currency translation will happen for monetary as well as non-monetary items at the closing rate, for share capital and pre-acquisition reserves at the historic rate, and if there is any balancing figure, that balancing figure will be taken into the foreign currency translation reserve. Okay, so over here we'll just review this. Chalo kar hi lete. PQR Holdings is based in London and has pound sterling as its functional and presentation currency. On 1st April 11, PQR Holding is incorporated PQR India. It's wholly owned subsidiary in India. PQR will be engaged in trading of items purchased from PQR Holdings. The shares of PQR have a face value of 10, amounting to 500 crores. Okay, so all of this is the regular data given. It is incorporated at the start of the year. So there's a UK company and there's an Indian subsidiary. So UK company has to convert all the financials of the Indian subsidiary, which are in rupees, into pounds. PQR India has adopted IND AS. In accordance with IND AS, management of PQR India has concluded functional currency is the rupee. Following is the summarized trial balance of PQR India being the reporting date. Acha. So all of these amounts are in rupees crores. Share capital, remember, is non-monetary. Security premium is non-monetary. Retained earnings are non-monetary. Long-term borrowings are monetary. Deferred tax liability, I guess, is non-monetary because there is no contractual obligation. Current tax liability is monetary. You have to pay. Deferred tax is just an accounting concept. There is no contractual obligation to pay a fixed or a determinable amount. Income tax payable monetary, import duty payable monetary, employee benefits payable monetary unless otherwise given, like salary, wages, sundry trade payables monetary, property, plant and equipment non-monetary, software non-monetary, inventories non-monetary, cash and bank balance monetary, trade receivables monetary. Allowance for bad debts is reduced from trade payables itself. So if this will take the same classification, if sundry trade receivables are monetary, allowance for bad debts is also monetary. Additional information relating to PP and computer software is given. So you have been given their respective dates. PQR has adopted the following accounting policy in relation to shareholders' funds to translate equity. Share capital using historical rate, correct. Securities premium also using historical rate. Yes, these are this is arising on 1st April at the time of issue, and retained earnings using average rate. That's right. PQR India is incorporated, so all the profits after the acquisition will be converted at the average rate. Aja, since the presentation currency of PQR Holdings is GBP, PQR India is required to translate its trial balance from INR to GBP. Remember, these are not foreign currency transactions, they are foreign currency translations. So over here, every item, whether it is monetary or non-monetary, will be converted at the closing rate except for share capital and reserves. Everything will be at the closing rate. So you have been given the closing spot rate on 1st April so this is relevant for share capital and securities premium. Closing spot rate on 30th April. वैसे PP is purchased on that date. However, you are not looking at a foreign currency transaction. You are looking at a foreign currency translation. You are translating the entire trial balance, which is happening at the closing rate. So this is not relevant. 5th May software, not relevant. 15th March inventory, not relevant, at least in this case, because you are just doing a foreign currency translation. Closing spot rate on 31st March. This is relevant. Every other item will be converted except for the first 2 or 3 items will be converted at this rate. Acha. Average rate, so this is relevant for retained earnings. So you will apply these 3 rates, and then if there is any difference, it will go into the foreign currency translation reserve. So if you look at this working, everything over here, all of these items except for the items over here, all of them are converted at 0.109 only. If you see, everything is 0.109, that is a closing rate. It is only share capital, historic rate, securities premium, historic rate, and this is the average rate. The difference, if any, will be adjusted against foreign currency translation reserve, which is a part of other comprehensive income. FCTR can have a debit balance. FCTR can also have a credit balance. So this kind of takes care of IND AS 21. Complex questions involving this standard. So next we go to IND AS 108. Again, I guess we have taken 2 questions over here. One is on segment report presentation. Second is on reportable segments. So this is question number 1. X is operating in the coating industry. Its business segments comprise of coating and others. So these are the business segments. So you have all of this data. What do you have to do? You have to ultimately prepare the reportable segment revenue, profit, losses for the year end. So this is segment report. Segment report mein external revenue will be a part of the segment revenue. Achha, if this is including GST, you will subtract the GST and find the net external revenue. Other operating income is still operating and hence it will be a part of your segment revenue. So this is all a part of my segment revenue. Achha, then there is segment result. Now this is a part of my segment profit. However, this segment profit will have to be reconciled with the net profit. And then this segment assets, it will be a part of segment assets. Segment liability will be a part of segment liability. Unallocated income, net of expenses, is let's say this is in lakhs. So if you convert this into lakhs, this is 3,000 in lakhs. So unallocated income net of expenses, it will be a reconciliation item for the purpose of profit reconciliation to get to the net profit. Interest and bank charges, these are non-operating in nature and hence must not be a part of my segment report, but I will have to show this as a part of my reconciliation. I will subtract this. So if I look at this, just say ye mera total segment profit I 14,000 my plus unallocated revenue minus interest and bank charges. I am trying to arrive at the company's net profit. Income tax expenses, again this is income tax, out of which it is current tax and deferred tax. This is also a reconciliation for the purpose of calculating profit after tax. So this is finally reconciled with the profit after tax. Next you have unallocated investments. This is a reconciliation item with the assets and other assets. So both of these are reconciled. So this is 50 plus 30, that is 80,000 will be the segment assets. To this 10,000 and 10,000, that is 1 lakh will be reconciled. So that is the total assets in the balance sheet. Unallocated liabilities, reserves and surplus and share capital are given to you. This is a reconciliation item to the liabilities. So you will have that 30,000 and 40,000, that is the segment liabilities. To the segment liabilities, you will add unallocated liabilities and then share capital and reserves. Next you have depreciation for coating and others, capital expenditure for coating and others. This requires a separate disclosure. Okay. So this requires a separate disclosure. Okay. So over here, what we are trying to say is when we look at the capital expenditure and depreciation, we will show a separate disclosure over here. At the end, you have revenue from outside India is given, segment assets outside India is given. So this will be used for the purpose of additional segment report. Where is it better now? It is for additional segment report where you will show segment revenue outside India, total revenue, difference is the segment revenue in India. Then you have segment assets, total assets minus in India, minus outside India. So the balance will be in India. And for capital expenditure, you will assume everything is in India only. So this is the presentation of segment report. Acha. Next you have reportable segments. XYZ has 8 segments, namely A, B, C, D, E, F, G, H. The information regarding the respective segments are as follows. So you have for segment revenue, profits and assets. Identify which of the above segments out of A to H would be considered as reportable for the year ended. So over here, what we will first try to do is we will try to find the total segment revenue. This is 415, 45, 30. So I guess this is 600, which means 10% of 600 will come to 60. So if you consider 60, 1, 2 and that's it. Only A and B are reportable under the segment revenue criteria because that is greater than 60. Second, segment profits. You will take the total of profit 5 plus 15 plus 8 plus 5 plus 7. So this comes to what? 28 and 12 comes to 40 of profit and 95 of losses. So higher between the segment profit, which is 40, and segment losses, which is 95. So higher of the two is 95. 95 into 10%. I guess will 95 ni 100. So these three. So this is losses are 100. 100 into 10% is equal to 10. So what is reportable is greater than 10. This is 1. This is 2. And that is it. So under the profit criteria, only segment B and C are reportable. And under the assets criteria, if I total 15, 47, 16, 8, 14. So this is, I guess, 100. 100 ka 10% nikalo. So that comes to 1, 2, 3. So basically A, B and D. So your reportable segments which meet at least one of the criteria are A, B, C, D. So ideally you will take A, B, C, D as the reportable segments, but here the solution does not end only at quantitative thresholds. You will have to see whether these segments that you are taking cover 75% of the external revenue. So ABCD ka external revenue is 0 plus 255 plus 15 plus 10 and hence this comes to 280. ABC's external revenue is 280 over a total revenue of, let us say, 405, and hence this is 280 upon 405, that comes to around 69%, which is less than 75%, and hence you will have to add segments. Which segments can you add? You can add any. You can add E, you can have F, G or H, anything. F has the highest sales, and hence the faster it gets done, the better it is. So we will take F for example. You can take any other segment as well. So if you take A, B, C, D and F, this will now be 330 upon 405. Does this cover? So this is 405 external revenue, 330 upon 405, which is 81%, yes, and hence your reportable segments will be A, B, C, D for sure, and then additional you can add F or even any other segment. That should work. Okay, so these are two important questions, both of which are important from an exam perspective. So this kind of takes care of the discussion of standards from your module 3 by and large. Now the last part before the major chapters or the other chapters, remember small standards are largely ignored, but remember these are very scoring, because if they come, I mean business combination, financial instruments, consolidation will make you work really hard for the marks. These are direct, open and shut. You will majority get questions which are direct, and hence please do not ignore them. So I'm not just doing tier 1, I'm doing everything right now so that you are fairly clear. Okay, so now we are going into module 1. So these are fairly easy topics, only I think IND AS 101, IND AS 20 and IND AS I guess 113 to some extent will require some level of understanding. A cash flow statement requires some calculation elements as well, but otherwise IND AS 1, IND AS 8, IND AS 10, IND AS 34, they are fairly easy. Okay, so we go into the other module 1 topics. So first we are going into IND AS 1. Very quickly, basic principles of IND AS 1. We need to remember that we have to give a disclosure that we are preparing our financial statements as per IND AS. It should be an explicit and unreserved statement of compliance. Apart from that, other regular principles of presentation apply. Current and non-current classification. If an asset is realizable within 12 months or within operating cycle, whichever is longer, it is treated as current. Everything else is non-current. When you look at operating cycle, you take the raw material holding period plus the WIP processing period plus the finished goods holding period plus the debtors collection period minus the creditors payment period. Net will give you the operating cycle. Two very special cases over here to be remembered will be if there is a loan which is taken and that is a non-current liability which is subjected to conditions. If there is a breach in that condition before the balance sheet date, the loan becomes repayable on demand and hence it becomes a current liability. However, if before the balance sheet date, if you approach the banker and seek a grace period which is greater than 12 months, it continues to remain non-current liability. However, if the grace period is less than 12 months, it is now a current liability. If there is a waiver, if you get a waiver of the breach before the balance sheet date, you can still show this as a non-current liability. However, during the post-balance sheet period, if you get a waiver, this is treated as an adjusting event, and hence even if the waiver is obtained in the post-balance sheet period, we will reclassify the loan from current liability to non-current. Ideally, there has been a breach before the balance sheet date, which means on the balance sheet date, the loan is a current liability. The waiver is obtained in the post-balance sheet period. However, this is allowed as an exception only for a waiver, and hence we treat it as an adjusting event, and on the balance sheet date we will reclassify the liability to a non-current liability. However, if the waiver is obtained after the post-balance sheet period, obviously it is not an adjusting item. Sometimes what happens is you take a waiver before or you take a grace period before the breach itself. Remember, this chart will apply only if there is a breach. If there is no breach, this chart realistically does not apply, only because the liability continues to be a non-current liability. So if a question tells you that there is a breach, just a second, I guess again there is an issue. So if there is so if there is a breach, then we say that the liability gets classified as a current liability. If there is no such breach, then it continues to be shown as a current liability non-current liability only. So if there is an extension that you get before the breach, then the classification continues to be current. So this is an important case. Another important case will be if there is a refinancing or a rollover agreed. So if you have taken a loan from a bank and the bank has agreed to refinance it or roll over it, if the refinancing or rollover has been agreed before the balance sheet date. So if there are only 6 months remaining, the liability is current liability. However, before the balance sheet date, a refinancing or rollover has been agreed, in which case we have agreed to roll over the loan for another 3 years, in which case if the refinancing or rollover is agreed with the same bank, it is treated as a non-current liability now because I don't have to repay the loan after 6 months. However, if the refinancing or rollover is not yet agreed or it is agreed with another bank, it means I have to first repay the loan and then arrange for a new loan, in which case it will still continue to be shown as a current liability. So before we proceed, what we'll do is we'll just kind of quickly do this question for IND AS 1 because otherwise वो समझना थोड़ा मुश्किल पड़ता. So let us try to pick up this question for from page 1. An entity has taken a loan facility from a bank. So entity has taken a loan facility from a bank that is to be repaid within a period of 9 months, which means it is a current liability. From the end of the reporting period, prior to the end of the period, the entity and the bank enter into an arrangement whereby the existing outstanding loan will unconditionally roll over into a new facility which expires after 5 years. So entity and the bank have agreed to it. How should such loan be classified in the balance sheet? Well, it will now be a non-current liability. Well, loan was to be repayable in 9 months, but entity and bank have agreed to roll this over for a period of 5 years. So it is a non-current liability. Will your answer be different if the new facility is agreed upon after the end of the reporting period? Yes. If it is agreed upon at the end of after the end of the reporting period, your answer will be different. It will now be current liability. It will no longer be non-current till the time the rollover actually happens. Will the answer to A be different if the existing facility is from one bank and the new facility is from another bank? Yes. Your answer will be different. It will still be a current liability because I will have to repay the loan to the existing bank and take loan from a new bank. So repayment has to happen. So it will be a current liability. Will the answer to A be different if the new facility is not yet tied up with the existing bank, but the entity has a potential to refinance? So you just have a potential. You have not yet refinanced, in which case your answer will still be different. Will still continue to show it as a current liability only. Acha, this is on refinancing. Next, question number 2 is on grace period. In December 2011, an entity entered into a loan agreement with a bank. The loan is repayable in 3 installments starting December 15. So that is after 3 or 4 years. So it's a non-current liability. One of the loan covenants means conditions, is that an amount equivalent to the loan should be contributed by the promoters by 24th of March, failing which the loan becomes repayable on demand if they don't bring in by 24th of March. As on 24th March, the entity has not been able to get the promoter's contribution, and hence on 25th May, the entity approached the bank and obtained a grace period of up to 30th June to get the promoter's contribution. So there's a grace period up to 30th June. Okay. But this is a grace period for around 2 or 3 months. And this is after breach. So your liability continues to be shown as a current liability only. The bank cannot demand repayment during the grace period, but it can demand after 3 months. So it is current. Annual reporting period of the entity ends on 31st March. On 31st March, how should the entity classify the loan? Current liability. Assume that in anticipation that it may not be able to get the promoter's contribution by the due date, in February 12th, the entity approached the bank and got the compliance date extended. So you got this date extended in February itself, that is before the breach. For getting promoter's contribution, in this case, what will be the loan classification? Will it be different? Yes. The loan will continue to be shown as a non-current liability because in this case, there has been no breach. In the first case, there was a breach. In this case, there has been no breach at all. Okay, so that takes care of IND AS 1. Next you go, let us say, to IND AS 7. This is the cash flow statement. Now, when I look at the cash flow statement, first there are 3 parts of the cash flow statement. There is cash flow from operations, investing and financing. Then you have the net changes in cash and cash equivalents. To that you add the opening cash and cash equivalents and you get the closing cash and cash equivalents. Within the operating cash flow, there are two methods. There is a direct method and the indirect method. Under direct method, you take the cash sales or cash collection from debtors, less cash payment to creditors, less cash payment for expenses, less taxes paid, and you get the cash flow from operations. Under the indirect method, you start with the net profits, add back tax expense, get the profit before tax, then make three distinct adjustments. First, you have the non-cash adjustment where you add back items like depreciation, amortization, impairment loss, etc. Even share in profits from associates under the equity method is actually a non-cash item, and as a result, you will adjust that. Secondly, you will look at non-operating items. Non-operating items are items which are either investing in nature or financing in nature, like interest paid, which is financing, interest income, investing, or gain or loss on sale of fixed assets, investing. So you will remove that from the net profit. The idea is to get to the number which is your cash flow from operations. Then you will do the working capital or operating assets and liabilities adjustment. So when you're doing the operating assets or liabilities adjustment, the rule that you need to remember is current assets opposite relation. So if there's an increase in current assets, you subtract, decrease in current assets, you add. Current liabilities direct relation. So if there's an increase in current liabilities, you will add, decrease in current liabilities, let us say, you will subtract. So there is a direct relation in current liabilities, inverse relation in case of current assets. Next, you will subtract tax paid, and that will give you the cash flow from operations under the indirect method. Cash and cash equivalents. Within this, cash equivalents have to have three distinct features. First, they have to be highly liquid and marketable securities. Second, they should be maturing in the very short term, that is less than 3 months from the date of acquisition, and they should be in a position to be convertible into a fixed or a determinable amount of cash. Equity shares are not convertible into a determinable amount of cash and hence cannot be cash equivalents. If you are looking at bank overdraft, usually bank overdraft in the balance sheet will be a part of short-term borrowings. However, if the bank overdraft is a temporary overdraft, then it can be reduced in the cash flow statement from the cash and cash equivalent section. If it is a permanent overdraft, then it can be shown in the cash flow statement as a financing activity. So this by and large broadly discusses the cash flow statement impact. So you have a question on this, which is a slightly complicated question. It's a slightly exhaustive question, which is taken from an RTP. So we'll just refer that once. So over here, it is just asking you to calculate cash flow from operations. There is an extract, so you don't have the entire balance sheet. You can't prepare the full cash flow of consolidated position of A Limited are as follows. So you have been given the balance sheet at 31st March 12 and 31st March 11. And extracts of the statement of profit and loss for the year ended 31st March 12 are given. So you have been given the profit and loss extract as well. The below information is relevant for A group. So there are certain information given. You have to find the cash flow. A spent 30 lakhs on renovation of building. Now, unless given otherwise, renovation is subsequent expenditure which should be capitalized. A charged the entire renovation cost to the profit and loss account. So that is an error, and hence, if you want to find the cash flow using the indirect method, you will have to first take the rectified PBT. You have 1840 as a profit before tax, but in that 1840 you have subtracted 30 of renovation that has to be added. Again, that second effect will also go against the building. On 1st April 11, A acquired 100% shares in S Limited for cash of 300 lakhs. Fair value of the assets acquired and liabilities assumed under the acquisition are as under. This is a very common adjustment which Institute likes asking if there is an acquisition. In such a case, the cash that you are paying for the acquisition is to be shown as cash flow from investing after subtracting the cash and cash equivalents taken. Which means if I had to find CFI, my CFI would be 300 rupees minus 20 of cash and cash equivalents, and hence 280 would be shown as my net cash flow from investing activities. Apart from that, every other item, PP, inventory, trade receivables, trade payables, all of these you will adjust because you have shown 280 as a net payment, and this 280 is a net payment for all of these items. So we don't have to show a cash flow again, and hence we adjust the closing balances. So for PP, for example, you can subtract, okay, you can say minus 140 minus for inventories over here 60, trade receivables minus 30, trade payables minus 50. So this will be the adjusted balances that you should be taking. Remember, when you take 280 as a net payment, the payment for all of these items have already been covered, and hence you don't have to adjust it separately. Just remember, you'll have to take the net amount. So over here, A's PP comprises of the following. So you have been given detail of PP, addition at cost. So this is cash flow from investing. Revaluation is non-cash in nature. Disposal is typically cash flow from investing. Depreciation is non-cash in nature. And carrying amount. A constructed a machine that is a qualifying asset and incurred construction cost of 40 lakhs that has been charged to other expenses. This is also wrong. Ideally, if it is constructing a qualifying asset, it has to be capitalized. What you have done is you have expensed it to the P&L, and as a result, you will add back 40 to find the true profits. And again, 40 has to be added in cash flow from investing. Of interest cost of 110 charged to the P&L, 10 includes interest on specific borrowings that are to be capitalized, which means that 110 should not be expensed. Out of this 110, 10 has to be capitalized, and hence the remaining 100 is to be expensed. So another 10 will be added back, and that 10 will be added to the cost of the PP. PP was sold at 630, so your cash flow from investing will be 630, and gain on disposal is adjusted against operating expenses. Gain on disposal must have gone to the P&L, but how do you calculate the gain? You compare 630 with 490. So you are saying that if you are selling at 630 and the WDV is 490, which means 140 is the gain. So the gain over here is going to be 140, which is to be taken to the profit and loss account. Acha, A Limited purchased 30% interest in associate on 1st April. This will be a cash flow from investing. This will be a cash flow from investing. The associate reported a profit after tax of 400. Acha, 400 ka 30% if you go to see will be 120 rupees. This 120 rupees, your entry will be investment account debit to profit and loss, but you have not received cash, and a dividend of 100 lakhs for the year. Now this 100 lakhs will go as cash flow from investing. Okay. Impairment testing was conducted on 31st March and following were impaired. Goodwill impairment loss 265. Intangible impairment loss 900 lakhs. Okay, streaming is fine, great. I'm getting an error message over here, so if there is there's a bitrate error coming. In case there is a problem, please mention. The goodwill impairment is relates to 100% subsidiary. Assume interest costs are paid in cash. So you are required to generate cash flow from operations for the year. So if I were to calculate the cash flow from operations, I'll first find the rectified PBT. In the cash flow statement, I will show the rectified PBT 1840 plus 30 plus 40 plus 10. So this is 1920. Tax is not given. So if I look at this question, in my cash flow from operations, I will start with net profit, I think of 1920. So this is your net profit 1920, to which you will add non-cash items like depreciation, like impairment. So depreciation is there in your adjustment somewhere at 290. So you will add back depreciation worth 290 plus impairment somewhere, unless it is given. Otherwise, we assume these impairment expenses would have been subtracted. So this is 265 and 900, which comes to 1165. So this is also non-cash in nature, 1165. This is expenses which need to be added back. Apart from that, you have share of profit from the associate 120. This is an income. This is also not in cash, and hence income from associate. Well, dividend is a cash flow, but that is cash flow from investing. This income of 120 has to be subtracted. These are non-cash items. Then you look at non-operating items. There is a gain on sale of PP, which is 630 minus 490, which is equal to 140. 140 must have been included, and hence it is non-operating. It will be subtracted. Apart from that, interest expense. Interest expense is financing in nature. You will have to add back 100. Acha, it is 110, but out of that 10 has been rectified, and hence 100 will be added back. And other than that, there is no other non-operating item, non-cash item, and hence you will take the changes in working capital. So this is changes in inventories, then changes in trade receivables, and then changes in trade payables. So when you look at inventories in your balance sheet, this is 1550 minus 60. Adjusted inventory 1550 minus 60 minus the opening balance of 1900. So that is a decrease in inventory. So there is a decrease in inventory. Decrease in inventory is to be added. Then there is trade receivables. Within trade receivables, this is 1250 minus 30 minus 1800, I guess. This is also a decrease in trade receivables, which you will add. When you look at trade payables, this is 1550 minus 50. From this subtract 3610. Remember, you have to take the adjusted balances because the cash flow from investing activities of 280 would have considered the total payment for all of this. So this is again a decrease in trade payables which you will subtract. So this is what? 1490 minus 1900, which comes to 410, which you will add. 1220 minus 1800 comes to 580, which you will add, and 1500 minus 3610, this is 2110, which you will subtract. There is no tax, and hence if you take this, ideally you should be getting cash flow from operations. So that's 1920, 290, 1165 minus 120 minus 140 plus 100 plus 410 plus 580 minus 2110, hopefully 2095 should be your cash flow from operating activities. So over here this will be 2095. Okay, so that is about IND AS 7. Next you go to IND AS 8. This is changes in accounting policies. Maybe I guess another half an hour or 40 minutes maybe. Hopefully by then everything should be done. So you're looking at accounting policies over here. This standard covers accounting policies, accounting estimates and errors. When you look at accounting policies, these are methods of applying accounting principles. If there's a change in accounting policy for like to like similar transactions, you need to apply it retrospectively. A retrospective application means that policy was always applicable. And if there is a change in the comparative previous year, you will change it in the respective line items. If it is for a period prior to the comparative previous year, you will adjust the opening balances. So the opening retained earnings, opening asset balance, etc. So I've shared these notes on the Telegram channel only. So whenever, I mean, it is there, all of these are there on the Telegram channel. Otherwise, it is there on your shield. If you want the hard copy, it is there on the shield. Otherwise, whenever we have given the revision videos for each of these topics, we have shared the respective notes. So you have the accounting policies. So retrospective application for the comparative years, you will adjust in the respective year. Prior to the comparative years, it is in the opening balances. The change in accounting policies can be changed from FIFO to weighted average or change from cost model to revaluation model. All of these are changes in accounting policies. However, changes in functional currency or reclassification from PP to investment property, these are, or a change in the method of depreciation, these are not changes in accounting policies. Accounting policies have to be retrospectively applied. If there's a change in accounting estimate, it has to be prospectively applied. An error is not a change in accounting estimate. An error is clerical, mathematical, judgmental. It is factual in nature. Estimates are linked to judgment, error are linked to facts. If it's an error also has to be retrospectively restated. That is, adjust the error in the respective year when the error pertains to. If the error pertains to a period prior to the earliest year presented, then the error will require a retrospective restatement in the opening balances. Whenever the error or an accounting policy change or a reclassification pertains to a period prior to the comparative year presented, you also need to present the third balance sheet. Apart from preparing the two balance sheets, let's say 31st March 23 and 31st March 2022, you will also have to prepare the 1st April 21 comparative balance sheet if the impact goes on or before 1st April 21. This is for IND AS 8. Then there is another simple standard IND AS 10, which is events occurring after the balance sheet date. Post balance sheet period is a period that starts from the balance sheet date and ends when the director signed the accounts. Every other date is irrelevant. There are two types of events which can happen during this period: adjusting events, which give you additional information about a condition existing on the balance sheet date; non-adjusting event, new events which do not pertain to anything existing on the balance sheet date. Non-adjusting events, if material, can be disclosed, otherwise they can be ignored. Adjusting events pertain to conditions existing on the balance sheet date and hence they require adjustment. Adjusting events examples include settlement of an ongoing lawsuit in the post balance sheet period. Examples include the selling price of the inventory gives you additional information of the estimated selling price as on the balance sheet date for the NRV determination, or let us say insolvency of a debtor in the post balance sheet period gives you additional information of a potential bad debt loss as on the balance sheet date, etc. The two exceptions to the non-adjusting events would be going concern assumptions. If something happens in the post balance sheet period which affects the going concern assumption, you treat it as adjusting. And secondly, if there's a subsequent waiver of a breach of a material condition in the post balance sheet period, you treat that also as adjusting. So if we discuss the questions for these items, so there are, I think, questions on IND AS 8 as well as IND AS 10. So over here, ABC Limited changed the method adopted. This is in IND AS 8 for inventory valuation in the year 1819. Prior to the change, inventory was valued using FIFO. However, it was felt that in order to match the current practices and make them more relevant, a weighted average method would be appropriate. So basically, you are changing from FIFO to weighted average method. The effect of the change in the method of valuation of inventory was as follows. As on 31st March 17, there is an increase of 10 million. On 31st March 18, an increase of 15 million. If you have 31st March 19, this is for 20 million. So when you look at profit or loss under FIFO valuation method are as follows. So you have revenue less cost of goods sold gives you gross profit less expenses, which will give you the profit. So when you look at the COGS, inventory affects COGS. So opening stock plus purchase less closing stock will give you COGS. So over here on 31st March 17, this will impact the COGS of the year 16-17. Now 16-17 COGS is not there. So we don't know about the opening inventory, but your closing stock increases by 10. If closing stock increases by 10, COGS will fall by 10. COGS falls by 10, profit increases by 10, and hence your opening retained earnings of 423 will increase by 10 with the corresponding adjustment to inventory. Second, when you go to the year 31st March 18, your opening stock in the year 17-18, your opening stock increases by 10, your closing stock increases by 15, and hence COGS falls by 5. If COGS falls by 5, this becomes 164 ke badle this becomes 159, and because this becomes 159, your gross profit will now be 296 minus 159 comes to 137 minus 74 comes to 63. This is your profit. Acha, in the year 18-19, there is an increase in opening stock by 15, increase in a closing stock by 20, and hence there is a net decrease in COGS by 5. So your net COGS decrease comes to 168. So this comes to 156. 156 minus 83 comes to 73. So this is coming to, let us say, 73. Are we clear with this? So over here, we will restate 18-19 and 17-18. We will restate 18-19 as well as 17-18. When we look at the other changes in the statement of equity, our opening balance gets restated. There is a changes in accounting policy of 10 rupees, and accordingly the entire statement will get restated. Here you will have to prepare 3 balance sheets, including the 1st April 2017 balance sheet as well. Achha, then there is an IND AS 10 question. This is equivalent to 4 different questions over here, where you have to comment on the events occurring in the post balance sheet period. Discuss with reasons whether the events are in the nature of adjusting or non-adjusting events, and the treatment as per IND AS 10. Moon Limited won an arbitration award on 25th of April for 1 crore. From the arbitration proceedings, it was evident that the company is most likely to win the award. Institute has interpreted this to mean virtual certainty. So if you treat this to be virtual certainty, then the amount of 1 crore is an adjusting event. If you treat this not to be virtual certainty, then it is still non-adjusting. The directors approved the statements on 31st March 11. On 1st May, the management did not consider the effect of the above transaction in the year 10-11 as it was favorable to the company, and the award came after the end of the year. So if you believe that it was evident that the company will win the case, in which case if there is virtual certainty, then the 1 crore can be adjusting, otherwise it is non-adjusting. Second, Zoom has a trading business in mobile telephones. The company has purchased 1000 mobile phones at 5,000 each on 15th March. So this is the cost of the mobile phones. Mobile phones are inventories. The manufacturers of phones had announced the release of new versions on 1st May, but had not announced the price. Zoom valued the inventory at 5,000 at the end of the year, which is fine. It should be at cost. Due to arrival of new advanced version on 8th April, the selling price of the phone stocks dropped by 4,000. Which means the estimated selling price is now 4,000. Compare the cost of 5,000 with NRV, which is based on the estimated selling price of 4,000. The financial statements of the company valued the phones at 5,000 and not 4,000 less expenses as the price was effected after. Let it be effected after. Remember, inventory was the only item which is based on estimated selling price. We don't measure inventory based on fair value. We measure it based on estimated selling price, and the actual price in the post balance sheet period gives you additional information about the estimated price as on the balance sheet date. So as on 31st March, we can say that the estimated price is 4,000 rupees based on events occurring in the post balance sheet period, and hence the valuation should be based on 4,000 over here. This is unique to inventory only. Acha, third, there is a old due from a debtor amounting to 15 lakhs against whom insolvency proceedings were instituted prior to the financial year ended 31st March 11. The debtor was declared insolvent on 15th of April. So this was insolvency on 15th of April in the post balance sheet period. So this will be an adjusting event. Aage bhi adjusting event. This will be an adjusting event because the debtor was already there on the balance sheet date, and insolvency gives you additional information about the inability to pay, which must also be there as on the balance sheet date. Acha. Third, assume that subsequent to the year end and before the financial statements are approved, company's management announces that it will restructure the operation of the company. Management plans to make significant redundancies, that is close. This is subsequent to the year end. So you are doing a restructuring after the year end. Close a few divisions of the company. However, there is no formal plan yet. Should the management recognize a provision in the books if the company decides subsequent to the end of the year to restructure? The answer is no. It is a non-adjusting event because as on the balance sheet date, there is no obligation to restructure. The obligation to restructure arises only once there is a detailed formal plan in place which is communicated, which is likely happening in the post balance sheet period. So it is a non-adjusting event. The only contentious discussion over here is in sub point 1, where it depends on your assumption of what you believe is virtual certainty. In all other cases, the answer is fairly clear. Okay, so this takes care of IND AS 10. Next, you go to IND AS 20. This is on government grants. So when we look at IND AS 20 over here, government grants has two parts. There is grants which is quantifiable, for which accounting is to be done, and there is assistance which is non-quantifiable, for which a disclosure is to be given. If a grant is to be recorded, you will recognize the grant. You will recognize the grant when the grant becomes receivable and there is a reasonable assurance that the conditions attached to the grant will be fulfilled. Accounting for grants, there will be two types of grants. There is a grant linked to asset, which is linked to acquisition, purchase or construction of a specified asset, or a grant linked to income. So every grant which is not linked to asset is linked to income. If it is a grant linked to asset, you can either show the grant as a reduction from the asset's cost, or you can create a deferred income account. If you reduce it from the cost of the asset, then it is very simple. Depreciation will be based on the net amount. However, if you show it as deferred income, then the deferred income or deferred grant balance will have to be amortized to the P&L, preferably in the ratio of depreciation. However, for assets like land where there is no depreciation, the deferral will happen based on some other appropriate ratio. All of these will work in general. However, in case if the asset is received free of cost, in which case if you are following the net method, then at what value will you show the asset? Because if it is received free of cost, in which case the standard says you can show it as a nominal value. Nominal value is a value that you just show for the purpose of namesake, and in case of the method where you are showing the asset at fair value and a deferred grant, you have no problem in this. Further, sometimes it might happen that the asset is still under construction and we have received a grant amount. Till the time the asset is ready for use, it is preferable to show this into a deferred grant account, and then once the asset is ready for use, you can either reduce it from the cost or take it to the P&L in the ratio of depreciation. In case of grants linked to assets, you will always have to amortize in the ratio of depreciation in case it's a depreciable asset. You cannot take it to the P&L account immediately. Acha, if it is a grant linked to income, then you have to see whether it is linked to some past expenses which have already happened or losses which have already happened, or it is unconditional in nature, in which case the grant can directly go to the profit and loss account. In other cases, like in case of an unconditional grant, you can take it to P&L, but in other cases, if the grant is to compensate for future expenses, etc., then you will take the benefit of the grant into the deferred grant account, and then you will amortize in the ratio of expenses, and if the ratio of expenses is not available, then on the straight line basis. Acha, so A few special cases are there. You have grants in the nature of promoters contribution, which was earlier as per AS12 taken into the capital reserve. There's no capital reserve concept over here. It will be treated as a grant linked to income and accounted accordingly. EPCG schemes will also be taken as grants, which are as per the institute's advisory committee, should be taken as grants linked to income, because the primary objective over here is to encourage exports, and hence they should be deferred as and when the export commitments are met. Now, in my opinion, the most important part of this standard involves loans at concessional rate, because this is an interplay between IND AS 20 as well as IND AS 109, in which case if there are loans which are at a concessional interest rate, in which case you will first have to find the fair value of this loan liability at the market rate of interest had there been no grant. The difference between the fair value and the actual loan amount is the grant amount, and the accounting for this grant is as per IND AS 20. So if this grant is linked to an asset, you will either reduce it from the asset or take it as deferred grant and defer in the ratio of depreciation. If it is linked to income for a past loss, then it will immediately go to the P&L. If it is for future expenses, it will be deferred in the ratio of the expenses. This, in my opinion, is the most important part of this chapter. Acha. Refund of grants will be adjusted from the same account where the grant had originally gone. So if the grant was reduced from the asset, the refund will be adjusted from the asset. If the grant had gone into the deferred grant, then you will first adjust the balance in the deferred grant, and excess, if any, will go to the P&L. When you are presenting the grants, deferred grant account will be presented in the balance sheet. The amount that is realizable within the next 12 months will be under the current section. Beyond 12 months will be within the non-current section. Profit and loss. In profit and loss, in case of grants linked to asset, the depreciation will be taken in the P&L, and the amortization will be shown as a part of other income. For grants linked to income, in terms of presentation, you can either reduce the grant from the expense, like training expenses minus the grant amortization, or you can show the training expenses separately and the grant income separately. So this is regarding IND AS 20 government grants. I think in the beginning over here there is only IND AS 34 remaining, and we'll finish IND AS 34 discussion as well, and then do the questions for both of these together. So you go to IND AS 34. This is interim financial reporting. Okay, so we look at interim financial reporting. So within IND AS 34, what is an interim period? Interim period is a period which is shorter than a financial year. It is not necessarily shorter than 12 months, but shorter than a financial year. That is an interim period. In case an entity is presenting an interim report and claiming that to be as per IND AS, then IND AS 34 will apply, where you can prepare either condensed financial statements or complete financial statements. Under complete financial statements, it is the same as the annual report. In case of condensed financial statements, then this would show headings as well as subheadings. ये दोनों अपन separately बताएंगे. You show the headings as well as subheadings. That's it. You don't have to give the detailed notes. Even within the notes to accounts, you can give selected explanatory notes. When you are measuring items, this is where the important part is. You will measure items in general, considering the current period to be the discrete period. So if the current period were to be the entire financial year, would you record an expense? If yes, then you record it in the current quarter as well. If no, then you will not record it. Income tax, fixed overheads absorption, and changes in accounting policies require a slightly different treatment. Like in income tax, you follow the integral approach where you treat the quarter to be a part of a larger financial year, and to achieve that you calculate the weighted average tax rate. So you estimate the annual accounting income, then you estimate the annual tax and calculate a weighted average tax rate. That means for every rupee of income that is earned in your accounting books, how much will be the tax. So your income in each quarter into the weighted average tax rate will be the tax for that particular quarter. Special cases over here can include slab rates, carry forward losses, losses during the current year, different types of incomes, different financial years. You have to consider each of them importantly for your overall understanding. Like if it is a slab rate, you calculate weighted average tax rate and multiply it by the income earned in each quarter. If it is a carry forward loss, you calculate the weighted average tax rate considering accounting income and then multiply that weighted average tax rate to each quarter's income. If there are losses in a few quarters, gains in another quarters, then you will have a tax in few of the quarters and a tax savings in the other quarters. If there are different categories of incomes like capital gains and other income, in which case you will calculate different weighted average tax rates for different categories of income and then solve. Next, if you have different financial years or different tax years, then you will take the weighted average tax rate for different years and then do the working and solve. Acha, for changes in accounting policy, remember you will do a retrospective restatement quarter wise, like you do a retrospective restatement and application for each financial year. In case of fixed overheads absorption, you will take the absorption considering the till date working. So you will take the output till date into the absorption rate minus the overheads absorbed earlier and accordingly solve. Achha, so based on this, we will go to the questions. There's one very interesting and detailed question which is there on government grants. So we will broadly refer this and then go to IND AS 34 question as well. So over here you go to question number 1 for government grants, which we are on page 20. Now A Limited is engaged in the manufacturing of certain specialized chemicals. A is engaged in the manufacturing of certain specialized chemicals. During the manufacturing process, certain wastewater is produced which is released by A Limited in the nearby river. To reduce pollution of the rivers, the state government has introduced a scheme with the following features. Okay. So this is to reduce pollution in the rivers. If a manufacturer installs certain pre-approved wastewater treatment plant, the government will provide interest-free loan equal to 50% of the cost of the plant. So this is interest-free loan equal to 50% of the cost of the plant. Such loan will be repayable in 5 years from the date of disbursal. Okay. The manufacturer availing the benefit of the scheme must treat the wastewater of its factory using specified plant before releasing it into the river. So we have to treat this, and if that is a condition, if the condition is violated, the entire loan will become immediately repayable to the government along with a penalty of 10 lakhs. So there's an additional penalty as well. Cost of the wastewater treatment plant to be installed to avail the benefit is 50 lakhs. Acha, so if you take that, you will have to buy the plant at 50 lakhs. The government is not giving you a grant for the plant for buying, it is giving you an interest-free loan. A Limited decided to utilize the scheme because if it were to obtain a similar loan from a bank, it would be available at a rate of 12%. Accordingly, A applied for and obtained a grant of 25 government loan of 25 lakhs on 1st April. A purchased and installed the plant such that it became ready for use on the same day. So if I were to look at this IND AS 20 question, we will first try to quantify the grant amount where the loan is 25 lakhs. The coupon rate is 0%. It is an interest-free loan for a period of 5 years where the market rate of interest, I guess, was 12%. So over here, the fair value of this loan, the fair value, this is IND AS 20 question, of this loan is 0 rupees plus 25 lakhs into the present value factor at the rate of 12% for the 5th year. So if I do this working, 1 divided by 1.12, 1, 2, 3, 4, 5. So this is 0.5674. So this is 25 lakhs into 0.5674. That comes to around 14 lakh. I'm just doing this directly in lakhs for a faster calculation. 14.185 lakhs. This is the fair value. However, what we have received is actually 25 lakhs, and hence the grant amount will be 25 minus 14.185, which is 10 lakh 81,500, 10.815. This is the grant amount. Now this is a grant which is directly linked to acquisition of an asset, and hence it is an asset linked grant which can either be reduced from the cost of the asset or can be credited to deferred grant account. Achha, A has an accounting policy of recognizing government grant in relation to depreciable assets in the proportion of depreciation expense, which means it is crediting it to the deferred grant account. It has determined that the plant will be depreciated over 5 years using the straight line method. In the month of March 2023, that is 2 years later, you have done all of this on 1st April 21, this is 2 years later, the government officials conducted a surprise audit and found that A has not been using the wastewater treatment plant as prescribed. So there is a violation of condition, and accordingly on 31st March, the government ordered the A Limited to repay the entire loan along with penalty. So repay the entire loan along with penalty. A repaid the loan with interest and penalty. Interest over here has to be ignored as per ICI solution. So we say along with penalty as per the order on 31st March 23. So we have to do all of these working. So over here the grant is 10.85 and this is to be shown in deferred grant account as per the company's policy. So if on 1st April 21 you had to pass the entry, this will be PPE account debit, let us say 50, to let us say bank, let us say 50. Apart from that, you will get a loan on 1st April 21, your journal entry will be bank account debit, you will get a loan of 25. To loan you will recognize at 14.185, to deferred grant you will recognize as 10.185. now depreciation is on a straight line basis. So on 31st March 2020-22 your entry will be depreciation account debit to PPE, which is over 5 years, so this will be 10 and 10. Again on 31st March 2023 there will be further depreciation of 10 and 10. Apart from that, there will be a government grant amortization. So on 31st March 2022 as well as on 31st March 2023, your entry will be deferred grant account debit to PNL. This will be 10.185 divided by 5 in the ratio of depreciation. 10.185 divided by 5, it is 2.037. 2.037, approximately 2.037 in both of these years. Now what happens is, at the end of year 2, what will be the entry? There will also be effective interest. So on the loan you will have 14.185 on which there will be an effective interest of 12% into 12%. This is 1.7022 and hence you will get a closing of 15.8872. In the second year 15.8872, there will also be an effective interest further of 12% and hence your closing will be 17.7936 approximately. This will be your regular loan using effective interest method. Now what happens at the time of refund? On 31st March 2023, the government ordered that you will have to give back the loan and hence loan account will be debited. Loan will be debited to the extent it is there, 17.7936. Acha, to bank if you have paid or to payable if you are yet to pay. How much will you record? Well, 25 you have to pay along with the 10 penalty. So you can pass a separate entry for 10 or you can record it as a part of this entry. Institute has passed a separate entry though. So this is 35, 25 and 10. Apart from that, there will also be some balance in the deferred grant account. Acha, what will be the balance in the deferred grant account? There was a balance of 10.185 or 10.815, out of which 2.037. नहीं, ये मैंने उल्टा ले लिया है क्या? This is 10.815 divided by 5 comes to 2.163. Sorry, this is just a small calculation mistake. 2.163 and hence you will have 10.815 minus 2.163 minus 2.163 will come to 6.489. So this is deferred grant, 6.489. However, the balancing figure will now go to the profit and loss account. So whatever is the balancing figure will be taken to the profit and loss account. So if we just verify this, 10.82 or 81, that is fine. Deferred income to PNL. So this is 6.48 or 49, that is okay. Loan account is 17.79, perfect, 78, that's fine. And hence if I take 25 lakhs, there will be a balancing figure of 72,000 approximately. So if I take 17.7936 plus 6.489 minus 35, that comes to around 10.717. This will go to PNL. Institute ke working mein 72,000 is going to the PNL first and then another 10 lakhs is going to the PNL later. Ultimately 10 lakh 72,000 is going. In our working also 10 lakh 71 or 72,000 is going. It is approximately the same. So basically you will first quantify the grant. A lot of things are getting covered over here. You will quantify the grant. Financial instruments is applicable. After that you will defer the grant over 2 years. IND AS 20 is applicable. In the meantime, you will also prepare an amortization table for 2 years. Financial instruments apply. And then there is a refund of grant as well. So all of these get applied. I would say this is one of a very, very good exhaustive question. Are we clear with this? Yes? Okay. So this kind of takes care of IND AS 20. You will have to refer this question again if you have not done this earlier. Then you go to question number 1 in IND AS 34, similar to a past exam question as well. This is on tax calculation. Estimated annual income is 1 lakh inclusive of capital gains earned in quarter 2 of 20,000. The tax rate on capital gains is 10% and on other income first is 40,000 and the balance income is 40%. Estimated income of each quarter is 25,000. Acha, income of 25,000 of the second quarter includes capital gains of 20,000. So there are two different categories of incomes. Assuming there is no difference between the estimated taxable income and estimated accounting income, calculate the tax expense for each quarter. So over here, if I were to do the tax expense, let us say for each of these quarters, how will the working proceed for tax expenses for each of these quarters? So there is capital gains, and then there is after capital gains you have other income. So when you look at estimated accounting income for capital gains is 20,000 only. For other income it is 25,000 in the first quarter plus 5,000 plus 25 plus 25. So over here you compare that with estimated tax. So if you compare this with estimated tax, this is 20 into I think 10%, this is equal to 2, and you will have a total of 80. So 80 may say the first 40 will be at the rate of 20% and hence the next 40 will be at the rate of 30%. So this will be, let's say 8 plus 12 equals 20. So your weighted average tax rate, there will be different tax rates, 10% for capital gains and 20 divided by 80 comes to 25% if I am not wrong for other income. And here 30, 40, I think I have got this wrong. So this is 30 and 40. So 40 into 30%, 40 into 40%. So this is 12 plus 16. So this is 28. 28 divided by 80 comes to I think 35%. And hence if I want to calculate for quarter 1, quarter 2, quarter 3, quarter 1 there is no capital gains, quarter 3 there is no capital gains, in quarter 2 there is a capital gains of 20 into 10% which is 2. In quarter 1 there is entire 25 into 35%. 25 into 35% comes to 8.75. In the second, this is 5 into 35%. So this is 5 into 35% comes to 1.75. 5 into 35% comes to 1.75, and then the other quarters, it is 25 into 35%, same ka same. This is 8.75. So over here, when you are looking at these workings, you will see 8.75, 1.75 and so on. So this takes care of IND AS 34 as well. Next you go to the last two standards which are remaining on these lines. One is IND AS 101, which is on first time adoption. Now this is a fairly problematic standard. If you have not done this earlier, do not do it now. It will not really go into your mind and unnecessarily create more complications. If you have done this earlier, kind of important topics you refer and you proceed. Okay, so IND AS 101 is on first time adoption. What do you do at the time of first time adoption? You first figure out what is the date of transition in the year when you are applying IND AS for the first time. That is, you take the first IND AS financial statements where you give the explicit and unreserved statement of compliance. That is the first IND AS financial statements. Comparative year, the first day of the comparative year is the date of transition. Like if it is 22 23 is your first IND AS financial statements, then the comparative year will be 21 22. The first day, 1st April 21 will be the date of transition. On the date of transition, just a day before, your accounts would have been prepared as per previous GAAP. That is the accounting policies followed in India like AS. And the very next day, you have to follow something like IND AS. And as a result, if you were to follow something like IND AS the very next day, in which case, on or after, let us say the date of transition, the very next day, if you were to, let us say, follow IND AS, then you will have to change the accounting as per IND AS. That is, you will have to take all the numbers as per IND AS. Now this can be very tedious because as per IND AS this will require a retrospective restatement, and hence the standard allows you to take deemed cost. Deemed cost is a proxy, a surrogate for the cost which would have been done as per IND AS. Ideally, if IND AS 101 exemption is not there, you will have to restate the numbers as per IND AS. That is, you will have to over here make all the changes as per IND AS. Derecognize items that should not have been recognized, recognize items that should have been recognized, reclassify items as per IND AS, and then remeasure them as well. Now, in order to facilitate transactions, various optional exemptions or mandatory exceptions are given. Important of them include share-based payment, where if there are vested options on the date of transition, you can either follow fair value or you can follow previous GAAP carrying value. For unvested options, you don't have that choice. If there are foreign exchange items, then FCTR is given a choice of to be reset at 0 value. For other foreign exchange items, which is foreign currency monetary item translation difference, para 46A of AS 11, then if you had earlier adopted para 46A of AS 11, you have a choice to continue with para 46A or move to IND AS 21. If you had not taken para 46A, you have to move to IND AS 21 only. If there is PP, intangibles, investment in subsidiary, associate, joint venture, on the date of transition, you are allowed to either retrospectively restate or take deemed cost, which can be fair value or which can also be the previous GAAP carrying value. In case of compound financial instruments, you will have to retrospectively restate and find the liability component and the equity component as on the date of transition and introduce the liability component and equity component and reverse your existing ledger balances. In case of business combination, you are given a choice to retrospectively restate from a particular date. So it is, you can either not restate or you are given a choice to restate from a particular date. Your restatement for non-controlling interest is directly dependent on the restatement of your business combinations. So if your business combinations, you decide to retrospectively restate, non-controlling interest will also be restated. If business combinations are not restated, NCI will also not be restated. In case of investment in joint ventures as per AS 27 were accounted using the proportionate consolidation method. Under IND AS, it is accounted for using the equity method. So whatever is the proportionate value of the assets and liabilities of the joint venture will be taken as the carrying value for the investment in case of equity method. Government loans at below market rates, you can do a prospective application if data on the date when the loan was taken is not available. If data on the date when the loans was taken was available, then you can do a retrospective restatement. In case of financial instruments, if effective interest rate can be determined reliably, then you can do a retrospective restatement. If it cannot be determined reliably, then you will take the fair value as on the date of transition to be the starting point. Okay, and estimates usually, if estimates were correctly done as on the date of transition, you don't need to retrospectively restate. You cannot take the benefit of hindsight. If the estimates were correctly done based on the facts prevailing, then you will not alter the estimates. However, if the estimates were subjected to error, you can restate in such case only. Okay, so this is about IND AS 101, and the last standard on these earlier lines will be IND AS 113, which is on fair value measurement. Fair value refers to the exit price. It is a price that you will get if you were to sell the asset or transfer the liability to a market participant. So it is linked to market participants, exit price on the market participants in the appropriate market at the measurement date. So when we are looking at the appropriate market is of two types. There is a principal market, there is a most advantageous market. Now within the principal market refers to the market where there is the highest volume of activity. That is what you call as a principal market. On the other hand, the most advantageous market is the marketplace which maximizes the net proceeds to be received. Net proceeds over here would include the the available price minus the transportation cost and the transaction cost. However, once you determine the most advantageous market which gives you the highest net proceeds, then the fair value is the price which is available using level 1, level 2, level 3 category inputs minus the transportation cost. Remember, the fair value is a price after deducting the transportation cost but before deducting the transaction cost. If you want to find a fair value less cost to sell, then you will take the value minus the transaction cost as well. The value is from the perspective of a market participant and it is not entity specific. So if a market participant over here wants to kind of buy the asset, how much value is a market participant willing to pay, irrespective of whether how you want to use the asset, that is irrelevant. In case of non-financial assets, you will take the highest and the best use. You don't have to exhaust each and every available use. You can take the highest and the best available use for the purpose of this calculation. Acha, when you look at fair value hierarchy, the valuation rule over here is you should select a technique which maximizes the use of observable inputs and minimizes the use of unobservable inputs. And in the fair value hierarchy, there are 3 levels: level 1, level 2, level 3. Within the level 1 hierarchy category, that is a quoted market price of exactly identical assets. In the level 2 category hierarchy, you take the adjusted price, and in the level 3 hierarchy, you will take the financial forecast. If preferable, you will take the valuation method which maximizes the use of level 1 category inputs and minimizes the use of level 3 category inputs. Okay, so this is about fair value measurement. We will quickly refer the questions for this. So we go to IND AS 101, which should be on page number 66. So let us go to IND AS 101. Acha. On 1st April 11, Sigma Limited issued 60,000 6% convertible debentures of the face value rupees 100 per debenture at par. Okay, so this is financial instruments along with 101. The debentures are redeemable at a premium of 10% on 31st March 15, or they may be converted into ordinary shares at the option of the holder. The interest rate for equivalent debentures without conversion option, okay, just a second, without conversion option would have been 10%. The date of transition as per IND AS is 1st April 13. Suggest how should Sigma account for the compound financial instrument as on the date of transition. The present value of 1 rupee receivable at the end of the year is as per 6% and 10% discount rate is given below. So over here, what is the date of issue? The date of issue is 1st of April 2011 and the date of transition over here is 1st of April 2013. So over here you can try to find the liability component and the equity component as on the date of issue. So you can try to find on 1st April 11 what will be the liability component. The liability component is the present value of future cash flows. So if I take at 10%, this is what, 0.91 plus 0.83 plus 0.75 plus 0.68. So this is 3.17. Acha. So I will take 30,000 into 100, so that's 30 lakhs into 6%, that is 1,80,000. 1,80,000 into 3.17 plus, it's an optionally convertible instrument which is redeemable at a premium, so this is 33 lakhs into 0.68. So if I do this working, 3.17 M plus 33 lakhs into 0.68 M plus MRC, so this is 28 lakh 14,600. Compare that with the issue price of 30 lakhs and hence the equity component will be 1,85,400. Remember, the equity component will not change but the liability component will. So you will prepare 28 lakh 14,600 and the effective interest you will say is into, let us say, 10%, this is 281,460 minus a coupon of 1,80,000. So this is 28,14,600 plus 10% minus 1,80,000 will come to 29,16,060. 29,16,060. To this you will add 10% and you will have 1,80,000 and hence this is 30 lakh 27,666 approximately. Now as per AS you would have recorded, now this is over a period of 4 years, and as a result, as per AS, there is a premium on redemption of 3 lakhs into 1 by 4. So that is 75,000 premium on redemption you would have recorded each year, and hence 30 lakhs plus 75,000 plus another 75,000. So as per AS, this liability convertible bond would be shown at 31 lakh 50. So on the date of transition, your journal entry will be convertible bond account debit. Previous gap carrying value was 31 lakh 50 to liability component as per that date will be 30 lakh 27,666 to equity component will be 1,85,400 and hence the balancing figure over here plus 185,400, the balancing figure over here will be 31 lakh 50 will be 63,066 and hence we will recognize this in the retained earnings, because this is adjusted at the time of transition. 63,066 will be done along with the retained earnings. So when we look at the retained earnings over here, this will be your adjusting entry. Convertible debentures will be debited and liability component and equity component will be credited. Retained earnings will also be debited over here. Acha. Then there is this next question, question 2. Now this is a fairly long question. It's next to impossible that such a long question can come in your exam. However, adjustments over here are relevant, so making such a big question is unlikely. However, adjustments we can quite discuss. So this is schedule 3 along with IND AS 101. So there is a company Shaurya whose entire balance sheet is given to you, and then there are a few adjustments which are schedule 3 driven adjustments. We'll quickly discuss them. First, other current liabilities include 3,90,000 liabilities to be paid in cash. So that is shown in other financial liabilities. So ये दिखेगा आपका other financial liabilities में. And 60,000 are statutory government dues. Government dues are not financial liabilities, so they will be shown under other current liabilities. Long-term loans and advances include 40,000 loan and remaining amount consists of advance to staff. Okay, so you will show a bifurcation. Other non-current assets include 2 lakhs capital advances. Capital advances are within other non-current assets only. Other non-current assets include 3,50,000 receivable in cash and prepaid expenses. Prepaid expenses is not a financial asset. Other than that, 3,50,000 are financial assets. Short-term provisions include dividend payable of 2 lakhs. The dividend payable had been a result of board meeting wherein the declaration of dividend for the financial year was made. However, it is subject to approval of shareholders. As per IND AS, you cannot recognize dividend till the time it is approved, and hence the effect will be reversed. Your dividend payable will be debited and your retained earnings or profit and loss will be credited. CFO of Shaurya has presented the following information against the corresponding relevant items in the balance sheet. PP consists of a class of office building whose carrying amount is 10 lakhs. However, fair value of the said buildings as on the date of transition is 15 lakhs. Okay. So at transition, you can either take the previous GAAP carrying value or the fair value. Company wants to follow revaluation model as its accounting policy in respect of PP for the first annual statement. So it is important, if the company wants to follow revaluation model, then you can take the transition value to be the fair value, in which case 5 lakhs will be debited and you can credit the retained earnings or even credit the revaluation reserve since you are planning to follow the revaluation model. So PP will be debited by 5 lakhs and revaluation or retained earnings can be credited by another 5 lakhs. The fair value of intangibles on the date of transition is estimated to be 2,50,000. However, management is reluctant to incorporate the fair value changes. Okay, if you don't want to incorporate fair value changes, then you take the previous GAAP carrying value, in which case no adjustment will be done. Shaurya acquired 80% interest in a company, Excel Private Limited, a few years ago, thereby acquiring control. At that time, Shaurya recognized goodwill as per the erstwhile AS, accounting for the excess of PC over the net assets as on the date of acquisition. Fair value exercise was not done. Ideally, you should do fair value exercise. However, data is not given, and as a result, you can assume that previous GAAP carrying value will continue. We will not retrospectively restate past business combination because data is not available. Trade receivable include an amount of 20,000 as provision for doubtful debts measured in accordance with previous GAAP. Now, as per latest estimate using hindsights, this provision needs to be revised to 25,000. No, we will not revise it because the estimates was correctly done at 20,000 based on the data available. Then no revision will be done. So this will have no adjustment. Acha, company had given a loan of 1 lakh to an entity for a term of 10 years, 6 years ago. Transaction costs were incurred separately for this loan. The loan carries a rate of 7% and the principal amount is to be repaid in equal installments over the period of 10 years at the year end. Interest is also payable at the year end. The fair value of this loan as on the date of transition is 50,000 against the carrying amount of the loan which is at present amounting to 40,000. However, IND AS 109 mandates to recognize interest income as per effective interest method after adjustment of transaction cost. Management says it is a tedious task to comply with the effective interest rate method and hence is reluctant to apply the same. Acha, in such a case, if you don't want to retrospectively restate, then the fair value as on the date of transition will be taken as the base, in which case over here you will have the fair value which is 50,000 and hence you will have loan account debit 10,000 to retained earnings. In your carrying amount 40,000 is appearing, fair value is 50,000, you will have to take it to fair value. Previous gap carrying value option is not available. You either retrospectively restate or you show as fair value. If you believe it is a tedious task, then you show it as fair value. In long-term borrowings, 4,50,000 of component is due towards the state government. Interest payable on the loan is 4%. However, prevailing interest rate is 8%. Fair market value of the loan is 4,20,000. Remember, if there is a government grant or a government loan, you can retrospectively restate if the data available at that point. If data is not available, you will have to do a prospective working. Specific rule applies, and hence no adjustment is to be done. You are given the prevailing rate as 8%. Ideally, I don't need the prevailing rate. I need the rate when the loan was actually given. Under previous gap, the mutual funds were measured at cost or market value, whichever is lower. Under IND AS, company has designated these investments at fair value through profit and loss. The value of mutual funds as per previous gap is 2 lakhs and is included in current investment. However, the fair value of mutual funds is 2,30,000. Achha, so you will debit the investment. You will debit the investment and credit retained earnings because there is no other transition base. So mutual funds have to be shown at fair value. They were earlier shown at cost, and hence 30,000 will be recorded. Ignore separate calculation of deferred tax on the above adjustments. Assume net deferred tax to be 50,000 on account of transition. So you will have deferred tax with the corresponding adjustment to retained earnings. It's a huge, humongous question. If it comes in the exam in the same form, I am telling you, you don't try to attempt this. See if there are other optional questions possible, because the amount of time it will take to complete does not justify. Even if it comes for around 15 or 20 marks, it is humongous. You have to schedule 3, all of these adjustments. So if it is in a compressed or shorter form, or the paper is very small, which is very unlikely, then you can try. Otherwise, it's a very long question. Okay, so this is IND AS 101. Next, you go to IND AS 113. So in IND AS 113, this is question 1. Achha, just low in battery, sir. Hum bhi low hai battery pe. Achha, we just quickly have to finish these 2 questions. An asset is sold in 2 different active markets. That is a market where transactions take place with sufficient frequency to provide pricing information on ongoing basis at different prices. An entity enters into transactions in both markets and can assess price in both these markets. In market A, the price that will be received is 26, transaction cost are 3, and cost to transport are 2. The net amount is 21. Okay. And in market B, the price is 25, transaction cost is 1, and the cost to transport are 2. That is, the net amount would be received is 22. Find the fair value if market A is a principal market. If market A is a principal market, that is 26 minus the transportation cost, which is 2, and hence 24 will be the fair value. In the second case, you will have to figure out if none of them is a principal market, then the net proceeds in B is 22, in A is 21, and hence B is the most advantageous market, and hence the price in B would be 25 minus 2, which is equal to 23. It is very similar to a past exam question, which had also come. Achha, this is question 1. Then you go to question number 2. This is on decommissioning, finding the fair value of a decommissioning liability. On 1st January 11, A assumes a decommissioning liability in a business combination, so you want to find the fair value. The reporting entity is legally required to dismantle and remove an offshore oil platform at the end of the useful life, which is estimated to be 10 years. The following information is relevant. Okay, if A was contractually allowed to transfer the decommissioning liability to a market participant, it concludes that the market participant would use all of the following inputs, probability weighted, as appropriate when estimating the price. So how will I find the value of decommissioning obligation from a market participant perspective? There are certain labor costs. So we are expecting labor costs. Cash flows is 100, 125, 175. Different probabilities given. So if I take the weighted average, 100 into 25%, M plus 125 into 50%, M plus 175 into 25%, M plus, and hence the total comes to, just a second, 100 into 25%, 125 into 50%, 175 into 25%, and hence the total is around, just a second, I think this calculator, Okay, this is 131.25. But when I dismantle, I will not just have to use labor. Along with labor, I will have to also use equipment, and hence there may be overhead cost. There is overhead cost which is 80% of labor cost. So 131.25 into 80%, that is 105. This is the overhead cost. However, this is just the cost. Remember, if I am taking over your liability, there is so much of headache which comes along with site restoration. So I am not just going to measure it at cost. The compensation for a market participant would require for undertaking the activity for assuming the risk associated with the obligation to dismantle and remove the asset. Such a compensation includes both profit on labor and overheads. I would say that 131 plus 105, that is 236.5. This is the cost. But if I were to appoint a contractor to dismantle, 236.25 into a profit markup of 20% is consistent with the rate that a market participants would require into 20%. They would say that 47.25 I will additionally require because of the headache that I am taking. Or if I appoint a contractor to dismantle, he will not just charge me the cost, he will also charge me the profit margin. And the risk that the actual cash flows might differ from those expected excluding inflation. A estimates that the amount of that premium to be 5%. So over here, we are expecting that the contractor will charge us 131.25 plus 105 plus 47.25. That is, the contractor will charge us 283.5. But it is possible, like in working capital in your interest year, you keep a buffer, a safety margin. There is a possibility that the cash flows might change, and hence there is a 5% buffer that is kept to the extent of 14.175, and hence if you total, this comes to 297.675. The expected cash flows are real cash flows in terms of monetary value today, which means the effect of inflation has not yet been considered in all of these cash flows. So you will have to consider the inflation effect separately. The effect of inflation on an estimated cost and profits, he assumes that the rate of inflation is 4% over the 10-year period, unless given otherwise it is 4% per annum. So this is 297.675 into 1.04 raised to 10. So this is 1.04 into raised to 2, 3, 4, 5, 6, 7, 8, 9, 10. So this is 297.675 into 1.4802. So this is 297.675 will be 440. So this is 440.63. So this will be 440, let us say 0.63. Okay, based on available market data. So this is 440. So we are expecting the total cost to be incurred after 10 years, considering inflation, considering profit margins, considering safety margin, everything is 440. But remember, the value today is the present value for which I need the discount rate, and inflation is not just the discount rate. The time value of money represented by risk-free rate is 5%. Risk-free rate will include the compensation for inflation and non-performance risk relating to the fact that entity A will not fulfill the obligation, including A's risk is 3.5, and hence 5 plus 3.5, that is 8.5 is the discounting factor. A concludes that its assumptions will be used by market participants and A does not adjust the fair value, blah blah blah. Calculate the fair value of the retirement obligation, which is 440.63 into the present value factor at the rate of 8.5% for 10 years. All of this is happening over 10 years. So this is 1 divided by 1.085, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So this is 0.4423. So this is 440.63 into 0.4423 comes to around 194.89. So this comes to around 194.89. This is around 194.7. Different ways in which you can come to approximately the same answer. Okay. So this kind of takes care of all the standards. We have discussed all standards with crucial sums, important sums to the best extent possible. So over here, what we can do is actually, it's already a little late. I mean, if we stop for a break and we come back, in any case, we still have major topics remaining. I don't want to unnecessarily just cram them up and finish them up. We will in any case be keeping this on YouTube. So I will end this session now, and tomorrow we will continue with this session. If that is fine, because otherwise it's a little too much, I guess, to kind of absorb. In any case, you can sleep over all of this that has been done. So there are around 5 or 6 topics. Yes, there may be sundry miscellaneous topics like CSR, etc., which are also remaining, but the bigger topics like consolidation, business combination, maybe it's better if we do from a fresh slate. Another 3 odd hours is what I at least expect to kind of finish that and do justice to these topics. So we will keep that on YouTube. So if you are having some other plans tomorrow in the morning, tomorrow, I guess I'll just share on the Telegram channel, but probably tentatively we can keep 11 and 11 to 2 or 11 to 3. We can try to wrap this up tomorrow itself from a fresh perspective. So, okay, perfect. Chalo, thank you very much for your patience and your time. If there are any specific questions or something that you want me to specifically address, I'll just glance through the comments box. Let's keep it at 11 o'clock tomorrow. Yes, because already we have gone through a lot. We have almost done this entire course to the best extent possible. Yes. Chalo. I hope this session was helpful for you, and I'll not take more of your time. So I hope you have got a good recap, a refresher, because you might have done FR some time back. So I hope at least a lot of things have come back to you and you take this momentum into your preparations. Okay? Chalo. I'll see you tomorrow at approximately 11 o'clock in the morning. We'll continue further and try to wrap this up tomorrow. Okay? Chalo. Have a good day. Sleep well, and I'll see you tomorrow. Bye-bye. Take care. See, in analysis of financial statement, now honestly there is nothing new. There is a lot of confusion that analysis is there, not there, should you do. If you refer analysis of financial statements, there is absolutely nothing which is new as compared to other standards. So if you know the other standard principles, you know analysis of financial statements principle, you don't have to separately sit and study any separate concept. Yes, if you want to practice, you can. It's like, I mean, in DT, like computation of income, you will know that if you have, you know the other heads of income, right? So analysis is just random sample problems from different chapters. So you can just review them. There's nothing new in those points. Okay? Okay, I'll end the session then, and I'll share a separate link for tomorrow as well on the Telegram channel.